All right, it is 9 o'clock here in New York City on this Wednesday morning, August the 4th. Welcome to Yahoo Finance Live. I'm Miles Ludden, joined by Brian Sozzi. Julie Hyman remains on vacation. We're about 30 minutes out from the opening bell here as we get the third trading session of the week underway. Taking a look here at futures, we see that all three majors are lower. Surprisingly, the market actually moved a little bit on that ADP jobs data. We'll get into that coming up later on in this half hour. But the attention this week continues to be on corporate earnings. We're going to be breaking down results from Lyft and General Motors. We see here on the calendar, we've got Dropbox, Uber still on deck to come, Wayfair, Kellogg, AMC Friday morning. That should be we got jobs there on Friday, but really AMC results, I think, are the highlight there. Plus, shares of Robinhood, they're up. We'll talk about why. Who could really say? Stock up 14% pre-market. Shares went down. I think it will close down, 9% on their first day of trading. And now we see $53 a share in pre-market indications for Robinhood. We'll talk about that. I mean, I've kind of said the whole story, but we'll talk more about it coming up in about 10 minutes or so. But let's begin the show as we have really for the last couple of weeks with what's going on the earnings side. And yesterday, we got some interesting results out of Lyft after the market closed. The company hitting adjusted EBITDA profitability a quarter earlier than the company had projected. We see here top line results, revenue $765 million. That was better than expected, up about 100% from the same quarter last year. Obviously, the COVID impacts there clear to see. The adjusted earnings or adjusted loss per share in this case coming in at about 5 cents. But Brian Sozzi, the adjusted EBITDA profitability number, the one that really has investors excited this morning. But stock after that call had initially popped yesterday, and now we see shares of Lyft a little change, down about 0.9%.
Yeah, this was them achieving this metric or this major financial milestone. This was well telegraphed by Lyft's management team. They've been talking about this, I believe, for over a year consistently. Now, it did happen 1 quarter quicker than they thought, but the surprise, the earnings call, they expect to sustain this profitability into the third quarter. Overall, they expect to be adjusted EBITDA profitable in the third quarter, which is very interesting to see, given that they're going to be investing in lower prices. They talked at length about this on the call, that prices right now for rides are just too darn high because the supply of drivers remains under pressure here, so that pushes up the prices. But overall, this is a very good quarter for Lyft. You saw them benefit from the recovery in many major markets. Now, the big variable is, can they deliver on the guidance they have put forth for this quarter as we see the Delta variant spread and perhaps sending people back inside?
Yeah, I think the way that they termed the pricing that we've seen, we discussed this yesterday on the program a little bit, in the run-up to these results, you always have this tension of what do the numbers say versus what is the person on the street, the person you work with, your family member tell you about this service. And I think here on the call, at least, Lyft was pretty forthright about the frustrations that you can grab from just about anybody who's used Lyft or Uber in the last few months. The company saying to date, riders have been relatively patient with what they called a less than ideal or with less than ideal prices and service levels that they are faced industry-wide. So I don't think that really holds any, pulls any punches on just, how, let's call it degraded, perhaps, is maybe the right word here. But, I think that has some other connotations with it. But certainly a more challenging environment, let's say, for Lyft and for Uber. And we'll hear from them tonight.
Yeah, here's one of my numbers of the morning. Lyft is tracking to more than $1 billion this year in terms of driver incentives. What is that? Essentially, they're incentivizing human beings to come and drive for them so they can see this or service this real influx in demand that they're having. That is a very big number that will continue. Now, the positive thing is they are starting to see more drivers return to the platform. New drivers in July were up 11% month over month. That is a good indication that people are actually biting at these incentives and coming to work for Lyft. But also, I want to highlight, we talked about this in our Uber Lyft preview yesterday. You're seeing the stock decline here because there were very high expectations built into this quarter. Uber, on the other hand, the setup might be better into that report later on. The stock has been down about 20% going into this earnings report.
Something else I want to note here with Lyft's results is the number of active riders they have on the platform, up to 17.14 million in the most recent quarter. That's up from 13.4 that we saw in the first quarter of this year. But compared to the first quarter of 2020, so they give us 6 quarters of results here just within their release, 21.2 million active riders is how many Lyft had on its platform in the first quarter of 2020. So we've talked a lot about 2019 comparisons, but as we can see here on this chart, the company's still about 25-30% below those pre-COVID levels in terms of the riders on its platform. And I think it'll be, and I'm not sure when exactly the company feels confident that we're going to regain those levels.
Yeah, no, but at least in terms of Lyft, it's an easier story to understand. There are a lot of moving parts when Uber reports after the bell tonight. It's just a bigger operation, but you do get the sense that Lyft, its intense focus on driving actual profitability the past year and a half, they've cut a lot of expenses. However they've been able to do it, they have delivered, and that's a lot of credibility, a lot more street cred to that management team.
All right, let's stay in the auto space, totally different businesses, but we'll work on the transition there. General Motors also out with its results. The company here we see beating on the top line, slight miss on the bottom line, but Brian Sozzi coming out raising its guidance, which is a nice outlook there for investors.
There's another theme here building, and it's not just GM and Lyft. It's the market taking profits on really strong results. You have GM coming out here today, $4.1 billion in adjusted operating profits. Last year, they posted a $536 million loss. So that is a big swing considering they are up against the chip supply shortage that has shut factories down. So to come out here and deliver over $4 billion in operating profits against that backdrop, to me, is impressive. And they're out here raising their guidance it should be commended. I do think where the market is locking in here, and again, so they had this reaction to first quarter results. GM is pulling a lot of investment forward, $8 billion to build out new factories to support 30 electric vehicles coming to market by 2025. I do sense that skepticism on the street. Will these electric vehicles, will they be profitable for a GM? And if so, what are the margins on them? Are they higher than those GMC Chevy trucks they're pumping out?
Yeah, I mean, talking about $35 billion, and the company had already announced this, but Mary Barra in her letter to shareholders for the second quarter reiterating, pulling forward $8 billion worth of investments. So now we're looking at $35 billion in investments in electric vehicles and self-driving tech through 2025. And we like to joke about it on the show as the calendar turns. It's basically 2022. So it's only 3 more years there that we're, looking at this runway for investment. I know when companies come out and they say, here's our 2025 plan. We talked to Pepsi yesterday. They have a 2026 cost management plan. I mean, those dates come up. Those dates come up quite fast, and we've certainly seen GM responding to that, pulling forward some of that investment.
Some fun facts here. The quarter was primarily driven by U.S. sales of pickup trucks. The Chevy brand sold 235,000 trucks in the quarter. That was compared to 176,000 last year. GMC, a brand I don't think a lot of people focus on. I know I normally don't. They sold 153,000 models in the most recent quarter compared to 100,000 last year. The country remains in love with trucks. They love trucks.
I rented a Denali once. It was very nice.
Really?
Yeah.
Is that a truck, though?
No, it's
We're talking pickup trucks.
No,
you haul hay around.
No, it's like the GMC version of the,
that don't count.
It's like a long car.
Yeah.
It was nice.
To take that ride on the Uber Black, about $100.
More than that, probably. All right, let's turn from the world of cars to the world of cryptocurrency. SEC Commissioner Gary Gensler yesterday spoke to members of Congress and called on them to rein in the Wild West of cryptocurrency world. Yahoo Finance's Brian Chung joins us now to discuss the very calm and unloaded conversation, Brian, around cryptocurrency regulation, which Gensler certainly stepped into yesterday.
Well, I mean, it was a big deal. It was the SEC chairman's most comprehensive remarks since he's really taken office on the crypto space. And honestly, it was kind of a nothing burger at the end, because for as long as the speech was, he was speaking to the Aspen Security Summit, they really just kind of called on Congress to say, hey, maybe draw out the stakes for where regulatory agencies need to be in terms of saying this is what you should be regulating in terms of these are securities, these are not securities, these are exchanges that you should be regulating, these are places that you shouldn't be regulating. And take a listen to what the chairman of the SEC said, broadly speaking, though, about how he's approaching the cryptocurrency regulation space.
That's where I am about Bitcoin and the crypto space. If somebody wants to invest, as they have in gold or silver, that might be a speculative play, but to layer over that investor protection. And I think that enhances economic activity, but also protects investors. We wouldn't have the use of automobiles today if we didn't have some basic bargain. If we had no traffic lights, no stop signs.
Kind of a perfect segue that you had over there from cars to crypto, because he was comparing the cryptocurrency space to saying, hey, it's very much like the creation of automobiles in the 1930s, that you just didn't have this technology coming out of nowhere, that it was kind of a government partnership and them setting up the infrastructure to have traffic lights, to have stop signs. Now, of course, what does that mean or translate to in the cryptocurrency regulatory space? No one really knows, which I think is a big reason why, even though he's calling on Congress to say, here's the legislation for what you should be regulating, it's going to take a long time for Congress to figure out what that looks like.
Did Gary Gensler get room rated? I liked his room.
Yeah, it was a little bit too high. He's a short guy, so I guess maybe the camera wasn't set up right. But.
Yeah. Switching gears a little bit, we're still watching Robinhood. I mean, it's now up double digits here in the pre-market, up 25% yesterday. And you really, I think, put it perfectly on Twitter, Brian. More buyers than sellers, and that appears to be the case. The retail trade, just what I've been reading all morning long, appears to be now underneath Robinhood, really ever since Cathie Wood stepped up here and bought that stock.
Yeah, well, I mean, again, we're a few days out from the IPO. Again, who's to say whether it goes up or down? Obviously, these are kind of interesting movements. But I think, broadly speaking, we have to talk about the new trend that we've been seeing in these IPOs. It's been historically the case, at least maybe 4 or 5 years ago, that when IPOs would come out, they would have the big pop on the first day of trading. That hasn't been happening with a lot of these big high-profile IPOs. And whether or not that's because of the scale, is it because there's something unique about these unicorns when they take them public? Is it because the underwriting, the banks are just doing a different approach when it comes to maybe underwriting these types of IPOs? I think these are larger questions that really say, hey, is that expectation, I don't want to bring the Lucas critique into this, but is the expectation that IPOs often pop on the first day now busted because people have recognized that tends to be the trend?
And it's happening without a major move in crypto. Crypto, for the most part, has been stable for a little bit. So this move is happening without Bitcoin going to 60,000.
Should we do the pricing? The pricing thing? I don't want to do the pricing thing. The pricing thing is the most overplayed critique and conversation around the IPO market that you could possibly imagine. But look, you want to talk about Robinhood? What was Gensler really talking about yesterday, Brian? I think he's just discussing something that investors in the equity market and the bond market, but let's call it traditional institutional markets, something that they take for granted because regulations say that you basically know who your counterparty is and what the counterparty risk that you are taking on is. The problem that Robinhood traders came into in January is their counterparty, Robinhood, ran into problems overnight that they didn't know about. That's why they weren't able to buy or sell GME or AMC in the proportions they wanted. They had a counterparty risk. And I think Gensler's basic point is that there are a lot of people, a lot of operations within the crypto market where you don't have that same level of knowledge, and that's something that he thinks the SEC needs to and should be able to step in on.
Yeah, and I think, to be fair, we have to delineate that yesterday his remarks were mostly about crypto, but they are connected, because when you hear that bit that we just showed you, he's saying, look, I don't care if you make a play that loses you a bunch of money.
Absolutely.
That is your right as an investor. Investor protection is not stopping you from taking a loss in a position. What investor protection is making sure you don't get scammed or make sure that you don't get defrauded. Now, when it comes to translating that crypto space into specifically payment for order flow, I think there's a lot of conflation, right? People are saying, oh, well, the SEC is going to try to crack down on PFOF. And honestly, from Gensler's remarks, it sounds like he has really not much interest in maybe going beyond just studying the issue. I think, like you said, it's really about the clearinghouses. What is the DTCC's role when it comes to these brokerages because of specifically these high volumes that come as a result of PFOF and other innovations?
Yeah, I mean, Coinbase in their IPO is outlining, I think correctly, that crypto has gone through multiple price cycles. And there will be future price cycles, within that context. But along with those price cycles, we've seen various exchanges blow up. Where's the Bitcoin? It's gone. Or where is the stuff I pledged to you, central clearinghouse, that was supposed to have either my currency or help me clear my trades or find a counterparty for my trades? They just disappear. And I think that what Gensler is saying is that that's not going to be an acceptable long-term answer of sometimes the money is just gone. I mean, that happened, I guess, 30, 40 years ago in U.S. equity markets, and they regulated that out, right? So it feels like that's how he's thinking about this issue.
Well, I mean, DeFi is going to be a big focus for that reason, right? Whether or not there are these tokens that are being exchanged. I mean, he was saying in his speech yesterday that there are tokens that he feels should be registered that aren't registered, and there are DeFi platforms that should be registered that aren't registered right now. And I think for those exact reasons, that's why that may be a bigger focus than, say, the regulation of the securities themselves. That's fairly clear.
And all this is in the metaverse, guys.
Oh,
it's all in the metaverse.
This guy.
All of it. Metaverse.
I feel like we just ran through everything that we have to talk about in the last 15 minutes.
Let's wrap it up.
Now we're going to do an hour and
let's go
45
home.
minutes.
Good to see you.
of program.
Let's go home.
Be done.
Ladies,
All right,
let's go home.
Coming up on the other side of this break, it is Jobs Week, and ADP out with some disappointing data on private payroll growth about an hour ago. We'll get into some of the details on those numbers coming up right after this.
The U.S. economy only added 330,000 jobs in July, according to the latest from ADP. Wall Street economists had expected an increase of 690,000. Now all eyes shift to the non-farm payrolls report due out this Friday. Let's dive into all things jobs now with ADP chief economist Neela Richardson. Neela, always good to see you here. Disappointing report on the headline. Is this a sign that the Delta variant is having a greater impact on the economy than a lot of folks think?
You know, the Delta variant is just one part of the uncertainties that are currently characterizing the labor market. There are other bottlenecks that were there before the Delta variant really became part of the national attention, including childcare and the lack of childcare over the summer, bottlenecks when it comes to the timing and matching of hiring, a shift to more long-term workers making up more and more of the unemployment roles. And I would have to say this hiring mismatch with firms all wanting to hire the summer while consumers and workers may have benefited from transfer payments or generous unemployment payments that keep them off payroll until the fall. So all of these things are kind of coming together to show up in a very uneven but still progressive labor market recovery.
You know, Neela, in today's report, I'm struck by what we see in construction and manufacturing, just a combined 9,000 payrolls added in July there. And given what we've seen in some manufacturing data where employment improved last month, what seems to be holding back the appetite, at least, for hiring in those sectors?
I think the appetite is there. I think the meal is missing. So right now, skilled workers have been in short supply, but this isn't a pandemic phenomena. And when it comes to construction, those in specialized trade have been missing in action for the past 10 years. It's one of the reasons why housing has been in such short supply. In manufacturing, you're still seeing that missing skill set dominate in terms of hiring. So this isn't new. It's just been amplified by the pandemic. We think that manufacturing and goods sector in general is holding up pretty well, given the labor shortages and anecdotal evidence around that, and also the supply chain bottlenecks that are ongoing because of the pandemic. So again, that unevenness continues, but progress is being made.
Neil, is it also the problem here that employers perhaps are not raising wages fast enough to get workers back into the market? We had an announcement today from CVS raising their wages to $15 an hour by July 2022. On the paper, that sounds good, but it should be $20 an hour to work in a CVS.
Right. So there is a limit to how quickly wages can adjust to meet current demand and supply dynamics. It's hard for companies, especially small businesses, to raise wages to attract new workers, because that also means they have to raise wages to retain existing workers. And if you're in a slim margin industry and you're still dealing with the effects of the pandemic on your revenues and cash flow, that could be a very challenging spot to be in. But we're also seeing at the same time that the prevailing wage may not attract the same quality of worker that was before the pandemic. And if you need any evidence, you can look at the overall number of people who are leaving their jobs to look for new ones. That's actually higher than it was before the pandemic. So there is a reassessment of work going on at the worker level. Wages help kind of narrow down those options pretty quickly. And so firms that are competitive right now are the ones who can adjust wages quickly. But over the long term, it's that skills match that's most important in retaining a high quality, productive workforce.
And Neil, I'm also struck by the seasonality that we can see in this report, and you guys have a chart that goes back over the last 12 months, and we saw a surge from July into September of 2020, back down, surge from March into May, and now back down. And I'm curious how you're thinking about the labor market as we head into the school year. That's been a big potential catalyst. Is that something that's on your radar as maybe helping to increase the rate of hiring, or are we likely to see another false swoon?
Seasonality is also conflated with the path of the pandemic. So a lot of the ebb and flow of the labor market can be attributed to the rise and decline of the case count. And so as we head into the fall, we're also heading into a fall that looks increasingly uncertain from a pandemic perspective, right when we thought that the case count was being put to bed, and definitively so. So even as we expect higher vaccinations to improve health conditions going forward, there's still some uncertainty. That is matched up again now with the fall, with the idea that schools would be back in session, that parents would be freer to look for work if the child care was in place and elder care was in place. But we can't also miss out of these structural dynamics. We're seeing a record number of business applications, for example. We're seeing new retirees and early retirees shape the job market, and then a lot of switching jobs, which we've already pointed to. So all of that churn is going to impact the fall labor market as much as it is the summer labor market.
Neela Richardson, ADP Chief Economist. Always good to see you. Have a great rest of the week.
Thanks for having me. Good to see you guys.
Coming up, Miles and I are back with more earnings season analysis. The earnings storm just refuses to end. Stay tuned.
All right, welcome back to Yahoo Finance Live on this Wednesday morning, about 3.5 minutes out from the opening bell here, and we see futures pointing to losses at the open. Markets reacting to that ADP employment report, which came in a little bit weaker than expected. Some 330,000 jobs being added to the private sector in the month of July. But earnings, really, center of the storm continues here. Let's take a look quickly at what happened over at Match Group in the company's most recent quarter. The Tinder parent company out with its results last night. We see here a beat on the top line, slight miss on the bottom line here. Brian Sazzi, though, seems that the pandemic has not really slowed down. And we've seen just surprising performance. I think the strength of the business, from a Match Group shows that people are looking for companionship, let's say, in the pandemic. We have each other. We get to talk to each other every day. But a lot of people still at home all the time.
Yeah, I ain't searching for you on Tinder, Maz. I love you, man. But I'm not looking for you there. But Match Group, it might be also time for a new logo. Really not liking that thing. But anyway, you're looking on how the company performed in the most recent quarter. I am surprised to see the market reaction here because Tinder, which is really the main dating service inside of this company, they are noting vaccination rates continue to rise. Tinder to direct revenue growth is accelerating as users' propensity to pay is increasing. So people are getting vaccinated. They're willing to fork over more money to go out there on 5, 7, 10 dates a night. And you're seeing it in the Tinder direct revenue, which hit about $399 million in the most recent quarter. In 2019, for this same time period, we like those 2019 comparisons, that number was $276 million. So good to see people going back out there, getting their dating game on.
And they have a chart in here of Tinder. They call it Tinder's a la carte revenue. I guess this is when you decide I want to swipe boost on an ongoing basis. I'm not sure.
Swipe boost?
Well, you can, there's like extra swipes, right? Isn't there like a Tinder Plus thing that you pay for, but then you could maybe, I guess you could pay to get.
You have to get Zach Guzman in here. He's our chief
we
dating
should really
officer.
we should really be better with the product side of this, but we shouldn't because neither of us have a use for it. Just wanted to point out Tinder's a la carte revenue, which Match flagged in its release, over the last quarter has really been above what the company saw in January. And of course, in January, you expect, as you see every year, a spike when people say, okay, New Year's resolution, I'm going to find someone this year. So for the company to be above those sort of one-time seasonally aggressive numbers, I think an encouraging sign through the summer.
We're getting some breaking commentary inside of our Slack channel here, explaining to boomer folks like us what is some of these things on Tinder. You can get extra swipes, and if you pay more, there is no limit on swipes. So I guess that's a good thing. Okay. I mean, I don't know. Never used the thing.
It's great. Yeah. All right, let's quickly talk about Kraft Heinz. Company reporting out with its earnings and sales down in the U.S. business. Sales decreasing about 2.3%, I believe, in the U.S. market. 3.6%, excuse me, in the U.S. market in the most recent quarter. Beat here on the top line, beat here on the bottom line. But Sazzi, I think something that stands out to me, company talking about a more normalized promotional environment in the U.S. relative to last year.
Well, if you're going out and you're using Tinder, don't give that first date a box of mac and cheese. I love this transition.
And certainly don't transition from a Tinder super swiped into the Kraft Heinz.
Absolutely not. But I think what you're seeing here is, Doma, our friends at Doma, ringing the opening bell. Always good to see you.
Bailing us out of this segment here.
Yeah, good stuff.
Notice yesterday we had a guest going. Things were good here. We didn't play the sound. Yeah. But today our producers are like, these idiots are talking about Kraft. They're talking about Match. Let's play the sound so they shut up.
But Doma, good logo. Like that logo. Match Group, no go. But I will note on Kraft Heinz, where the stock is under pressure here, this stock historically trades off of the U.S. organic sales number come earnings day, and that fell 4%. And so you're seeing the market concerned that that pandemic pantry loading that we did last year is definitely not continuing. You'll talk more about that. We didn't see that at Clorox yesterday. They got destroyed because nobody's buying wipes to the extent they were.
Well, what's interesting about Kraft calling out the promotional environment normalizing relative to a year ago is that on the call, Clorox was asked, and now we're kind of mash these two things together. Granted, it's different parts of the grocery store, but ultimately in an increasingly commoditized grocery store, both those companies are selling premium brands. So how are you getting someone to buy a branded slice of cheese rather than a generic slice of cheese? Same thing with wipes. And Clorox was asked, why are you guys doing promotions right now? And I think for Kraft saying that the promotional environment is getting more aggressive, it's essentially telling us that the amount of money and time and interest Americans have at the grocery store is going back to pre-pandemic levels. That's the way that I'm reading it.
Yeah, this has been a disastrous season for consumer products companies of any kind. Cleaning products, food, P&G, Kraft Heinz, I'll give them a pass. This was a pretty good quarter for them. That recovery continues, but a lot. Clorox, just real dreadful earnings days.
And I think what's surprising, and I was listening to an interview on the way into the office this morning with a strategist over at Bridgewater, and they were talking about how inflation has created such an interesting environment today where the textbook tells you when you have more demand for products than there is supply, you go ahead and you raise prices. And we're continuing to see companies, they have demand for their products. They cannot bring the supply in. And it doesn't exactly apply in these situations, but it's important here because they're then not going and aggressively raising prices into that kind of market. They're actually going back to the old discounted model. And so you see complaints about margins, you see problems, on the bottom line for some of these businesses. But shouldn't it be the environment when you're jacking up cheese prices 50%?
Yeah, look, that stock has done squats since mid-May. I mean, and as it should, because there are concerns about forward demand and can they push through price increases. Kraft Heinz noting in their quarter pricing up 1.5%. I'm not paying $20 for a box of mac and cheese.
I mean, I think that's what's interesting on the inflation side is that the answer to can you jam through price increases into pretty much the best consumer environment most of these companies have operated in. Could you? Yes. Are they trying to? No. And so it's quite a time for investors. They're saying, well, we're going to deal with it on the cost side. We'll hope that passes, and then we'll get back to however we were modeling the business previously. Another company out with its results this morning, CVS. Sazi, a couple of headlines here stood out to you. Take a look at CVS's latest quarterly results, and we can see the company with a beat on the top and the bottom line, as has become the pro forma expectation here from investors.
Well, good to see CVS getting with the times here, raising their hourly wage to $15 an hour by July 2022. Unclear what the profit impact of that would be. Perhaps you're seeing that start to be priced into the stock today, but they're well behind the curve. Many others in retail, Target, Walmart, they've been well ahead of the curve in a lot of the pharmacy chains in lifting their wages, and they have to do it. I think the next question is for Walmart, for Target, CVS, now next up probably the dollar stores, when do you get to $20 an hour? Mm-hmm. Is $15 an hour in an inflationary environment, does that really cut it? Probably not. Especially if you have hours cut. You're working 25 hours a week.
Yeah, look, we could do you could do the political science side of it, where you didn't get $15 as a mandated minimum wage, but you said fight for 15 over and over, and now everybody does 15. Now all major national employers do $15 an hour. So
fight for 25.
Well, there you go, yeah. Brian Sazi. What are you going to run for on the fight for 25? How are you going to start your career?
I just want to help people.
I know, but you got to pick a position within local government to start.
I don't know.
Okay. Comptroller, Brian Sazi.
Comptroller, I like that. That's good.
Comptroller coming up. Fight for 25.
Senior Treasurer Officer.
Brian Sazi. All right, coming up on the other side of this break, Jared Blickery going to join us from the floor of the New York Stock Exchange, talk about some of today's market action. We've got nothing on why Robinhood's doing what it's doing. We'll ask Jared if he has anything on that front coming up right after this.
head down to the New York Stock Exchange and check in with Yahoo Finance's Jared Blickery. Jared, all eyes are on Robinhood here. The stock basically opened up 40%, and now we're getting reports that the stock has been halted. What's the latest?
Yeah, I was just checking it out myself. What an incredible run. I'll tell you what I'm going to do right after this, and I'm loading on the Wi-Fi Interactive right now. I'm going to add this to my meme stock heat map because this seems to be one of those meme stocks right out of the gate, kind of like Coinbase Quasi was. But you take a look at what's happening now in the Wi-Fi Interactive, 40%. I was looking at the technicals yesterday, and by the way, I'm not seeing any fundamental news or pegs for this kind of price action that we're seeing. I'm going to go to an intraday look here, and you can see once it broke above its IPO price of about $38, $39, it was off to the races yesterday, and now we're seeing continuation. I don't think we have any short interest just yet on this particular stock, but it looks like the meme stock traders, the Redditors, are buying and holding. Another thing on my radar today is the chip market, and it looks like my display is frozen here, but a lot of action in the semiconductors. We have the SOX, that's the Philadelphia Semiconductor Index, at another record high today, and this is an industry that it was flagging a little bit over the last couple months, and now it's reemerged. So it's nice to see those stocks advancing here. Now in the Nasdaq 100, I'm seeing kind of a mixed picture for the mega caps, and a lot of red in a lot of these heat maps. In fact, if we go to the travel sector, this would be the second day where we're seeing a lot of this action. Live Nation in the upper right, that's an earnings story. And by the way, if you want to check out what's going on in the earnings season right now, just take a look at this. That's a lot of dark red. And this is coming off of a lot of companies having record beats, record earnings season. So this is something I have my eye on. A lot of these companies are being punished right now for above average results.
Yeah, I mean, also on that reopening bracket, Jared, we saw that we had Avis on there, a company also out with its results. That stock down about 10%. Jared, thinking more broadly about the market, how surprised were you to see a reaction to the ADP numbers this morning? We saw bonds rally, we saw stocks sell off in kind. It's not typically a number that comes with market reaction. Is that telling you anything about liquidity conditions, about anxiety within the market? I mean, how do you see that move? Because again, I think catching a lot of people by surprise to see any market reaction to those numbers.
That's exactly right, Miles. This is not a report that typically moves the market. Everybody wants to know what's happening with the official numbers on Friday. So I think there is a bit of anxiety here. I was taking a look at the 10-year T-note yield. It's threatening to breach down to about the lowest level since February. So I would definitely keep an eye on this. This is kind of one of those environments where we're seeing growth stocks accelerate. I have seen a little bit of a stealth rotation into some of the value and cyclicals, depending upon the earnings reports over the last few days. I'm still keeping my eyes open for that, but my thesis over the last couple of weeks is we just don't have, there's too much uncertainty in the market right now with the Delta variant, with infrastructure, and traders are on holiday. So I don't think we're going to see a lot of big decisions being made here. It's easy to get wrapped up in the day-to-day gyrations, hour by hour gyrations here, but I'll focus on earnings, and I'm looking forward to a few of them after the bell today.
And Jared, quickly on the crypto markets, not a lot of reaction in crypto from Gary Gensler's comments yesterday. Obviously, the content of what he said is very important for that space going forward. How did you read that? Because I know you're closely following and thinking about the future of any kind of likely regulatory regime for cryptocurrencies.
Yeah, I'm writing about this today, and my take is it's actually pretty bullish for crypto. He outlined a strategy with a wink and a nod for every Bitcoin ETF fund manager who's filed under the 1933 Act, which is what ETFs typically file under. Well, they're going to have to go under the 1940 Act. And all of this is kind of in the weeds, but he said he wants to have mutual fund protection for Bitcoin ETF investors. That means that all of these companies are going to have to kill their current filings, refile under a new under a novel legal theory, under a different act, and it's going to take a while to get hashed out. But he also said something else that's key. He wants to approve a Bitcoin ETF that's based on CME futures that are tied to Bitcoin instead of physical Bitcoin. If you can imagine what physical Bitcoin is, they would hold it in their account in custody for the ETF. But he said he wants to do it the CME way. And not surprising maybe because he comes from the futures industry. He used to be the top watchdog at the CFTC. But I think this outlines a path forward for a Bitcoin mutual fund, which I find really interesting.
Jared, tweet me that story when it's live. I got your back on the retweet, my friend.
You got it.
All right, Jared Blickery, thanks so much. Coming up, Lyft just hit a major financial milestone. More on what it means to the stock price straight ahead.
All right, welcome back to Yahoo Finance Live. Lyft out last night, reporting better than expected revenues, also reporting adjusted EBITDA profitability for the first time. That coming in about a quarter or two sooner than the street had expected. We see here on the left side of the screen, however, shares now off some 7% in early trading. Joining us now to talk a little bit more about the quarter and the outlook for the business, Ali Mogharabi, senior equity analyst over at Morningstar. Ali, thanks for joining us this morning. Let's just start with your impression when you saw that adjusted EBITDA profitability, which of course has been much talked about with Lyft, and we'll see what happens with Uber this evening. But seeing that number come in, what were your first impressions of that?
Well, yeah, actually, I mean, basically, it was somewhat expected after you initially see that top line growth, which was very impressive. So that revenue, that top line, impressive top line growth creates that operating leverage for these guys. And then on top of that, what we've said historically about Lyft and also Uber is that they have this network effect competitive advantage, which means that as demand increases, more riders come on board. And of course, as more riders available, the time making the request possible, and also to a certain extent, the prices will decline, which attracts additional riders. So what we're also seeing in this case, in terms of helping the adjusted EBITDA, is that the cost of acquisition for the riders is actually decreasing. And we saw that at sales and marketing as a percentage of revenue. So you put those together and, yeah, of course, you see the adjusted EBITDA being positive for the quarter.
Is the reaction today we're seeing in the stock price, Ali, that the market just doesn't believe that Lyft could be sustainably profitable for the rest of the year as the Delta variant spreads, impacts the economy, and perhaps send a lot of folks not into Lyft cars, but back into their homes?
That could be part of it. Also, one of the economic indicators that went out today, the ADP employment numbers, I mean, that was a little bit disappointing. But keep in mind, management did say, or the company did say that in July, not only the supply of drivers was up significantly or continued to increase, but also demand on the rider side continued to increase. And we're talking about July, about a month after Delta variant came out there. So in our opinion, as vaccinations increase, we don't think that the Delta variant is necessarily going to have a significant impact on these guys, as again, the July numbers indicated. So we're pretty comfortable where we're at. We're valuing the company at $63 a share. We still, as we published last night, we still think that we recommend for the investors to wait for a wider margin of safety, and it looks like it's moving towards that. We're probably recommending the stock at around the high 40s, $48, $49 a share. That's where we think that the stock becomes attractive.
And Ollie, what'd you make of management's commentary last night about the wait times that, we've discussed it here on the program. Anecdotally, of course, everyone that can give you a complaint about waiting for a Lyft or an Uber or how much it costs. And were you surprised by how much management kind of discussed those challenges at length? I was sort of bracing for them to say, actually everything's fine. But for them to come out and talk about less than ideal pricing, at least to my mind, was a bit of a surprise.
Yes, it was a surprise to a certain extent. However, again, if you look back for the period to the previous quarters, you actually did notice that on the supply side, or the number of drivers, they were facing shortages, and that's very similar to Uber. So when there are not that many drivers out there, of course, the wait time increases, the prices increase to a certain extent because of that lack of balance between the supply and the demand. So we expected the management to at least point to that, focus on that a little bit. And they did, of course, also mention that they will continue to spend a little bit more to continue to attract the drivers onto that platform to basically balance out the demand and the supply, which, of course, helps decrease prices a little bit, while at the same time increases volume to offset the impact of lower prices. But overall, we actually viewed the earnings results and the earnings call pretty positive.
The Lyft team, and this, Ali, just following the company, they've been on a hardcore cost-cutting campaign really from the fourth quarter of 2019. They have now proven that they can be profitable on pressured volumes. Is the company, have they set the stage to be acquired?
That's a good question. Not sure about that. And the main reason is that, at least in the U.S. market, which is basically where Lyft is participating the most, in the U.S. market, you have pretty much a duopoly, right? The Uber Lyft market share is pretty much a 70-30. And because of that, since there are only two players, we did see price stabilization before the pandemic hit. And likely we will see price stabilization as, of course, the economy continues to return to normalcy, in addition to regular consumer behavior. So from that standpoint, it doesn't seem like there's a reason for Lyft to be preparing itself to be acquired. But that's our initial assumption and review.
All right, we'll leave it there. Ali Mogharabi, Senior Equity Analyst at Morningstar. Ali, thanks so much for jumping on, talk about Lyft this morning. Robinhood? Halted again.
More buyers than sellers.
You got anything here? It's up 65%, $77 per share.
Well, you're seeing the power of the retail trade that has powered GameStop, AMC, now coming home to roost on the Robinhood platform. And it is interesting to see that sentiment turn on a dime. The company IPO'd last week. It looked like the retail traders were not going to be behind this company. Kathy Wood comes out here. She's got a big retail following out there in retail stock trading land. Looks like that she has been the catalyst for this major move. When she went in there and bought, that was the buy signal.
All right, so the company now worth about, Yahoo Finance data says $64 billion, but I can have a lag on a real time. I should have like a little spreadsheet up just to be like, here's the market cap relative to the share price.
I was looking for the Schwab. No, I was looking for the Schwab market cap. Yeah. 126 billion. Almost there.
All we need, team, all we need to do is double the price of Robinhood shares, and then we can be worth as much as
Maybe by Friday. Maybe by Friday.
Yep. By the close. Come on, let's go.
Let's do it. LFG.
All right, Robinhood, the story of the day with stock just doing random things. Stock is currently halted for trade on volatility. That is the third halt so far. Market opened 21 minutes ago. We'll check on that right after this. Brian Sazzi also going to tell us about the summer's other hot trade.
So excited.
Literally the hot trade, the grilling market. You know, those veggie baskets? I got one of those veggie baskets. Super easy to use.
Looks great.
Great accessory for the grill.
Like
Talk
that guy
about
in the
Weber
picture.
coming up right after this. All right, welcome back to Yahoo Finance Live. Today's top story is Robinhood doing whatever it's doing after its recent IPO. But coming up in the coming days, Brian Sazzi in the market, we are expecting Weber to hit the public markets. You've been all over the grilling trade this year. You talked to the executives over at Traeger. We spoke to the My Barbecue guys, CEO earlier this, I guess it was last month because it's August 3rd now.
Yeah.
Only a couple of weeks ago. Weber, what do you got?
Yeah, I'm looking forward to grilling up some analysis here on Weber. When they eventually go public in the coming days, all you had to say it because you just have to do it. I really enjoyed reading their S1. So this is going to be a normal IPO. They file an S1, they come to market, their stock gets bought or it gets sold. A couple things I didn't realize. One, they have the Weber Grill Academy miles where you overseas. You can go there, work closely with grill masters and learn how to grill up a absolutely perfect steak. That is pretty cool. Also, they're the #1 outdoor cooking brand on Amazon. I definitely did not know that. And they also have a 50 million installed base in terms of grills globally. That is a pretty big number of, I would imagine, of loyal customers that have used Weber grills for many, many years. But just like Traeger, Miles, and this might get a giggle out of you, they're pitching them as being a connected cooking platform. Yep. They have their own software. You can cook, you download the app. You can use the app to grill up your absolutely perfect steak here. And that looks to be the next area of growth for them. Are they the Netflix of grills? Traeger promoted them being the Netflix of grills, and maybe they are. And that chart right there is just how fast this brand has grown, really, since it was founded. It's just been up Up and up.
Nothing makes me happier. I saw this yesterday, and I didn't have a chance to comment on it. Nothing makes me happier than the graphics that we do for this segment, including your face on it, just for reasons unknown.
That is me. Yeah.
But I think it's great. So look, everyone is probably like, Guy, can you just shut up about your grill? I got a Genesis too, folks. It's great. It comes with a little logo or decal on it. It's like, download the app. I didn't download the app.
Got it down. You have to.
Okay, but it's not like.
the app.
But like. The fun with the Weber, and look, granted, I'm just doing what a lot of people do, which is this is what my dad did when I was growing up. Here's how he grilled. He stood there, looked at it, and then he was done. So I'm like, oh, that's how you're supposed to grill. A Traeger has all kinds of other stuff where it's giving you the temperature on your phone or whatever. I bought a meat thermometer, and I stand there, and I look at it, and then I close the lid, and then I stare at the trees.
You got to Insta story me that.
Drink the beer, and then I stick the meat thing in, and it's... Oh, 165 for chicken thighs. I guess we're done. Then I take the meat off the grill. And I don't download the Genesis app, but it's still great. I love my Weber.
Fair enough. And to that, this is actually a company that has real numbers here. They're actually making money. For the 6 month ended.
$1.5 billion in revenue.
Yeah, for the 6 month ended March 30th. Sales up 62%, almost $1 billion to your point. Operating profits up 114%. They're making real money, but really, I can't help but to go. Look at that photo. Look at the
I know.
It's like Elf on the Shelf.
It
but
is.
worth noting, that I was reflecting on my life a bit going through this S1, and I remember the 1985 Weber Genesis. They have a picture of it on there inside of the S1. Grilling up some really bad London broil as a kid. I mean, I was using the grill when I was 5 or 6 years old, and if I didn't cook a good thing of meat, it was not a good day for me. Dad really, he put me to the pavement.
So one also subjected to way too much $1.99 London broil when I was growing up. I mean, it's terrible.
Does anybody eat that
terrible
anymore?
Meat. I don't know.
You see it in the store, it's like 5 inches thick. It's really bad.
There's like a nice meat place, kind of like 15 minutes from my house. Their London broils, which I had them once, that's actually good, but it's like the filet. It's like a ShopRite equivalent of a filet mignon if you get a London broil at this place. Anyway, that Weber 85, the Genesis, my parents got one. I think they got it as a wedding present in '88, and that thing was in the backyard for years, like 15 years.
Rusted propane tank, rusted out, grease drippings on the floor. It didn't matter.
You put the little coverall on it. I keep mine in the garage. But you got to put the thing on it so it doesn't get rained on.
True story before I let you go. I remember vividly.
Oh, you're letting me go. Okay.
Maybe when I was 7 or 8 years old.
Bad news. We're both here for the next hour.
Yeah, dropping a London broil on the ground. I was grounded for a week. It was a really bad day for me, and I will never forget that.
Like, did you drop it unintentionally?
I don't want to start crying right now.
I know, but why would you get grounded for a week if you accidentally dropped a London
broil? That's how things went in the Sazi household. It was a different time. Those are the 80s, man.
You made it.
Yeah, I guess.
You made it.
Sure.
That was before my time. Like being involved in the grill.
I'm emotionally sharing with our audience. Now, I hope you're connected with me. I mean, if you have similar stories, tweet them at me. I'm very curious.
Sazi, you told us you were reflecting on your life reading the Weber S1.
That's
That's like what novels are for. For you, it's a securities filing.
It's been a very sad life,
Weber
Miles.
Grills. All right, can we check Robinhood here? I think we have the elements up. Stock has opened for trade. Last time that I checked, it was up about 50 some odd percent. 41% right now. 66.50.
It's a lot of London broil.
Of Robinhood. You could buy a lot of London
broil.
All right, coming up, a lot more here on the other side of this break. We're going to talk more about that Clorox result from yesterday. We'll touch on the morning brief. Robinhood shares up 41%, about a half hour into the trading session.
Welcome back to Yahoo Finance Live on this Wednesday morning. I'm Brian Sazi, joined, of course, by Miles Udland. Julie Hyman is still on assignment. Let's get a look at the market real quickly. We're seeing some mixed market action on this Wednesday morning. The Dow is in the red, the S&P 500 in the red, and the Nasdaq bucking that trend. It is in the green right now. Here are three things we are watching closely right now in these markets. A strong bid, to say the very least, remains under Robinhood. The stock surged 24% on Tuesday and is up another close to 65% so far this morning. As it appears retail traders are kicking the tires. The stock has been halted 3 times so far on the session. Lyft shares are on the move after the ride-sharing giant reached profitability for the first time. Now all eyes turn to Uber's earnings after the close today. And we have an exclusive chat with Apollo Global Management's co-president, Jim Zelter. The company announced a solid second quarter this morning, as well as a big new deal in the telecom space. But of course, we're going to start right now with the Morning Brief newsletter. And Miles, you remained locked and loaded really on that bad quarter out of Clorox.
Yeah, it was a tough quarter for Clorox specifically, but I think the lesson that I took away, and there's a couple of different lessons that one could take away if they so choose to take away lessons from the likes of a Clorox earnings call. But to me, it's that the pandemic craze around wiping down every surface, and we see this in our normal course of our lives, but the disinfectant craze, let's call it, and granted Clorox has a broader portfolio than that, but the namesake product is, of course, cleaning stuff off. That is over. That phase of the pandemic is over. You can now go into a store and you can get as much Clorox product as you want, give or take. And I think what's interesting about looking at the stock and the company's trajectory holistically is it also gets to another theme that we've talked about on the program, that we've thought about, that I think we're going to continue to stay on in probably the years plus ahead, which is what trends from the pandemic, what trends that were forced upon us by COVID are going to stick around. And if you look at the share price action in Clorox, the market is saying, after it seemed for a time that this was a new trajectory for the business, that's actually not going to be the case longer term. Clorox shares right now are trading at almost exactly the same price that the stock traded at in March of 2020. Now, the premium that investors are, what investors are assigning, the value investors are assigning the company has actually gone up a little bit in that time. Company yesterday guiding to a midpoint of full year adjusted profits of $5.55 per share. Back in February of 2020, the company was expecting to earn around $6.18 per share. So we can do the quick math, a couple turns on the valuation there. So it's not like investors necessarily value the company at so much less than they did pre-pandemic, but there are now questions around what is Clorox. And I think in the coming quarters, those are going to return in a more pointed way, whereas for several quarters over the last year, it's been, oh, well, it's a pandemic play. Oh, it's benefiting from people being at home more. They were asked about the trash bag business, which has slowed down because people go back to the office, so they fill up their own trash bags, less frequently, so on and so forth. So I think a lot of lessons here, but really, when you go down the line, which companies, quote unquote, benefited from COVID, we are going to see which ones don't stick around. And I think the disinfectant craze would seem to be one that is not likely to have a lasting impact.
One thing that may not stick around for Clorox, the Renew Life business. It's a vitamin business. It's a competitive business. They acquired it several years ago at a very peak multiple. And I do suspect it could be a quick win for Clorox and new CEO Linda Rendell if they sell that business and save some expense here. It's not a priority for them.
And that's another pandemic craze, too. I mean, how many people did you hear about, because okay, we did the whole hydroxychloroquine thing. I mean, vitamin D is a major part of beefing up one's immune system, and I think there was a major vitamin push from a lot of people when they were at home during the pandemic, wanting to be healthier. And so you mentioned that part of the business as well under some pressure. And we've talked, Sazi, on this program about a couple of tough earnings calls that we've seen management teams face. Tough one yesterday. It was tough.
You know what's not tough? I have a new product for you. I hear you're getting a new dishwasher, Microband 24 from P&G. You spray it on, it puts a force field over your products, and it prevents bacteria from getting through.
Well, this is a brand new dishwasher. Presumably, it's already clean.
No, it's not.
Our dishwasher guy told us you just got to make sure you use the pods. But back to the call quickly, though, just something that one analyst, I believe it was an analyst over at Citi, said in her preamble to the question was something along the lines of, I've been covering this company for 20 years and I've never heard of a margin guide quite like this, or something to that effect. And you don't want to be told by an analyst covering your company that they've been covering it for that long, because they're basically telling you What are we doing here?
Well, that analyst is not going to get their quarterly meeting. Let's just say
No,
that.
I think they will. The stock was down it's a consumer staple, and stock goes down 9% in a single day. There's really nothing, and that's another point I made. I tried to make, it's a brief piece, but as a management team in that position, all you do is take your medicine.
Yep.
You go out, you put out a bad quarter, you get through the call, and I think you've got a couple of really important quarters coming up here if you're Clorox.
Go out and get a drink after. All right, staying on this subject, to another degree, the markets continue to be anxious over the latest trends on the COVID-19 front. Yahoo Finance senior healthcare reporter Anjali Kamani is here with the latest. Anjali.
Thanks, Brian. News out of the World Health Organization today where the Director General, Dr. Tedros, announcing that he's calling on the world to basically have a moratorium on boosters. So the wealthier countries that are already starting to weigh that question, we've already seen that start in Israel. Today, in a press briefing, he said the following. He is calling on anyone with influence who can really prioritize COVAX, which is, of course, that program that the World Health Organization is working on to help distribute vaccines, and everyone, as well as the manufacturers themselves, to help put more emphasis into that program, as well as hold off on the boosters until the end of September at the least. And that's, of course, because right now, the World Health Organization has set a deadline of the end of September for 10% of the global population to be vaccinated, and they're nowhere near reaching that right now. And they're hoping, of course, to reach also 40% of the global population by December, which, based on the uptake in wealthier countries, it leaves very little room for vaccines to be used in middle and low income countries right now. So really interesting call there from the World Health Organization. September also going to be an interesting month here in the US, as the FDA is weighing full authorization for the Pfizer-BioNTech vaccine. And that's going to be an interesting call. As we know right now, vaccine mandates are starting to make their way through private companies. We saw New York yesterday announce a proof of vaccination in order to enjoy indoor spaces like gyms, restaurants, as well as event venues. So a lot of that coming to light, and the need for really the legal route, as some have said, for that vaccine authorization to come through. The New York Times reported that the FDA is looking at before Labor Day, so it could come in the next couple of weeks, but the end of September is really the sort of unofficial deadline that the FDA has set for itself. Back to you guys.
The COVID challenges certainly continue. Anjali Kamani, thanks so much. Coming up, we have an exclusive chat with Apollo Global Management's co-president, Jim Zelter, fresh off a very solid second quarter. Do stay tuned for that. Solid second quarter out this morning from Apollo Global Management. The alternative asset manager saw record fee-related earnings and strength in its key credit business. Apollo also continues its year of aggressive deal-making, announcing a $7.5 billion deal for a large chunk of assets from telecom Lumen Technologies. I spoke to Apollo Global Management co-president and CIO Jim Zelter earlier today. Take a listen.
It was a terrific quarter. I think if you look at our full announcement and the report, you'll see that not only do we execute across the business in terms of very, very strong returns, exceptional deployment, and exceptional fundraising from all of our channels, a lot of strategic transactions were done in the quarter. We grew some origination platforms with our purchase and our involvement with Victory Park. And at the firm level, what we're doing in terms of Motive, in terms of fintech partnership, really growing that front end and really bringing technology throughout the whole firm. What we're doing with Foundation Homes over in the UK in terms of buy-to-let financing. So really on the execution front, great strides. And on the strategy front, growth and very thoughtful use of our balance sheet for acquisitions. So really a two-pronged attack on the opportunity in the marketplace.
Where are you finding opportunities right now? And I ask that because valuations are at record highs, but seemingly once a week or multiple times a week, Apollo's out there making pretty big deals.
Well, you're right. And I think that we have been able to find areas. I mean, certainly if you look at the marketplace, valuations are quite strong, but the economy's strong. It's not a surprise. The economic numbers that are coming through are quite strong. But what we've done is we've just gone back to our original game plan, and even the transaction we announced yesterday with Lumen Technologies, really using our skills of corporate carve-outs and structuring to do it in a way that's going to help build and rebuild the digital divide in America. So Lumen, the old CenturyLink, we bought a carve-out of 6.5 million customers across the Midwest and the East and the Southeast. It will really enable us to put a lot of CapEx in that business and take it from a old copper business to a digital fiber network today. So using our skills in that, obviously our pending acquisition of Yahoo Finance we're quite excited about, but then a variety of other acquisitions in the quarter that we found. So again, using the time-tested strategy of value, complexity, corporate carve-outs, and being thoughtful about how we position our company towards value but growth, which we've been able to find a path to do so.
And since you mentioned it, it should be noted that Apollo Global Management is in the process of acquiring Verizon Media, which is Yahoo Finance's parent company. Jim, since you mentioned it, is that deal still on track to close soon?
Very much so. Very much so. Looking forward to it. Tremendous workings between two organizations. But yes, all in line and all on pace as projected.
What's your vision for those series of assets?
Well, we have a variety. Certainly those assets in particular are in our private equity business, which has really been the traditional hallmark of the firm and really embeds in our DNA. But certainly we believe that those are tremendous assets in terms of the legacy brand, the legacy identity, and infusing CapEx, infusing management with the existing team, but also some new folks. We believe we can create a tremendous amount of value for our investors, which are the pension funds and endowments of America and around the globe. So a time-tested strategy. We're confident that when you buy landmark assets like that, that the performance will come through. So that's just one of many. Certainly we're very active in the whole home building and what's going on with the building of homes in America, but also the financing of homes in America. The whole household formation, that's a big theme for us these days. Certainly the whole digital in terms of not only what we've done yesterday with Lumen, but First Digital in terms of really creating more of an infrastructure in the West on that area. So from our perspective, the ability for us to find areas of growth. Yes, the economy is growing. Yes, technology is taking a bigger part of our overall economy, but we're doing it with the Apollo playbook in hand. And also, I would also mention what we did with Motive. That was not only to help us identify and think about investments in the fintech space for our funds, but really embed financial technology throughout the firm and everything we do. Apollo is a great financial services investor. We have for a couple of decades, 3 decades. But at the same time, we need to make sure that we understand what's going on with the democratization of finance, how the markets are changing. And so by doing what we did with Motive in terms of that strategic JV, really in terms of our fundraising, our product creation, our distribution, but also our insurance businesses and our regular credit businesses, we believe there's a lot that they can add to our playbook and our toolbox.
Jim, is Apollo still long the economic recovery? I'm sure you've seen the stories, hopefully on Yahoo Finance, peak economic growth, earnings growth starting to slow down a little bit in the back half of the year. Lots of concerns about the Delta variant and its impact on the economy. How do you see it?
Well, we are along the U.S. and we are along global corporate business and the consumer. In the U.S., I'll just add it was a exceptional quarter for the economy. The macro data continues to improve, and if you look at where the consumer is, it's in strong shape. So, the big question in the macro right now is the 7 million jobs, and the Fed has convinced folks that they have a view that this is really a temporary inflation blip to the economy. But we are long the U.S. and we are long the consumer, and we feel very good about the high quality businesses that we have backed and have invested in equity and in debt across our platform.
Apollo is getting ready to launch a new fund in 2022. Tell us about that.
Well, certainly on the back of what we announced yesterday in terms of our flagship fund 9, a $25 billion fund, with the acquisition yesterday, which we announced of Lumen, that is going to put us around 73% committed or invested. And that's a number that we would think that lead us to believe that in the first half of 2022, we will be, launching Fund 10 to our institutional investors, and don't have a specific date, but in the first part of the year.
Fair enough. And lastly, before we let you go, Apollo has played a big role in many SPACs that have come to market. How do you see that market evolving over the next 12 months?
Well, you're right. We have found ourselves to be a key player in being a sponsor, being a provider of capital on the equity side, and also, selling businesses to SPACs as well. So in the complex ecosystem, we've had a seat at every table. It's going to continue to refine. It's going to continue to evolve. It is a tool for the future, no doubt. And from our perspective, our ability to be able to add value at each point along the ecosystem, I continue to believe we'll still sell companies to SPACs. I believe we'll still provide, pipe capital and equity capital and debt capital to competitor SPACs. But there will be a shakeout, and as there has been going on in the last couple of months amongst the pipe market and the equity side. But in the refinement and the evolution of that product, we will continue to be a significant player.
Straight ahead, a retail legend graces our airways. Mickey Drexler stops by for a chat on the future of retail. You won't want to miss this one.
All right, let's take a quick look here at some of today's other top business headlines. The Biden administration announced a new 60-day eviction moratorium on Tuesday that will now run through October the 3rd. The new rules will apply in areas that have, quote, substantial or high levels of COVID transmission, which is expected to cover more than 80% of counties in the U.S. And of course, we must have our daily check-in on the track and field action at the Tokyo Olympics. 21-year-old American Sydney McLaughlin set a world record last night, taking the gold medal in the women's 400-meter hurdles. Dalilah Muhammad, American, in second place in that race as well. And elsewhere in the world of sports, Spain's top soccer association, La Liga, said Wednesday that it had agreed to a deal in principle with private equity firm CVC that would inject some 2.7 billion euros into the coffers of the firm's clubs, which include Real Madrid and Barcelona. The deal values La Liga at just over 24 billion euros. All right, let's take a quick break here. On the other side, we're going to have a lot more on this Wednesday.
Maybe.
It's Wednesday? It's Wednesday. Robinhood shares, what are they doing? Stocks up, 30%, 40%? Who could really say? We saw shares halted at least 3 times. Stock traded as high as 77. Saw it there. Of course, company went public in its debut last week. We'll have a lot more on everything coming up in the markets here right after this.
Mickey Drexler is credited with turning around some of the most well-known retailers in the game as CEO. You probably heard of them, Gap and J. Crew. Now Drexler is back at the helm, leading specialty apparel retailer Alex Mill. The brand was co-founded by Mickey's son Alex Drexler in 2012. Joining us now for a look into the current state of retail is, in fact, Mickey Drexler. Mickey, good to speak with you here. So you're back at the top of the helm. You're back in the retail game, leading Alex Mill. Tell us a little bit about the brand and how it's been doing during the pandemic.
Well, we're doing actually quite well. We're a brand that's been around, run by my son for 6 years or so, as you mentioned. Pandemic kind of hurt all of us to a degree. We're fortunate that we only have one store. So with one store and online as a business, the business has been quite good. And I'm very happy with where we are and mostly with where we're going. The pandemic, we're going to open up our second store here on Madison Avenue. But we have a really cool store in Soho on Broadway and Mercer Street, 2 entrances. So, but we're doing okay.
What is it like working with your son so closely during the pandemic to try to build this brand?
Well, not easy, pandemic or not. But we finally reached a father-son agreement. And I was probably treating Alex more like, I want to say employee or an associate. He's my son. And I did learn that son comes first and then employee, or I don't like the word employee, associate and partner comes second. So but it's not been easy, but now it's been so much better. And then we have a third, Samsak, who is our third co-founder, who worked with me for over 15 years in my old companies. So, but it's okay. We're getting along well, and we're moving forward.
And Mickey, I'm curious how you're seeing, apparel trends right now. We've talked a lot on this program about, big public companies, big public retailers have seen a surge in their sales as people have started to reemerge back, into the world. What are people wearing now? What do you think people will be wearing on the other side of this? Will it be dramatically different from what was prevailing pre-pandemic?
Well, the pandemic, for all of us, we were up against like a snowstorm every day for an entire year. The real world will begin again in February of 2022 when we're up against normal figures. Everyone's comparing themselves to 19. Everyone's quite happy right now. I'm not in one of the big people I used to be in terms of business, so it's hard to know. But I think clearly there'll be less sweats. In fact, unfortunately, we ordered our last order of sweats without figuring out that they would drop dramatically, and they have. So if anyone needs a sweatshirt, we have plenty of them. But I think people are going to get back to being normal in their dressing. I think clearly there won't be as much dress up, but khakis, jeans, back to the more uniform kind of dressing. And not wear anything because you're at home. Although a lot of people are still home with a Zoom. So I think dressing up, we're looking at more suitings for men and women, but very, very casual suitings. And for us, mostly we look at good taste and good style, which is really important, of course. So, but I don't think, I'm not sure, but I think online will continue. Companies are going to have less stores because they don't need as many stores. And there'll always be a business, but I think the best are going to win always. The ones who are good at what they do, style-wise, value-wise, and nothing in that changes long-term, in my opinion. What role do stores play in the post-pandemic retail sector? Well, I think all of us went to store crazy worldwide. I think there's nothing like going into a store to get a sense of the business and the brand. So where companies opened up, I'll make up a figure, 250 stores, they probably need 100, maybe 125 stores today. That's a guess. No one will know until time passes in that regard. I do think, and I think if a shopping center or a mall or a street is compelling to visit, I think those are the winners in the business. A+ shopping centers I still think will do well. I wouldn't want to be in the C or D shopping mall business today. And you just don't need as many stores as they used to have. You never did, by the way, because the amount of markdowns that are taken and discounting that goes on is beyond wild, always.
And thinking about the e-commerce, piece of it, Mickey, I'm curious what you make of, a lot of, the Walmarts, the Targets. They're all trying to open up to third parties as well. Everyone wants to be an Amazon of sorts, and I'm wondering if it makes the opportunity, more compelling or more straightforward for an independent retailer to, own and operate their own site, because that behavior is now ingrained in consumers that you go online first to really look for something.
Well, I think they'll always, it depends on what kind of brand or retailer you're talking about. We right now wouldn't join any of them. It would be great for 1 week or 2 weeks maybe of, wow, look at the amount of people. But at the end of the day, Walmart and Target, great businesses, by the way, they're value businesses. So for us, it doesn't work. But I think for most other value players, look, there's value, and then there's, I think, overpriced. And then there are businesses like ours that are very fair priced and don't take double markups. So I think it's smart to do it. I'm an Amazon family, but I get Walmart delivered to my home also. I'm not sure what's in the Walmart packages. I think a lot of it's the same in Amazon's packages. But we won't be there as a high taste fashion company for sure.
Well, no offense to Walmart, Mickey. I hope it's not Walmart apparel. That stuff is just not cutting it. They have not cracked the code on that, and they probably never will.
Well, I think you're right. And I spent a day there a year or 2 years ago, and Target's pretty cool now, and Walmart hasn't cracked it yet. You're absolutely right. And by the way, if they ever do, they'll be dangerous, but they don't. And that's why we started, when I started Old Navy many years ago, I can't believe it's 25 years ago, I was inspired by Target and Walmart, and Old Navy's, been a success, hugely successful. For those people, every business is tiny, but I don't like that big anyway. Old Navy was an amazing and is an amazing business. Good value, fun, and style.
Mm-hmm. So Mickey, bear with me on this. So I've been following the Kanye West product drops pretty closely here. Not much has been released yet. Pretty cool round jackets, 2 different colors. But then I go into a Gap store and I still feel that disconnect. There is the Kanye stuff and the non-cool stuff in the Gap store. Do you think that eventually changes for Gap at some point because of his influence?
Well, I probably shouldn't say this, but I told him he shouldn't do the deal because it doesn't make any sense. My opinion, and my friends, I have a lot of friends at Gap still, but it doesn't work for someone like Kanye. He's not a corporate person, and Gap's a big corporation. And so I know the jacket sold out. They did $7 million on the one jacket overnight. No zipper, no nothing. I mean, try to be warm with no zipper. But
I need the zipper.
They left out the zipper. But he's a smart guy, but he should have done it. And I don't think they should have done it either. And I hope my friend Mark's not mad at me. We'll see what happens. It's very, very hard culturally to do what he's trying to do. So see what happens.
Mickey, speaking of Kanye, it makes me think of course, the Yeezy shoes and the sneaker craze that we've really seen in the last several years. I found myself, as a millennial man living in a city, thinking I should care a lot about my sneakers in the time before the pandemic. And when I go on Alex Mill, I see things that will actually last over time. I look at some sneakers I bought in 2018. They look ridiculous now. What do you make of the streetwear craze that we've seen, StockX, Goat, these other platforms, and where that fits into men's fashion today?
Well, I can't ever argue with what customers like. It might not be right for us. We have a sneaker. It's actually my biggest, this is silly, my biggest frustration. We have a sneaker called Babouk, B-A-A-B-U-K. I found it 3 or 4 years ago. I went to Switzerland to visit with the owners of this tiny little company. We redesigned the sneaker. A few of us here wear it every day of our life, but we're not Nike, we're not Adidas, we're not New Balance, and it's very hard. What I think of them is, again, it's personal or business. I think it's wonderful for business. Personally, I don't, I'm not into it, so I don't understand. I understand it, but what do I think of it? It's just a way to look new and not look like everyone else. And I don't really get it the way.
I can't help myself here. I've listened to a lot of your earnings calls through the years at J. Crew and at Gap way back in the day. What's your holiday season outlook?
Was it what, holiday?
Yeah, what's your holiday season outlook? Is it just going to be gangbusters?
Well, I think for us, it's really nice to be small-ish. I love the way our goods look. And I say that objectively. We're a tiny little, we're not tiny and little anymore, we're getting bigger. But it's not about holiday. It never was for me about the outlook. It's always about how good are you at what you do? How good are your goods? And so the holiday outlook, this holiday will be great for everyone because we're up against the pandemic. It has to be great. And then the real world will start again. Everyone's so happy out there now, but just let's wait to see what normal looks like again and how it is to be up against normal.
Before we let you go, Mickey, what is your favorite piece from your collection at Alex Mill?
Well, my favorite are the jumpsuits because that's for women mostly. We just started carrying guys. You always have to say your favorite is the one you can't keep in stock to a degree. I have personal favorites, but it might be we have some very cool chinos, but that's personal. And I only wear Alex Mill. This jacket, by the way, nylon and cotton. You're going to see a lot of this on. And our sweaters, I think, are incredible. But I sound like a retailer,
Guys, jumpsuits. I've never seen one of those, but maybe Miles Unland, maybe you and I. I see them right now on the website. That's interesting stuff.
I got to join the wait list, though.
You call me, I'll get you. They sold
Face know the right people. Miles Unland with his first jumpsuit.
I got a 40 chest, 34 waist. So is that a large or medium, Mickey?
It all started because of a person on TV said, I want a jumpsuit. We made him a jumpsuit, and then we ordered a whole bunch, and it blew out. I'm just going to do it quick. I wish I could find it. Well, I'm on here. Here. Here it is.
Oh, that is right. That is for Miles. That's perfect. Yeah. That's a Robin Hood trading outfit right there. That's wonderful.
Yeah, I think maybe I'm right on. I need a Marge.
Well, Marge. I'll give you Mickey's email after this. We'll get it done. We'll leave it there. We could stay and talk to you all day. Mickey Drexler, it's good to see you. Thank you for the time today. Good luck at Alex Mill. We'll talk to you soon.
Appreciate it. Bye-bye.
All right, coming up, Activision shares are moving after the company reported earnings, and they're still dealing with a lot of internal problems at that company. We'll have more on that one right after the break.
All right, Activision Blizzard shares are in focus today. Company up, seeing its shares rather up about 2% after the company last night reported its latest earnings report. But of course, the backdrop to this earnings report, ongoing harassment allegations by former employees, and the company talked at length about that issue within its ranks on its earnings call. Yahoo Finance tech editor Dan Howley joins us now to talk us through everything going on with Activision Blizzard here. So Howley, let's start with the numbers. And I think important to note here on the back of Take-Two with a bit of a disappointment earlier this week, a little bit more constructive for the game industry.
Yeah, Take-Two just kind of bombed their earnings, especially with the forecast for the coming quarter. Activision Blizzard, on the other hand, did great. They beat expectations. $1.92 billion for the quarter versus $1.89 billion was expected. 91 cents per share versus 75 cents per share. That's for this quarter. In the coming quarter, they're outpacing analyst expectations. They're looking at the $1.85 billion versus analyst expectations of $1.79 billion for the quarter. Earnings per share a little lower than what analysts were expecting for the coming quarter. And yeah, their stock price went through the roof, but really, this is overshadowed, as you alluded to, by this ongoing harassment and discrimination kind of issue that they're dealing with. They're being sued by the state of California because of that. Now there's a shareholder lawsuit against them claiming that the company didn't inform them of the investigations that were going on into this. The day they announced their earnings yesterday, the president of Blizzard actually stepped down. That's J. Allen Brack. And then later in the day, the head of PR for the company stepped down. J. Allen Brack is going to be replaced by two people now who would be the co-leads of Blizzard. Blizzard, of course, is the arm of Activision Blizzard that makes games like Diablo, World of Warcraft. Activision is where you get your Call of Duties, things like that. They, though, continue to do well as far as mobile goes. King, their mobile brand, continues to do well. Call of Duty is basically just printing money for them now, though there are some complaints among gamers about hackers in there. That could sour them over time. We don't know, but for now, it continues to do well. And the Blizzard brand is still chugging along. So the fundamentals are there for the company, but the initial response, at least, to the initial suit from the company was, as CEO Bobby Kotick said, tone deaf. They basically dismissed it out of hand and said that this is something from years ago. Clearly, that's not the case with these people now stepping down. There was the employee walkout where we saw employees work out physically and virtually on their jobs. Obviously, not everyone is back into the office, so they were doing it virtually as well. Employees were coming forward with their own stories of harassment. So this is going to be something that I think overhangs the company for some time. And it is kind of an issue that the gaming industry in general needs to deal with. Obviously, we had heard Riot Games. It was an issue there. Ubisoft, another huge publisher, was an issue there. They saw 5 executives step down. So it seems like it's time for these companies to finally clear house of these executives or these employees that aren't behaving properly.
Yeah, Jen O'Neill and Mike Ibarra now stepping in to be the co-leads over at Blizzard. And Howley, just to kind of circle back, because again, there's 2 tracks to this story, but I'm struck on the earnings call. Matt Costa over at Morgan Stanley, the first question was about the headlines around corporate culture. It is very infrequent that you see Wall Street analysts asking about news stories and not asking about the minutia of margin guidance. And one wonders how long the road ahead is, I think, for Activision Blizzard management, let's be clear, the combined company, to kind of put this issue behind them, or it's really not going to move behind them, right? This is something that I think this management team is now it's going to define their time with the company.
Yeah, and I think it's important because when you look at these kinds of companies, these games are made by the developers, right? These are the people that they want to attract. And if the corporate culture there is so toxic that it pushes them away or it makes people think twice about joining the ranks of these companies, then that will ultimately hurt their bottom line. So, you're right. You get on these earnings call and it really is just kind of the dull, let's go over the numbers kind of thing. Nobody asks the really interesting questions. But to hear questions about the management shows that investors recognize how much of an issue that can be for companies like this. And that's why they're really going to have to really kind of tamp down on it.
All right, Yahoo Finance's Dan Halley with the latest going on over at Activision Blizzard. All right, coming up on the other side of this break, Jared Blickery stopping by to talk a little bit about what we're seeing in Robinhood today. Stock up some 30%. Sazi, it's been trading now for about an hour continuously, so that's a start. After
Someone's buying the rip.
3 halts earlier in the day, the stock has been open for an hour. Back with more on that after this. All right, welcome back to Yahoo Finance Live on this Wednesday morning. Let's take a look at shares of Robinhood. Everyone's having fun. Everyone's having fun. Stock's up 35% today. Stock is up 20%. Couple of days yesterday, up 20 some odd percent. First time since March 2020, I'm at this desk with Yahoo Finance's Jared Blickery. Jared, welcome back.
Oh, thank you.
Good to see you.
I'd like to switch venues as much as possible.
That's right. Jared Blickery, did you take the scooter or the subway from the
I took a car today. I got down to the subway, 10-minute wait. No, I dialed my Uber.
Man is busy. All right, so Robinhood, we see the stock, I guess, kind of becoming a meme in real time, which should it be that surprising that the meme venue is now publicly traded and thus becomes memed of sorts?
It's meta. I'm not going to lie. You know, and
that's what Vlad said.
Did he?
He did.
That's pretty incredible. Yeah, I keep joking. I can't wait until we get the YHOO ticker. I think we're going to be an OG meme stock from the beginning.
Oh, that's right.
But back to Robinhood. Let's take a look at the Wi-Fi Interactive. I'm looking at the price action here. This is today, and as you said, it's been halted 2 or 3 times. And if you take a look on an intraday basis, what it's done. Look at that chart right there. That's just incredible. This looks like a short squeeze, but how could that be possible?
Could it be? That's right.
Who could be short? How many people could be short? Market makers could. Just a little background in market making here. This was explained to me by an actual market maker before computers. So this was 20, 25 years ago in the Nasdaq, but they make their most of their money, just bread and butter money, by basically scalping. They're taking the opposite side of positions. They're making markets, making sure there's liquidity. But then if they get up to a certain level that they like, if the stock rises or if it falls, they might buy it or they might sell it, and then they might hold that position for a few hours, a day, not typically beyond that.
And, you know, something else here with obviously there's not a lot of liquidity in the stock, right? You don't see stocks move like that unless there's just, you can't make markets given the size of the demand. And Ben Carlson over at Ritholtz Wealth Management wrote a post. You know, he jumped on the grenade. He said he got his allocation of Robinhood shares last week. Then he sold it the next day. Everyone go ahead, make fun of Ben. But he made a point in there. When he went to sell, Robinhood gave him a notification within the app that said, if you sell your shares within 30 days of having gotten the IPO allocation, you will not be able to get an IPO allocation for 60 days. So basically what I'm seeing in that is there are a lot of customers on Robinhood's platform who likely got filled, who are now kind of unable to sell, like they can sell their shares, but it would seem that for an illiquid issue already, there's even a little bit of marginal liquidity pulled out of the market, given that Robinhood customers who received IPO shares are incentivized to not sell those shares for another 4 weeks.
Well, Robinhood hodlers, and that's what they are. They're supposed to hold. They're not supposed to sell. This is how IPOs work. This is really not that different from any other IPO, except for the fact that the customers got a larger allocation. So usually the institutions, they hand these things out to their friends, and they say, you can't sell these for 6 months. Forget 30 days, 6 months. Yeah. So in this particular case, I see this as a potentially better liquidity scenario because they have the option and they can sell now if they want to, or they can sell in 30 days.
Jared, are you crypto mining on that computer?
Yes,
I mean, this thing is bad. I mean, this is rad. Look at these. It's just unbelievable. It's powerful stuff, Jared. Oh my God.
The liquidity is so good, the stock's up 30.
I'm providing liquidity right here.
Seriously,
that's what I'm doing.
Computer. Liquidity is so good in Robinhood.
You want to see what happens when I close this?
There it goes.
Halted.
I'm receiving word that Jared Blickery will be at the top of the 11 o'clock program, which is coming up in just 2.5 minutes. So Jared needs to run. Me and Brian Sazzi, we're done. We're going to go to Sweet Green now. Zach Guzman and Kiko Fujita have you on the other side of this break for the next couple of hours here on Yahoo Finance Live.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman, and we are seeing a bit of a split picture here. 90 minutes into the trading day, the Nasdaq just turning positive right now, but it is trading pretty flat. The Dow now down about 277 points, and the S&P 500 down 18. Stocks weighed down by disappointing jobs data with the ADP private payroll survey showing just 330,000 new jobs added in July. That is nearly half the estimate analysts were expecting. Vaccine mandates gaining steam. New York City becomes the first in the country to mandate jabs for indoor dining. Los Angeles looking to potentially follow suit. We're going to be talking to LA City Attorney about his push to protect residents there, and the Chinese crackdown rattling American investors as regulators on both sides of the Pacific look to clamp down on some of the biggest Chinese players. We're going to be talking to Muddy Waters founder Carson Block about the biggest risks he sees ahead. But we are beginning with the market action today with Yahoo Finance's Jared Blickery standing by with the very latest moves. And Jared, we have to start with Robinhood. That stock is up more than 30% in the session. What's going on?
Yeah, forget about those ADP payroll numbers. I'm checking out Robinhood here. So let's go to the Wi-Fi Interactive, and I'm seeing something pretty interesting. First, what you're going to notice is this stock is up 34%, but it had been up quite a bit more. Sorry for that circle there. I'm going to show you the intraday price action, and we opened. First of all, we got above that IPO price yesterday. That was $38 per share. Got all the way up to about 80 here, and now we're back at 60. So is it any surprise that Robinhood is now trading like a meme stock? In fact, it is, and I'm not that surprised myself. Here's the 5-day price action. So we got kind of liftoff yesterday. This looked much more dramatic when it happened because all of this is obscured by this price action right here. Now, I was just talking about this with Miles and Sazi literally 10 minutes ago, and a couple comments here on the allocation. So Miles brought up the point that if you bought this and if you were let in at the IPO price, because we know that Robinhood allocated about 30% of the IPO to their customers, which I applauded, you really can't sell that for 30 days. So they're a little bit locked in here. They can sell if they want to, but then they're not going to get another allocation of future IPOs. So who's buying and selling here? This looks like a short squeeze, but it's pretty much guaranteed to not be a short squeeze because we don't have shorts in this issue yet. So this is really interesting to watch. You know, the way these meme stocks have traded before, you get one of these big spikes, comes down a bit, finds a bit of a base, and then you launch later on. So the consolidation period here is going to be pretty important to watch. $45 to $50, that's a level way down here. And I check out the opening price here, but it's a little bit too early to say where we should expect to find support, especially since the stock has only been trading, 5 days now?
Yeah, and Jared, too, I mean, when we look at, you mentioned the retail allocation, there's also been some institutional names, Kathy Wood, ARK Invest, one of those names that jumped into Robinhood here in yesterday's session. Options are also something that people are pointing to when we think about volatility for the name, early options action. Obviously, you know, it takes a little while for options action to kick off in stocks like these, but some people are pointing to that $70 calls that expire August 20th that could be adding some volatility to the swings we're seeing, given that's only a couple weeks away in terms of expiration. I mean, how much does that maybe add into what we're seeing play out here?
Yeah, that's an excellent point because the call buying, and I'll just get into the mechanics, not into the weeds here, but the way that works, if you buy a call in a stock, that's basically a levered bet because you put down a certain amount of money and then you control a larger amount of stock. So with that leverage, that gives you more power. Now, somebody, a market maker, is taking the opposite end of that trade, and they have to hedge their bets. And one of the ways they do that is by buying the underlying stock. And so that just kind of feeds on itself, and it creates this feedback mechanism. Now, if the stock gets too high, market makers can then decide to short. They can naked short if they want to. Could be the case here, push the price down back to some potential support area. But also, separately, you mentioned Kathy Wood getting into this. I think that's notable. She got into Coinbase, I think on day 1 or day 2, kind of fits in with her investment strategy of looking for disruptions. But the exchange business overall has been very good, and that's thanks to higher trading volumes and what have you. The Nasdaq exchange itself, which trades under the ticker NDAQ, was making record highs earlier this year. So the options market is definitely contributing to some of the volatility here, and also the fact that this is a brand new meme stock. So I'm excited.
We're already calling it a meme stock. I think you called it a meme stock on day one, but we're going to continue to watch that action there. Let's turn our attention to some other trending tickers here. And Zach, it's talking about the moves in the market today. A lot of that weighed down by what investors have taken to mean disappointing earnings here. Let's start with Lyft because we're seeing a big slide on that stock, despite the ride-hailing company beating on the top and bottom lines. The company did lose about 5 cents a share in the second quarter. Revenue, though, jumped about 125% year on year. Of course, last year was a really slow time at the same period. If you compare it by quarter on quarter, it was about a 26% jump there. Lyft issuing guidance, expecting revenue between $850 and $860 million. Some notable improvements here in terms of the number of active riders that jumped up just over 3.5 million from the previous quarter, but it's still about 4 million shy of pre-pandemic numbers. We did hear Lyft CEO John Zimmer there talking about the number of increased drivers, the number of drivers increasing at a faster pace than the previous quarter. And Zach, because we've talked so much about Lyft, Uber, some of those companies that have really had to dangle a lot of incentives to get drivers back on board. Zimmer did mention that in the states that have ended the enhanced unemployment benefits, he's seen bigger return of drivers there. So something to watch in that thread. But investors certainly not pleased if you look at the stock action right now, down more than 7%.
Yeah, and I mean, I think that they're focusing in on what you mentioned there and talk about driver incentives and how much it's going to cost the company to bring those drivers back on the platform if demand does come back even farther in the quarters to come. And I mean, there's a couple numbers you can point to on that front. I mean, better than expected adjusted profit guidance for the full year, 25 million to 35 million we heard on the earnings call. Particularly for the third quarter, that was higher than 11.3 million that analysts were expecting. But I think, Akiko, I mean, you point out the price action here. I think investors might just be focusing in on the fact that we did see still $251.9 million net loss for the quarter. And that's larger. We think about it narrowing during the same time period last year. But of course, year-over-year comps are going to be what they're going to be. But it was more than what analysts were expecting there when you think about net loss, 230.1 million. So, we talked about adjusted profitability and what this company can post there, but still, I think investors, the longer this draws on and you think about the cost on the driver's side, maybe getting a little skittish about, finally seeing that net loss come down. Not good when you miss on that front. There's another company, too, that I've been watching in today's session off earnings as well. That would be Match Group, the dating app giant, which includes the likes of Hinge and Tinder, beating on its top line, but missing on the bottom, just 46 cents a share versus the street at 52 cents. And it's interesting because it kind of speaks to the story we've been talking about in terms of different countries around the globe recovering at different speeds here in the pandemic. And you might not think that we could learn that from the results of a dating company here like Match Group, but really that's what the company pointed to in COVID impacting results in India and Brazil. They said seeing a strong recovery here in the U.S., but and Europe as well. But important markets like India, South Korea, Brazil, Japan further behind on that COVID recovery curve. Tinder, for its part, saw growth of 26% in the second quarter, had 9.6 million users. That was up 17% when we talk about Americans here paying for the services. But Akiko, I mean, that's kind of the story here, is just looking forward, a mixed picture in terms of adding revenue from paying users beyond the U.S. and Europe, and that's not exactly something that Match Group can say is headed in the right direction.
Yeah, and that's something to watch with so many of these companies with significant international exposure. To your point, we're talking so much about the Delta variant and the concerns here in the U.S., but when you look at places like Asia, they have really lagged in vaccinations, and that's really coming back to bite them in many ways. We're just talking about the big outbreak. We're seeing big relative to what they had seen before over in China, obviously Japan in focus too, but all those pickups in terms of infections going to weigh on a company like Match Group as well. Let's talk about another stock that we are seeing sliding in the session, and that's GM reporting their earnings this morning. Adjusted EPS coming at $1.97, their revenue of $34 billion. A number of things here highlighted by the company. Earnings, number one, dragged down by warranty recall costs stemming from the Chevy Bolt EV. Remember, there were about 100,000 cars that were recalled twice this year because of the fire risks. That made up roughly about $800 million of the $1.3 billion in warranty costs. The company did raise its full year guidance, but some key headwinds still there in play. Number one, the commodity costs rising by about $1.5 billion to $2 billion. And then, of course, this ongoing chip shortage. It was just yesterday that we heard from the company saying that they would be shutting down 3 assembly plants for their full-size pickup truck because of that shortage. For much more on the broader car space here, let's bring in Greg Migliori. He is Autoblog editor-in-chief. And Greg, I'm just walking through the numbers on GM here. The stock really tumbling in this session, but really some of the concerns they've highlighted speaks to the broader issues we have heard consistently throughout this earnings period from car makers, which is the rising commodity costs as well as the chip shortage. How are you looking at all those variables?
Absolutely. And thanks for having me, guys. So General Motors overall did have a strong quarter. They beat estimates. And there was a strong demand for some of their pickup trucks and SUVs, which are obviously quite lucrative. And that allowed them to overcome things like inventory issues and the chip shortage. General Motors, like you guys mentioned, did raise its earnings outlook, but the CEO, Mary Barra, is acknowledging some of these challenges, which are really, they could be very strong headwinds as we head into the second half of the year here, like the Delta variant and like chip shortages. They're two very unpredictable things that could impact the business model and obviously earnings. They have a big third quarter and fourth quarter out in front of them. Mary Barra, again, laid out an aggressive, I think, optimistic plan for growth. They're going to launch the GMC Hummer electric vehicle. This is a big deal launch for them. It's the return of the Hummer brand as an electric model. That's going to happen, I believe, in October. And that's sort of a signpost for GM. The Cadillac Lyriq, that's another EV, is going to follow in early 2022. And they've even mentioned this morning that they want to move up sort of $8 billion in investments to pull them ahead for EVs. And that's sort of their goal, is 1 million sales of EVs by 2025. The challenges are really obvious, though. And things like the Chevy Bolt recall really don't help. That was actually the last generation of Bolt, so it's not the new model that's on sale right now. But that still is not a great, situation for consumers, especially if you own one of those cars. And that obviously, understandably, is, cost them quite a bit of money in the second quarter. So sort of despite these challenges, which, recalls, the chip shortage, the pandemic, they're going to weigh down basically every car company. And I think GM is better positioned than most to try some new things and grow in the second half of the year here.
Yeah, you talk about the GM, the struggles there specific to the Bolt. We're talking about 800 million, they said, on the recall issues late last month that we've been highlighting on the show here. But that's a lot of money, and you wonder if that's kind of what's weighing here in terms of the build out and the other models you're talking about on the EV side. If that kind of is having investors skittish on the idea that they can actually handle as big a push into EVs as they're kind of trumpeting here and had got investors excited about, not a good look when your cars are catching on fire. Is that kind of, how different is the technology there in the Bolt versus maybe some of the other models in what GM's trying to do?
Yeah, no, great question. So what GM is doing is basically banking on this new sort of battery cell technology called Ultium. It sounds cool, sort of like a transformer type name, if you will. And I think that's good for marketing and trying to, generate enthusiasm around investments. So that's sort of their going forward type of, battery packs that's going to power things like the Hummer, the Cadillac Lyriq, and everything that comes after that. These Bolts that are sort of in question are powered by like an older type of battery cells, not to get too granular here. And they actually switched suppliers sort of through the launch after, I believe, one recall maybe. So again, that's sort of like an older technology that on the last generation of Bolts that they're trying to sort through. So I don't think that's really going to hurt them going forward. But to your point, it's certainly not a great look, especially because these are relatively new vehicles that are out there in the hands of consumers. So we'll see.
Greg, bottom line, this comes at a time when we've seen so many car makers set forward some pretty aggressive timelines for their EV rollouts. GM, of course, we're looking ahead to their Hummer EV as well as the Lyriq being launched. But you've got other car makers, even somebody like a Toyota who came out overnight, had record profits, but said that they were kind of keeping their forecasts in line there because of the uncertainty around the chip shortage. In the context of this aggressive move to try to get ahead of the EV race, how significant is the shortage, and is that going to pull back the timeline?
I think the CEO of Stellantis actually a couple of weeks ago sort of put it very well. He did a briefing with some reporters, Carlos Tavares, and he said, something to the extent of, we've never seen anything like this before. We think it's going to keep going on, and we really just don't know. Now, GM has a wide-ranging purchasing operation, and they can sort of get whatever they need. But with the chip stuff, we don't even know what we don't know. I think it's going to drag on for at least into next year. And it's, the chip shortage and the Delta variant are two things that I think sort of weighed down GM and other automakers in a way where good quarters probably could have been a little better sort of in normal times. So, a lot of uncertainty as we head into the fall, but again, it looks like GM is probably better positioned than many car companies to weather this and grow.
Investors still not liking what they're hearing, though, today, as we see that stock continue to be under pressure. But Greg Migliore, Autoblog editor-in-chief, appreciate you stopping by here to chat with us on that. I want to shift over to another stock we're watching play out in today's session, a mover we have for you here when it comes to the real estate investment trusts that are focused in on Las Vegas. Real estate investment trust, Vici Properties, buying casino resort owner MGM Growth Properties in a deal valued at $17.2 billion. Of course, MGM Growth Properties spun off from MGM Resorts. The actual casino operator had been operating the lease for the casino giant. MGM Resorts is getting about $4.4 billion in cash through redemption of most of its stake in MGM Growth Properties. And Vici Properties now says about 45% of its rent base will come from the Las Vegas Strip, about 55% coming from other regional properties. And after the deal closes as expected in 2022, Akiko, that will include an updated master lease with MGM Resorts. So a potential bet here on Vegas coming back a bit.
Yeah, looks like activity sort of picking up there as well. Coming up, we're talking about the Chinese crackdown, the latest regulatory actions wiping out more than $1 trillion in market value. Could this mark the beginning of the exit for U.S.-listed Chinese companies? We're going to break it all down with Muddy Waters Capital founder Carson Block after this short break. Well, we saw shares of Tencent bouncing back in Hong Kong trade overnight after the stock plummeted on fears of a regulatory crackdown in the gaming space. The gaming sector, just the latest in the crosshairs of regulators over in China and increasingly here in the U.S. as well. So what is the key risk here for U.S. investors? For more on that, let's bring in Carson Block. He is Muddy Waters Capital founder and CIO. And Carson, it's great to talk to you today. It feels like we have seen one crackdown after another over the last several weeks. Started with Didi, we talked about the tech companies, then the education sector, now the gaming sector. What do you think is the motive here? Connect the dots for me.
Sure. So let me preface everything by saying that when it comes to reading the CCP tea leaves, I mean, who really knows? So I'm just giving you my best assessment. I think you have to look at this in two tracks here. So you have the industry by industry crackdown, whether it's on real estate, such as Evergrande and the leverage there, the cybersecurity with Didi Chuxing, or the education companies, and also Tencent as well, gaming. But I think that what actually is more important is this thread that connects them all, which actually is an issue that goes back probably 11, 12 years. And that is the issue, at least in the United States, with the fraud in the financial Chinese companies, the US government's increasing demands to be able to inspect the auditors of these companies. And I think what we're seeing now, since most of these moves are against publicly traded companies, especially companies that are public in the US, I think that what this means is, and understand, I'm reversing myself here. I always thought China would give at the 11th hour on auditor inspections. And the reason I thought that was because so many CCP officials have undisclosed stakes in these US listed China companies. So I figured, that they would exhaust our political will and then give on it. And, we'd be able to inspect the auditors and nothing really would be accomplished. But I think Xi Jinping has decided not giving on the auditor inspection. And I think that's because right now he has to play to this domestic audience of not being bullied around by the US. And I think he's also assessed then that it is inevitable that the US will delist the US listed Chinese companies, because if you look at this act that was signed into law in December of last year, it passed each House of Congress unanimously, and it requires the SEC to delist these companies. So I think that while you can see certain industry by industry moves here that are designed to improve things, I suppose, in the domestic front for Chinese citizens, the overall thread is, I think Xi Jinping is saying, look, US listed companies need to understand that they have to find an alternate way of accessing capital markets, come back to the mainland, come to Hong Kong, but your days in the US are numbered. So that's my best interpretation of what's going on.
So where does that leave U.S. investors? I mean, it sounds like you're saying that the Chinese side isn't going to give. The U.S. is going to continue to seek additional transparency from these U.S.-listed Chinese companies, which isn't going to actually happen. What about those investors who've put their money there?
Well, so the act that was signed into law, the Holding Foreign Companies Accountable Act, has a pretty long runway on it. I mean, clearly, Congress was not looking to, this was a bit of a kid gloves approach. But what I think China is doing here, and actually this is an important point that I should have made a moment ago, is with Xi effectively forcing companies to relist or exit the US capital markets over time, if Chinese companies largely get out of the US before the mandate to delist kicks in, then it kind of looks to Xi's domestic audience like Chinese companies left the US out of strength as opposed to being thrown out. So again, this is all, in my view, about playing to domestic politics. So what is the timeline that Xi Jinping is really imposing here on companies to get out of the US? That's impossible to say. Again, the Holding Foreign Companies Accountable Act, I think it's a 3-year runway. So for Xi, it's somewhere inside of that. Now, some of these companies will be able to relist in Hong Kong and have active markets. And so if you're a US investor holding shares in a company that does that, you should be able to, as we say, funge your shares and trade them over there. But in my view, the Hong Kong market does not have the liquidity to support a wholesale relisting of these companies. So I think your tier one US listed China companies will be able to find reasonable markets over in Hong Kong, meaning some liquidity, et cetera. It won't be anything like the liquidity in the US. But your tier two and tier three companies are going to have problems. Now, the interesting thing here, and now this is speculation on top of speculation, but that might mean that China will look to encourage, and there is precedent for this sort of thing. If you look at these companies that were acquired in 2012 through 2014 with financing provided by state-owned banks, like some complete zeros were taken private at real premiums with Chinese government financing effectively. I think that maybe you could start to see some acquisitions over time of these tier two companies by the tier ones because there's not enough liquidity in HK. So speculation on speculation, but there might be an interesting long side play. Not something I'll get involved with, but just putting it out there.
Yeah, I mean, speculation on speculation. That's where our viewers' ears might perk up here in terms of what they should be doing, maybe to play it. And you're talking about risks in some of the bigger guys versus some of the smaller guys. There's also the ETF way to play this, I suppose, if you really wanted to. Fundstrat was out with an interesting note kind of mentioning a potential inflection point on KWEB, kind of the China Internet ETF here. And when you do look at that, I mean, down 54% since March 31st, the S&P 6% gain over that time frame. I mean, when you're looking at this, obviously you're talking about speculation on speculation here, but it sounds like you're mentioning that there could be less risk to play the bigger guys here that have also been beaten down, but have also seen investors shed them, Kathy Wood among them. I mean, what would your advice be to maybe an investor who does want to take the other side here and maybe jump in now?
Well, look, I mean, when you say less risk, I suppose it's all relative. I'm of the view, and I have long been of the view, that substantially all of these companies have problems with their financial statements to at least some extent. So if you look at it through my worldview, you're talking about financials that are probably, have issues in many cases. You're talking about this variable interest entity structure, VIE structure, that we didn't mention this earlier, but the PRC government is putting this up for review as well. And that's the structure by which almost all of these companies that are listed in the US have gone public in the US. And it applies to, I think, pretty much every internet company. So there are questions around the legality there. I do think that the end game is to relist these companies in Hong Kong or domestically in China, but that's also a risk right there. If you're thinking on the US side, hey, I'm going to play this, I want to be able to funge my stock. If the relisting occurs in mainland, I mean, you really have to figure out whether your broker is going to allow for that. So I do think that the Chinese government was a bit shocked by the reaction to these moves in the markets. And they're trying to mellow it out. I think they want like a nice glide slope down as opposed to this. My kind of quip was, I think that too many CCP officials lost too much money too quickly when these things dropped. But it's risky. Of course, I come from a viewpoint where I've long felt that these are toxic securities. So take what I'm saying with a grain of salt if you want to be on the long side. But I just feel like there are lots of embedded risks here, and there are a number of unknown risks or unknowable risks as well.
Yeah. Well, I mean, let's shift from unknowable risks to maybe known risks. And one name that has been caught in kind of, I guess, shining a light on some of the known risks in the market. We're seeing shares of Robinhood pop quite a bit today, halted for volatility and a lot of that. I mean, we saw kind of short sellers get a lot of flack here in the GameStop meltdown. And now you got Robinhood up 30% and halted well above its IPO price at $38. I mean, as a man who's played the short side of this, what do you think about the moves there and what might be looking to do on a move like that?
Well, I mean, trying to decode moves like that or volatility like that is, there's no fundamental way to look at that, right? obviously Robinhood exists and its business model is based on payment for order flow. So is there a regulatory risk here? I mean, there is a risk that payment for order flow will be reined in some way. I'd be surprised if it were eliminated. The HFTs that provide the payments to Robinhood will tell you that, hey, we must improve price, and we do improve price. But the flip side of that argument is, well, do you improve price as much as you could, or are you making this nice little spread there? And look, it's a very difficult, I mean, now we're talking US politics really, and it's a very difficult situation to foresee, especially because there's so little understanding of how this stuff actually works. I mean, it's a little disheartening. It was a little disheartening watching these GameStop hearings and, hearing various Congress people try to discuss what happened, and they clearly have no handle on how markets work. So is there a chance that they go and do something bizarre? I mean, in the absence of people who really know what they're doing, yeah, there's a chance. So again, I'm going to punt on this one and just say, state the obvious. Like, there are risks there with Robinhood, but I don't know if PFOF is the wave of the future or if that's something that's going to be reined in.
Carson, finally, going back to the risk from the Chinese companies, I mean, it sounds like you're foreseeing here a potential decoupling, if that's the right word, of financial markets between the U.S. and China. And ultimately, what does that mean for the capital markets here in the U.S.? I mean, sure, there are significant risks involved with these companies, but you've still got dozens of Chinese companies that have come to market in the U.S. this year. What does that ultimately mean for the U.S. exchanges?
Well, we've heard the word decoupling used for several years with respect to the overall economic relationship between China and the US. And to be clear, it's impossible to completely decouple. So it's degrees of disengagement. I've been making the point for a few years that the capital markets were really the only high ground that had been left unscathed by this broader trade war or these broader issues, economic, political issues between the two governments. Well, that's no longer the case. It's no longer high ground. So I think that from the Wall Street perspective, the perspective of the banks and asset managers, they're not liking this because they want to continue to sell the dream to US investors and make the fees associated with that. I do personally think it's healthy if less US retail money and pension money is put into these things. But on the other hand, capital is mobile. And at least at the institutional level, if there are fewer US listed China stocks, then large fund managers will beef up their Hong Kong offices and Shanghai offices some more, and they'll be trading from there. So I don't think this will really scale back the availability of China-based financial products for US investors much. It'll irritate the banks, and the banks tend to get outcompeted in Hong Kong often by local banks, and there's real fee compression there. So for banks who make a lot of money on the IPOs and secondaries of these China names in the US, probably the halcyon days are over.
Carson Block, it's good to talk to you today. Muddy Waters Capital founder and CIO. Appreciate you stopping by. And we'll be right back. Well, Los Angeles is looking to follow New York's lead when it comes to mandating vaccines. Yesterday, we saw New York become the first city in the country to mandate jabs for indoor dining as well as events. Now, Los Angeles' city attorney is urging the county's board of supervisors to implement the same mandate to try and prevent or at least stop or slow the spread of COVID-19. Let's bring in the city attorney himself. We've got Mike Feuer joining us from LA. We've also got Yahoo Finance's Danny Romero joining in on the conversation. Mike, it's great to talk to you today. Walk me through your thinking, first of all, in terms of why we are at the point where you think the mandates need to be in place.
Well, you know, the CDC has called this a pandemic of the unvaccinated. For a long time now, many people have followed public health advice and gotten vaccinated, but others haven't. And because others haven't, the COVID virus is surging here. And we need to be able to curtail that. We should be incentivizing people to get the vaccines. We should be honoring the roles that people have played to act responsibly by enabling them to be in public places without masking. I'm hopeful that we can reach the stage where we require vaccinations for certain indoor venues. And then as things stabilize, we can alleviate the mask mandate that has been put in place here in Los Angeles County. We need to be incentivizing people to get the vaccine. And we need to be saying to people who've taken the act to act responsibly that you did the right thing. And society is going to recognize that.
And Mr. Feuer, in your proposal, you didn't include the option for the unvaccinated people to submit a recent COVID test. Why is that?
Because simply submitting a test isn't good enough if we're going to be trying to incentivize people to participate in society by getting fully vaccinated, acting responsibly, not only taking into account your own health condition, but also the health of other people around you. Simply having a momentary COVID test isn't the same thing as getting a vaccine that's going to help slow the surge that we were experiencing here in California and throughout the United States.
You know, I also reached out to all the board members and the Department of Public Health in response to your letter. And from Supervisor Catherine Barger, she encourages businesses to show proof of vaccination, but has not yet considered the county mandating that businesses do so. What is your response to that? And I know that the board is set to discuss the proposal to require county employees to show proof of vaccination. Is that really enough?
First, I think it's a great step forward for county workers to show proof of vaccination. That's a great step for the board to take. Second, I know Supervisor Barger well, and I know that she is going to take into account the important public health mandate that we are trying to pursue here. I recognize that many businesses, indeed many restaurants, are already requiring proof of vaccination before someone can come in and dine. But we need to have consistency throughout the county. We can't have a patchwork of situations where some businesses are taking that step, but others aren't. So I'm optimistic the Board of Supervisors is going to take the next step, recognizing that many businesses are already going down this path. And then I want to say something else. You know, it's also in the interest of the business community to support this idea. And the reason is, it's one thing to have the responsibility to assure people are vaccinated. That's an additional burden. I recognize that. But a far greater burden would be having to shut down again because the virus is surging throughout our region. And to cut that surge and have to make a real step forward in trying to protect public health and safety, everyone needs to get vaccinated, and requiring rather than simply asking people to get vaccinated if they want to participate in things that are voluntary, like dining or going to a gym or going to a performance, could incentivize them to take the step that is what the public health experts say is the responsible step for them and for everybody else in our community.
Yeah, Mr. Feuer, Zach here. I mean, you were talking about kind of the added, I guess, effort that it might take some of these businesses to implement if they're going to be checking for vaccine status. We were talking with one of the industry groups that represents America's nightclubs yesterday on the show, and how much that might be, added on the plate of workers there. I mean, when it comes to the businesses, you might have heard voicing some concerns here and requesting maybe additional support for something like this. How much more can be lent, and what kind of additional resources might be put into something like that, and falls on the government side to make sure that it can be handled well, when you talk about people maybe presenting fake vaccine passports in line to get into some of these businesses?
Yeah, so a few thoughts. First of all, I want to underscore that a number of restaurants have already taken this step, so we know it can be done. Secondly, I noted yesterday in response to the New York proposal that the hospitality industry came out in favor of that approach. So there's a lot of support in the business community because the stakes are so high. Businesses recognize that if the surge continues, their livelihoods could be threatened. I recognize that this is not always going to be an easy thing to implement, and I think there's further thinking that has to go into how exactly enforcement can be optimized here. New York has certain steps they have in place. They have a citywide app. They have other steps they have in place. It may be that government can provide more to assist businesses to enforce this rule. But at the end of the day, the choices are getting increasingly stark here in the United States. We can endure another surge in COVID. We can confront the real possibility of having to shut down more than has already happened thus far. We were just emerging from this. We were just returning to some sense that people could experience life again. We want to be able to sustain that. And this, I think, is a necessary step on the way to getting there, as opposed to finding ourselves falling back into a world where businesses are shut down, employees are not getting paid, and our society is on the verge of something much more severe. We can do better. It's time. It's time for those people who've taken the step that attacked responsibly and gotten shots to be able to participate fully in society without having to risk a breakthrough COVID situation that now is confronting a number of people who've already gotten vaccinated.
Well, it feels like, if the last few days are any indication, that the vaccine mandates are gaining steam just with corporate America, but as well as local governments as well. Mike Feuer, Los Angeles City Attorney, it's great to talk to you today. And our thanks to Danny Romero as well for joining in on the conversation. Coming up, we're going to be talking about the moves behind Robinhood, off of its highs in this session, but still up nearly 30%. That discussion on the other side. We'll be right back. In our worldview today, China is dramatically restricting travel as it looks to control the worst COVID-19 outbreak in months. On Wednesday, the country announced it would halt all non-essential travel. Meanwhile, in Beijing, trains suspended long-distance rail lines for nearly 24 stations, while large apartment complexes were sealed off for testing. All local governments have called on residents to avoid leaving their regions. The latest outbreak has infected more than 400 people in 25 cities so far, including Beijing and Wuhan, where the first COVID case was detected in 2019. Residents in Beirut mark the one-year anniversary of the catastrophic explosion that killed more than 200 people and injured thousands. Demonstrators gathered along the port where the blast occurred, demanding justice for those who died. 1 year on, no senior official has been held responsible for the disaster that rattled Lebanon, even as the country faced its worst economic crisis in history. And that's only gotten worse, with the ruling government failing to establish a new cabinet to tackle the problems. French President Emmanuel Macron, who's been leading the Western effort to reform the country, pledged an additional $120 million in emergency aid today, along with 500,000 doses of the COVID-19 vaccine. The extradition case involving Chinese company Huawei's CFO reaches a critical stage today. Meng Wanzhou will appear in a Vancouver court as the judge begins hearing the final arguments over her extradition to the U.S. The daughter of Huawei founder Ren Zhengfei was arrested at the Vancouver airport in December of 2018 and faces allegations that she misled HSBC about Huawei's business operations in Iran. The court hearings are expected to last up to 3 weeks, and the case has reportedly also been raised in high-level discussions between senior U.S. and Chinese diplomats in recent weeks.
Let's check in on shares of Robinhood, seeing another big pop today after closing almost 25% higher yesterday. And for more on the moves there, shares were halted for volatility for a little bit in today's session. I want to get to Yahoo Finance's Ines Ferre, who's been watching that move for us. Ines?
Yeah, Zach and Akiko, this morning, in the first few minutes of trading, the shares were halted for volatility. Up 65% earlier this morning. Right now, we're looking at the stock that's up about 29%. So why is this happening? Could be a couple of reasons. One is retail interest. Swaggy Stocks, which tracks the stock sentiment and mentions on Wall Street Bets, shows that Robinhood is a top commented stock on the forum. Over the last 2 days, you saw that commentary spike up. Also, Fidelity is showing some real-time data that's showing that Robinhood is a top traded stock. And there are more buy orders than sell orders. And this is behind AMD and AMC. And these are also heavily watched and followed by retail traders as well. And then you've got Kathy Wood from ARK Investment, which last week on Thursday and Friday scooped up about 4.9 million shares. So that could be some sign of encouragement for investors. Now, you'll recall that with some meme stocks that are followed by retail traders, initially, often you've seen short squeezes on these. I reached out to S3 Partners. They measure short interest. This is not a short squeeze, definitely not. There has not been enough time to accumulate a large short position in Hood. But while there is some short interest, short activity in Hood, it's really the long side that's driving this price upward. And we just received some new data also from Bloomberg on option trading, options expiring August 20th. More put options are those are outnumbering call options. And puts is when you're betting that this stock will go lower, that the price will go lower. So certainly some investors out there that are betting that this rally may not last. So earlier this morning, we did see this stock spike heavily. Right now, we're watching it up about 28%.
Yeah, still significant upside from its IPO price there. And as for on top of that move for us, thanks so much for that. Coming up, the labor crunch hurting the restaurant industry as so many businesses shell out incentives to try and attract new employees. We're going to be speaking with the CEO of Noodles & Company after this short break. Well, the ADP private payroll survey out today showed just 303,000 new jobs were added in July. That's roughly half of what the analysts were expecting. The tight labor market overall weighing on recovery for so many businesses as they shell out some big incentives to try and attract new employees. Let's bring in the CEO of Noodles & Company. We've got Dave Benihausen joining us today. Dave, it's great to talk to you. You had some really strong earnings out yesterday with revenue up about 57%. And it feels like this is kind of a thread we're hearing with so many businesses. The business is coming back, the customers are coming through the door, and yet they can't find enough workers to fill that demand. What does that dynamic look like for you?
Yeah, it's great to be here, Akiko. That's definitely been the common thread that we're seeing in the industry. What we've seen, unfortunately, in Noodles & Company, April, Akiko, seemed to be the worst of the labor shortage, and now we've gotten that behind us. If we go back a few months, there was definitely a mismatch in terms of the number of people we were looking to hire versus the number of applicants coming through our door. That has steadily increased over the last couple of months. So we're actually pretty encouraged that we're starting to see kind of a light at the end of the tunnel when it comes to that labor shortage.
On the other fronts here that we've been watching play out kind of industry-wide, we've been talking about a lot of costs going up, not just for labor, but also other things that go into kind of products businesses are making. Obviously, in the restaurant space, you got a lot of costs there on that front too. When you see kind of pricing pressures there, I mean, is there anything that stands out? I know you guys top line estimates here, but earnings coming in a bit light. I mean, talk to me about what you're seeing on that front.
Yeah, it's really, we're seeing across the board, we're starting to see inflation kind of hit all aspects of the business. And it's not just rising costs that you're seeing, everything from lumber to the resin that goes into our to-go materials, and certainly on the labor side as well. But in many cases, it's availability. It's just getting the actual pieces of equipment that we need to operate the restaurants, to open new restaurants. That's been a challenge. Fortunately, no disruption that we've seen in our business today, but we definitely know it's a lot of interesting and unique things that are happening in the space when it comes to inflation and just availability and disruption.
David, let me ask you about what we were talking about with the LA City Attorney earlier in the program, which is this question about vaccine mandates. Obviously, you want people to feel comfortable coming into your restaurants, and there is a huge debate that's happening between mask mandates and vaccine mandates as well. Where do you stand on that, at least within your stores?
Sure, Akiko, it feels like deja vu all over again. If we go back just over a year ago, all of us in the restaurant space, particularly somebody like Noodles & Company, we've got restaurants constantly following very dynamically changing mandates, very dynamically changing regulations. That's what our biggest focus on is right now, is ensuring that across those different geographies, across those different regions, we're following all those mandates. We have encouraged our team members to be vaccinated, not required as of yet, but we do give 4 hours of paid time off to our employees, encouraging them to get vaccinated. We're fortunate at Noodles Company, before the pandemic, 60% of our sales were actually off premise. And now as we sit today, that's still around 80% of our sales. So as we see that dynamic shift, last year we were one of the first fast casual chains to go to an off-premise only model. We're looking at not just what would vaccine mandates, mask mandates look like, but also the operating model itself. We're not seeing changes in consumer behavior yet, though. So that's something that'll be interesting to kind of track as we go through the next few weeks.
Dave Benihausen, Noodles & Company CEO. It's great to talk to you today. I appreciate the time. Coming up, we are talking about moves for Activision Blizzard. That stock is up more than 2%, but a lot of concerns here about the corporate environment and that lawsuit that's been filed against the company, how that's likely to weigh on the company in the coming quarters. That discussion is on the other side. Welcome back to Yahoo Finance Live. We are seeing shares of Activision Blizzard up in the session on the back of some strong earnings out yesterday. Revenue was up 20% to $2.3 billion for the company in the quarter. But that sexual harassment and discrimination lawsuit filed by the state of California continuing to cloud the outlook for the company. Let's bring in Yahoo Finance's Dan Halley, who is following that story for us today. Dan, what do we hear from the company?
Yeah, essentially they're saying that they're going to take the accusations as seriously as possible. They mentioned that as part of the earnings release and on the earnings call. And, for the quarter, they did very well. Net bookings, which is what they report as revenue, that's what they get out of the sale of digital subscriptions as well as games. That was $1.92 billion versus $1.89 billion expected. Earnings per share were 91 cents versus 75 cents expected. They also beat on forecast for Q3, but really everything having to do with harassment and discrimination scandal is overshadowing that. So the day of the earnings yesterday, they announced that the president of Blizzard, that's Jay Allen Brack, he is stepping down. He will be replaced by two new co-leaders who are veterans of Blizzard. The head of HR has left the company as well. They've sacked a few people over time since this scandal had broken and the investigations had started. But really what this comes down to is employees looking for kind of more scrutiny of the way managers handle interactions and management to come forward and really kind of uphold the values that they say they are committed to. I mean, if you look at their investor page, they talk about diversity and equity, and clearly that's a problem within this company. The main issue for investors now is, do they manage to hold on to the developers that make the games that they produce so great? That's something that they really need to take into account, and something that obviously Activision Blizzard is going to be looking at very closely.
All right, Dan Halley, bring us the latest there. Appreciate that. Coming up, we're going to be discussing the updates we got from SEC Chair Gary Gensler speaking yesterday about some of the issues around crypto and regulation. We're going to be chatting with someone who knows all of that very well. One of the few CEOs that can boast a banking charter in the crypto space, Caitlin Long, is going to be joining us to dig into the details. On the other side, stay with us. Welcome back into Yahoo Finance Live. We've got the Dow off more than 200 points right now. Some interesting updates to thinking at the Fed, at least when it comes to one of the more important voices out there. In a new speech, Fed Vice Chair Richard Clarida presenting some new thoughts around inflation risks and perhaps a pull forward in his timeline for the first time around rate hikes of the cycle. And Yahoo Finance's Fed reporter Brian Chung is all over that for us today. Brian, I mean, it's interesting because you think about some of the inflation, the transitory talk at the Fed. What do you make of this?
Well, Zach, this commentary coming about an hour ago, and as you mentioned, it was the Fed Vice Chairman Richard Clarida who provided a little bit more detail on how the Fed might be timing its tightening of its extraordinary accommodation through the crisis. So Clarida is saying that he could see the Fed tapering its asset purchases before the end of this year if the forecast that he has end up playing out as he expects. But he also says if the unemployment rate reaches 3.8% by the end of 2022, that could give a green light for a rate hike by the end, or rather by the beginning of 2023. Now, there's a few caveats to this. First of all, he said, I want to read you this quote: "The recovery and expansion following the pandemic are unlike any we have ever seen, and it will serve us well to remain humble in predicting the future." But there's also the caveat beyond the data itself that Clarida himself will be gone from the Fed board by the end of 2022, barring any sort of renomination from the Biden administration, which I haven't heard of. So that really kind of underscores how the Fed, really the other cast of characters could come into play. And when you do look at those dot plot projections from the Fed's last June meeting, rather that was 2 meetings ago, you can see that the median member of the 17-member FOMC does see the base case for perhaps 2 interest rate hikes by the end of 2023. This all coming as we hear commentary from former Fed Chair Janet Yellen, who's now currently the Treasury Secretary, talking about the idea of trying to push that infrastructure bill that's currently working its way through Capitol Hill across the finish line. She's really saying that things like childcare, training programs, the availability of high-speed broadband internet are all priorities, and that for that reason, Congress should get moving on those investments. She said, quote, "Now is fiscally the most strategic time to make them." And one big reason, guys, is because of low interest rates.
All right, Brian Chung bringing us the latest there as we continue to watch for any update and guidance there on the interest rate hike front or tapering. Appreciate that. I want to shift over to the broader market, though, as we got the update on the labor market here in terms of private payrolls numbers coming in from ADP this morning, missing the estimates that economists had by a wide margin, almost by about half. If you do the math there, 330,000 private jobs added for the month of July versus the 690 expected. And for more on what that signals, not just for the labor market, but for where we're at in this recovery right now, happy to bring back on James Liu, Clearnomics founder and CEO, joining us once again. And James, I mean, when you look at that number, what does it say? Because obviously we're probably expecting some chop as people react to the Delta variant, but where do you classify that as kind of some steam coming out of this recovery?
Well, hey, Zach, good to chat with you. Well, the backdrop to all of the market activity right now and all the economic data is that we are back to pre-pandemic levels for the overall economy and for corporate earnings. And so what we would expect going forward is that we're transitioning from that initial recovery to a more steady state set of numbers. And so we are going to expect a lot of these numbers to start to come down and to moderate over time as that evolves. And so, across the board, we are back to pre-pandemic levels. But when you look at the labor market, as you're talking about, we're only about 70% of the way there. So there's a little bit more room to run. What that means for the overall market, we think, based on this data, is that the overall equity markets are still highly valued, but earnings are expanding at a rapid pace. And so we think the equity markets are still in a fine place. However, on the side of interest rates, Brian, and you were just talking about some of the Fed comments, we expect interest rates actually to start to rise again. They've been falling since the end of the first quarter, but we think a more steady state rise in interest rates is more likely over the next 2 quarters.
And James, on the earnings front, it feels like there's a similar thread regardless of sector here, which is that there has been a significant bounce back when you compare it to the same period last year. And yet there's a big question mark going into the year end because of concerns around the supply chain, whether it is the cost of goods going up, whether that's shortage of chips. How does that change your outlook in terms of these companies and their ability to continue this momentum and the recovery?
Well, that's right, Akiko. There are some uncertainties out there all that being said, the current consensus estimate is that we'll hit about $190 for S&P earnings at the end of this year. That'll represent a 40% increase over the full year, which is just absolutely astounding. And the numbers really have lived up to the hype so far. Now, maybe those numbers come down to closer to, quote unquote, only 10% over the next 2 years, but those are still really spectacular numbers. The risks to that story are, like you mentioned, maybe there are more supply and demand disruptions that affect everything from semiconductors to autos. Maybe there's even more inflation or supply constraints that cause prices to go up. But overall, businesses are reinvesting and consumers are spending. So we think that there is still a really phenomenal earnings story to be told. And over time, that earnings story is what's going to pull valuations back down to earth from the very lofty levels that they're at today.
And James, lastly, when we talk about expectations, it is interesting to kind of see investors and CEOs kind of reacting to the timeline that the Fed has laid out as well. And JP Morgan CEO Jamie Dimon speaking on Fox Business not too long ago about kind of his expectations on when the Fed might have to move. And he's saying basically the Fed's going to start tapering once they begin seeing unemployment hit 4.5%. You're thinking that it's going to be, that the inflation that we're talking about here is not transitory. It's a pretty big voice to be coming out on the other side of what the Fed's expectations are. I mean, how serious do you see maybe the pull forward that we're continuing to talk about?
Yeah, that's really the big question. We're under 6% on the unemployment rate. You have inflation that had reached, close to 5.5% on many measures across the board. So, overall, the fact that we are back to pre-pandemic levels, and you think back to end of 2019, before the pandemic, the Fed funds rate was coming down, but it was at 1.5%, not 0%. And so we do think it's possible that some of that is pulled forward. And so what's likely to happen in the market is that we'll have these short periods of adjustment as we're trying to figure out will tapering happen end of this year or early next year, and when that first rate hike will be. Right now, most likely at the beginning of 2023. And these small periods of adjustment in the market, they'll be volatile, but that's probably healthier for the market than a big shakeup if there's a big surprise out of the Fed. The Fed obviously wants to help ease the market there, and I think they've been actually doing a very good job of that so far.
Yeah, so far the language there has been pretty impressive in kind of guiding, of course, a change up at the top of the Fed here. Whether or not President Biden wants to renew Jerome Powell's stint there could change things up. But James Liu, Clearnomics founder and CEO, appreciate you joining us today. I want to switch over and check in on the action in the crypto space after SEC Chair Gary Gensler came out swinging with some updates on how he sees his agency stepping up regulations on tokens and lending platforms. Not necessarily shaking up the prices here. Ethereum and Bitcoin both up today. In his thoughts, though, presented at the Aspen Security Forum, Gensler hinted at perhaps approving a Bitcoin ETF, even if it were limited to cash-settled CME-traded Bitcoin futures. So that might be a positive in some eyes. But the negatives, some people are pointing out, were focused more on pressure to label a lot of the other cryptocurrencies outside Bitcoin and Ether as securities. In a corresponding video on his Twitter, Gensler says it all boils down to investor protections. Take a listen.
I think that moving forward, promoting investor protection is not only good for you and for anyone who would consider investing in these assets. I think that it's the only real viable path forward for this nascent technology. See, at the heart of finance is trust, and trust rests on investor protection. And so that's what the SEC has to do with crypto, investor protection.
Shout out to the production value on that SEC video. I kind of like what they're doing there. But joining us now for more on what it all means, happy to bring back on Caitlin Long, CEO of Avanti Bank, one of the few licensed and regulated crypto banks in the space. And Caitlin, there's a lot to dig into when it comes to not just what we're hearing from Gary Gensler, but also what Congress is trying to do here. But we'll start with what we heard from the top of the SEC yesterday. What jumped out to you about maybe clarification on either the Bitcoin ETF that people have been waiting for there, or maybe more pressure on things that aren't Bitcoin?
Oh boy, yes, there's a lot going on, and Gensler is a huge part of it. I'm surprised he hasn't acted more up until this point. He's been in his role now for several months. And if you go back to his confirmation hearings, he was asking Congress for clarity. And what came out of yesterday's speech is that he's taking some positions in spite of the fact that Congress hasn't acted. So there's a jump ball going on. Is the SEC going to interpret its authority more broadly and start taking enforcement actions? Or is the SEC and, of course, other agencies in Washington going to wait for Congress to give them instructions? But very clearly, something's happening. And I must say, his video is interesting because consumer protection is at bottom one of the big concerns. There are bad actors in this sector. There are institutions that are doing things that, had they registered onshore in the United States, would be considered illegal and they would have been shut down already. But they're operating overseas, offshore, and in many cases actually serving Americans.
Yeah, it's interesting because you talk about maybe what they can do without getting more powers here from Congress. And one of those is kind of labeling what is a security and what's not. And he kind of waded into that. He didn't want to get into specific tokens, but I just want to read what he kind of had in his prepared speech there on that topic. He said, folks buying these tokens are anticipating profits. There's a small group of entrepreneurs and technologists standing up and nurturing the projects. I believe we have a crypto market now where many tokens may be unregistered securities without required disclosures or market oversight. This leaves prices open to manipulation. This leaves investors vulnerable. I mean, that is kind of what you're talking about here, investor protections. But there's a lot out there beyond Bitcoin and Ether. And you think about the exchanges being impacted here, maybe what you guys could offer being impacted. I mean, talk to me about how big that is and how hard it is for people to agree on what is a security and what's not.
Well, it's so interesting because the SEC almost 2 years ago put out guidance that was supposed to clarify this, and it's clear as mud. And the industry has been saying, we really would like to have clarity because we want to know where the guardrails are so we can stay within them. In most cases, the compliant actors are interested in staying within those guardrails. And that was one thing I disagreed with Gensler's speech yesterday when he said this is clear. It is not. It is clear as mud, and it does need to be further clarified. And what's happened is the SEC has taken the stick approach as opposed to the carrot approach, which is to use enforcement actions and sue the issuers of these tokens that may not have clarity. And instead, what the SEC should be doing is enabling the innovators who are trying to protect consumers and are not trying to defraud anyone by providing enabling guidance. And that is not what the SEC has done.
So there may not be more clarity right now, but it does give us a little insight into Gary Gensler's thinking. And this morning we heard him say that, look, if you look at the crypto exchanges, they're just not under the same regulatory regime like a New York Stock Exchange, for example. I'm just curious if you think that they should be. Should they be treated as the same, or do you think there are separate tracks that need to be pursued?
Well, for exchanges in particular, there is really no regulatory regime for them. And again, most of the ones that are actively trying to do right are asking for clarity. They're not trying to evade the law. There are some offshore, of course, that are, but most of the onshore ones are not, and they do not fit within existing broker-dealer rules. We saw Chairman Powell testifying at the House Financial Services Committee a few weeks ago, for example, say that one corner of this industry, which is called stablecoins, stablecoins are US dollar equivalent tokens, and that they should be either regulated as bank deposits or as money market funds. But the problem is they don't fit within money market funds right now. The Federal Reserve has the ability to fit them within bank rules right now. They don't need Congress to act. It's very interesting that the Federal Reserve has not done so. They're not eating their own cooking. They're not living up to their own words. But the SEC, I think, does have its hands tied more than the Federal Reserve does on going ahead and saying, yes, here's how exchanges should be regulated. I think both the SEC wants to do that and the exchanges are expecting it. The problem is it doesn't fit within the existing laws and they need Congress to act. And we see what's going on up on Capitol Hill. It doesn't seem like anything's going to happen anytime soon.
Yeah, in that appeal for powers, he kind of laid out also a focus on not just kind of the tokens themselves, but now the institution, the crypto platforms that are kind of lending and allowing people to tap equity in their crypto holdings, and we've seen pressure mounted on some of those other protocols too. I mean, when you look at that space, did that catch your eye for something that maybe Gary Gensler would have high on his list of things to talk about, and maybe the issues that we've talked about, you and I, before, when it comes to those lending platforms not necessarily having any oversight there either?
Oh boy, that was the clearest shot fired, if you will, in Gensler's speech. In my view, there was a one-line reference to crypto lending platforms, and it didn't mince words. It said if crypto lending platforms are engaged in securities activities, they are running afoul of the law. It's interesting because we have seen enforcement actions by state securities regulators. I think now we're up to 5 states in the last week or so against one of the crypto lending platforms in the United States. But the SEC itself has not gotten involved. And yet Gensler had that one line in his speech. It does seem that there's coordination happening among the regulators. It is worth noting, though, one of the things that I think is difficult for folks who haven't been around and don't have the proverbial gray hair to understand is that the SEC has 5 years to go after bad actors here. They can take their time, whether you think that's fair or not. That's what the law is. And in the case of the Ripple lawsuit by the SEC, it took them 8 years. And the reason that they kept going for 3 years after the statute of limitations expired is that they had apparently agreed with Ripple to toll the statute of limitations to give themselves extra time. I actually think they need to act. I don't think those kinds of behaviors are helpful. To sue someone 8 years later over something that might actually be a valid dispute. The law is not clear in some of these areas. But the SEC, just because they have not acted yet, it absolutely does not mean they won't. I think they will. They take their time and they get their ducks in a row first.
I think that's a good way to wrap here with the last question. And, I guess this might be veering a little bit outside of, what we normally ask you about, which is just kind of the price moves, just because of what we're seeing, Bitcoin and Ether seeing a pop. Of course, that's kind of been settled when we think about how the SEC might look at them as not securities. But it's interesting to see the rest of the tokens and the rest of the space still in the green as well. And we know they're kind of linked. But if anything we got from yesterday, it would seem that they shouldn't be linked. And I guess, the question there would be what you make of the moves that we're now seeing in kind of investors, maybe putting the weight on what you just said, that maybe they take this to mean we're in the clear here because the SEC hasn't done anything yet. So maybe it's going to be fine.
Well, I think some of it is in the price. It's hard to say how much, but it is true that Washington, D.C. has been telegraphing a big regulatory crackdown. It actually started on the day that Tether released its reserve asset allocation back in April, which, by the way, was the peak in Bitcoin's price. And at the time, I said that's not a coincidence because a lot of the big smart money at the time, you saw analysts telling their investors, get to the sidelines, there's a crackdown coming, and wait until it happens and then get back in. And indeed, that's kind of what the price action has telegraphed. But I think more interesting than the price action is the volume. The volume has collapsed as it's clear that certain of the intermediaries in the sector are definitely in the crosshairs and others are more likely to be clear. But again, until that all shakes out, I don't expect the volume to come back. But the price action, a lot of it is a function of scarcity, and that has nothing to do with regulators at the end of the day.
So many variables to walk through here. Caitlin, it's always good to have you break it down for us. Caitlin Long, Avanti Bank and Trust founder and CEO. Thanks so much for joining us today. Let's turn our attention to one of the trending tickers in this session, and that is Live Nation, getting a big pop today, up more than 2% on the back of its earnings call. Q2 revenue climbed to $575 million. Of course, last year, pretty much all the live events were canceled here, so it's a significant pop, more than 600% from the same period. Net loss narrowed to $196 million. Ticketmaster, which of course Live Nation owned, seeing one of the best months in history in North America in terms of ticket volume. Now, some good commentary here from Michael Rapino, the CEO. They're saying that most festivals, they have sold out quickly. And he said, we expect to have 3 million fans attend festivals during the second half of the year. 2/3 of their festivals already increasing their attendance compared to 2019 levels. And Rapinoe saying that next year and 2023, in his words, will be a roaring era for live events. Zach, and I don't know about you, but I think, we're all dying to go back out to concerts and live events. And Live Nation certainly a big beneficiary on the back of that after a really tough year.
Yeah, we've heard a lot of calls for a roaring era of concerts, maybe not panning out for 2021 either. We heard that in 2020 with the hope of vaccines coming out. What we could see getting pushed back and back. We'll see what happens there. Coming up, families celebrating already the child tax credits that come through, but a new study looking at how big of the benefits actually are for society say that it's already delivering on that. We'll break down the details on the other side. Stay with us. Welcome back. It's been a few weeks since we've seen families cashing checks that may have come through on that child tax credit. And as more and more people push to talk about it being put into place permanently, the new study is looking at the way that it's already been impacting society and delivering on what it set out to do, and actually delivering a good amount of returns on the costs of delivering those tax credits. And for more on that, Yahoo Finance's Denitsa Seikova breaks down what exactly the analysis has found. Denitsa?
Yeah, so we're looking at an analysis by Columbia University that looks at both the short-term and the long-term returns from this investment. As a reminder, the price tag we have for the expansion of the child tax credit is around $100 billion, and the return we're expecting is 8 times more, close to 8 times more. So this is because the expansion of the child tax credit would actually increase children's safety, future earnings, improve health outcomes for both children and their parents, and reduce healthcare costs. So the biggest boost to society is really improved health and longevity of parents and children. Obviously, living longer has monetary benefits to society, and such cash payments are proven to have positive effects on health and longevity. Therefore, they're expected to bring big benefits to society, but this is more of a long-term benefit. Additionally, the expanded credit will lead to an increase in future earnings for the children receiving the credit. There are studies showing that increase of family income in childhood is actually proven to translate into additional future earnings for the child beneficiaries. As a reminder, the American Rescue Plan not only increased the CDC amount, allowed half of the credit to be distributed monthly, but it also made the credit fully refundable. So a lot of low-income families are actually getting the payments now.
Denitza,
go ahead, Akiko.
Denitza, what are some of the challenges of getting a high return on that?
Well, there is one big challenge, really. There are 4 million children, families of 4 million children that the IRS doesn't have information on them, and they won't get the payments automatically. So if we want to get that high return, we have to reach those families. So this is the big challenge, and those families will be the biggest beneficiaries. So going forward, that's where we're looking at, whether those families will get the payments.
Denitza Seikova breaking down the latest there on the child tax credit front. Appreciate that. Going to take a quick break here, but when we return, digging into Acorns, the platform you may know well out there, investors using spare change, now teaming up with a wireless provider to help get some investment cash around their bills getting paid. We'll chat that with the CEO of Acorns on the other side of the break. Noah Kerner joins us after this. Well, you might know spare change investment platform Acorns well, especially if you've used them to invest using your spare change on purchases here. But an interesting new partnership with Cricket Wireless is expanding that into customers paying their bills as well, with some money for investments getting tossed back their way too. And for more on that, happy to bring on the CEO of Acorns, Noah Kerner, joins us now for more on the latest there. And no, I mean, we were just chatting. I mean, you got these partnerships with a lot of merchants out there, but talk to me about this new one with Cricket and how it works to kind of drive what you're all about in helping customers get involved and put their money to work.
Yeah, and thanks for having me on. So as you know, Acorns helps you invest small amounts of money, and you're usually investing your own money. but we also partner with lots of brands that invest in your future when you shop with them. And the Cricket Wireless partnership is exciting because you get a bonus investment when you sign up for Acorns from Cricket, and then every month you stay committed, you get an investment from Cricket into your future. They're also introducing Acorns on the phones, in the stores. The staff is going to be trained to talk about the virtues of long-term investing and sticking with it and staying committed. So it's a great partnership. And if you think about sort of the world of rewards, the history is cash back, and this is really cash forward. It's about brands investing into the future of their customers and doing it through Acorns platform, which is awesome and exciting for our customers.
Noah, how do you see this fitting into your larger strategy? To your point, it really is about sort of investing and sort of looking ahead here at a time when we're talking so much about sort of current return or quick return now. This is just, as you said, one partnership that you have in place. But as you expand the platform, how does the strategy shift for Acorns?
Well, Acorns is always about the idea from tiny acorns, mighty oaks do grow. So it's about small amounts invested very regularly, staying committed to it. Spare change, $5 a day, $1 a day, $20 a week, whatever you can do to invest regularly, get diversified, and also benefit from the power of compounding over time. And this is just another contribution. So if you think about going about your day, shopping with different retailers that you care about and love, those brands also investing in your future as a reward for that. So it's just another contribution to your future. And I think that's exciting for people. And I think if you were to step back and ask, what's the best way for a brand to connect, or a retail company to connect with its customers? Well, why not invest in the future of the customer as part of your strategy? I think it makes a ton of sense.
Yeah, and it's interesting when you add up all the small change or maybe small investments, not only growing into oaks for customers perhaps, but also quite a bit of change that you guys now have under management. I think it was close to $5 billion earlier in May. Talk to me about where the overall strategy of the company changes now as you try and add up all that spirit change. What the most pressing, product innovations you're looking forward to as you come out on the other side of the SPAC deal as a publicly traded company?
Yeah, everything again comes back to long-term saving and investing for us. So it's a very purpose-driven product. The whole orientation is to show you how much you're saving and investing for the future and to get you to stay committed to that idea. So every product we add onto the Acorns platform points back to maximizing saving and investing outcomes. So we get into banking, and we've been in banking now for 2 years, but it's not about getting you to spend more. It's about getting you to save and invest when you bank. And in fact, so if you think about that, we want you to spend less so you can save and invest more. We want you to earn more, which is how these brand partnerships come into play, so that you can save and invest more. So there's a real purpose orientation. We think saving and investing is the most important through line in your financial life. So why shouldn't there be a platform, which is what Acorns does, that is fully oriented around maximizing that outcome for you, for your kids, all the way through your life?
Yeah, now also on your Cricket phone too, as it's loaded there. But interesting partnership here. The CEO of Acorns, Noah Kerner, appreciate you coming on to explain it all, man. Have you back soon. Keep us posted as the company continues to grow there. No pun intended. We're going to take another quick break here on Yahoo Finance Live. We'll be back in 2 minutes. Welcome back to Yahoo Finance Live. In today's Startup Spotlight, a check back in with the company we profiled that was seeing a lot of business earlier in the pandemic, and that business has continued. That business would be Studio Shed, a company that's been helping people build out units in their backyard or spare space here to build out guest rooms. Of course, everyone needed a little bit more space in the pandemic, but that growth is continuing. And for more on that, I want to bring on Jeremy Nova, the co-founder and creative director of Studio Shed, joins us now. And Jeremy, I mean, when we first talked about this kind of idea, it made a lot of sense earlier in the pandemic, but talk to me about what you're seeing now as maybe people even return to the office, how your business is held up.
Yeah, thanks for having me. We have seen, continued growth through, through the end of last year and then into this year on both the single room studio side, which is, the people using a home office or just a small creative space. And then also on our larger units. So accessory dwelling units, things that have like a bathroom and a kitchen, they have a longer purchase consideration. And so a lot of the interest that was generated, I think in the raised awareness of this category last year is really coming to fruition for us. That product line is growing at about 200% a year right now.
How much of those homes that you're building out, or the ADUs, we should say, are for self-use by the homeowner? How much of it is actually being rented out? And we've heard so much about prefab homes really taking off in some cities where there is a housing crunch.
Yeah, it's both. We're seeing the majority are homeowners that are doing it at their own primary residence, but there's a variety of use cases that make a lot of sense. People need space both for themselves, for guests. They're perfect for multi-generational living, a safe place for parents to live. But the rental aspect is also large and growing. The ROI on building a unit like that is quite compelling. I spoke to a few customers ahead of this interview, and you're generally able to cover the finance cost of the unit from day one, and then turn that into a sustainable source of rental income over time. We're seeing people that have sold their homes with one of our units in the back. The appraised value of that space is typically about 1.5 times the retail price of the unit. So it's one of the best home improvement projects from an ROI perspective that a homeowner can undertake on their property.
Yeah, it's an interesting, way to go about it if people are looking to get additional income and staying in their home, if they got a big backyard to put to work here. But when you talk about maybe the costs of all of these things too, we've talked about home costs rising, input costs rising. What have you seen on that front that may have changed, some of the math behind people looking to add these?
Yeah, we've been able to do a pretty good job of not having to raise prices in the face of a lot of the commodity increases that we've seen. We've been able to stay ahead of that, work creatively with our own supply chain. But I think you get at a good point about these units as a solution to housing pressure. We're seeing that in a lot of our most popular communities. We see this as a real solution to a lot of housing crisis issues. Communities are embracing this type of structure as a lower pressure way to alleviate some of those housing issues compared to like multifamily infill. It's a gentler way to increase housing density to get more people into communities, and so it's a really exciting thing to be a part of on that level.
And Jeremy, what does the growth trajectory look like for the company right now? We talked so much over the last 18 months or so about so many homeowners spending money on home improvement. It feels like that's kind of slowing down because people are getting outside of their homes. What have you seen over the last several months in terms of the ability for that kind of growth that we saw last year to be able to continue?
Yeah, it's a great question. We are seeing continued growth, and we're obviously mindful of some of the things that you just mentioned. I think that one of the things from last year is, we've been involved in this business for about 13 years now. And last year really was just an acceleration of a lot of trends that were already in place. And you're seeing a lot of companies embrace work from home on a more permanent basis. There are a lot of companies that are going to allow at least full to part-time remote work going forward indefinitely. And so we don't see that trend necessarily slowing down. I think a lot of people, spending all that time in their homes over the course of the last year have really reevaluated the needs, how to make their home work better for them. And that's what we're hearing from our customers. And, we're seeing really continued strong growth on the heels of last year.
Yeah, around $20,000 for some of those studios I'm looking at here, and not terribly high for maybe someone looking to venture into it. Very interesting option out there. But Jeremy Nova, appreciate you coming back on. Studio Shed co-founder, Creative Director. Thanks for the update there. Be well. Going to take another quick break here on the show. We'll be back right after this. Welcome back to Yahoo Finance Live. Got the Dow near session lows right now, off nearly 300 points, the biggest loser among the major three indices today. I also want to check in on the action we're seeing continue to play out in Robinhood shares, briefly halted due to volatility, popping quite a bit, building on yesterday's big gains, now at more than 40%, at one point approaching $85 a share here, sitting at 66.36. Of course, the IPO was in the high 30s. So above that now, well above that now, we'll continue to track the action, see what happens here as perhaps the birther of meme stocks now becoming one in today's session. We're back in 2 minutes time, though, with a look at more incentives for employees to get the vaccine. We'll break that down on the other side. Stay with us. Welcome back to Yahoo Finance Live. Today's hot takes. Another company jumping on the bandwagon here, perhaps the boat, if you want to call it that, in providing incentives for employees to get the vaccine in this pandemic. Vanguard, the latest, offering $1,000 to any employee who can prove they got vaccinated. And Akiko, that's a bit of a step up from some of the earlier incentives we've seen from other employers out there, including the likes of some of dollar stores. But $1,000 is a lot different approach, I suppose, than what we're seeing lately from some tech companies, other companies out there in mandating the vaccine. But what do you make of that?
Yeah, I'm not sure I like this idea that everything needs to be incentivized. And if we're talking about the vaccine, you could argue in the simplest terms, if it's about protecting others and protecting yourself, that should be incentive enough. Now, having said that, there are clearly businesses that have been struggling to get their employees vaccinated, to be able to open up their stores or open up their offices in a way that employees feel comfortable. And so if it is about that, $1,000 goes a long way. And I'm thinking to companies like Walmart, for example, who have mandated vaccines for corporate employees, but not their hourly employees in stores. Of course, we were talking the other day, Zach, about how that's going to be challenging for a company like Walmart because they're already struggling to get new employees through the door. If you dangle the $1,000 in front of them, in addition to the other incentives to get them on board, I mean, what's not to say they're not going to get the vaccine? If that's what it takes, maybe it's something companies consider.
Yeah, and I mean it's not just Vanguard. We've talked about other rivals in that space potentially also looking to do the same thing. BlackRock saying it's not going to allow unvaccinated employees back into the office. So that's kind of you can look at whether or not it's an incentive or disincentive here. But it is interesting to think about $1,000 and kind of how other workers have been rewarded with far less. You start to look at vaccination as maybe it could be argued that it's hurting inequality in the country too. And you think about that, we already know the pandemic has been hurting inequality and different groups obviously impacted a bit more, but interesting to see kind of the broader impacts once we step back and look at this maybe years down the line, what kind of incentives helped or hurt in kind of trying to get everyone vaccinated. Of course, this is kind of where we're at is what it's going to take to get more and more people vaccinated. If you add it up, if you're a Vanguard employee, Kiko, in New York, you don't only get the 1,000 bonus here, you also get that 100 from New York City as well. So you can start to add all these things up, incentives building on each other now.
Yeah, I mean, is it the $1,000 you think that finally gets somebody vaccinated? Is it the potential of not being able to get into a bar, for example, where you say, okay, now I've crossed the line, I need to go out and get vaccinated? I mean, I guess it depends on the person, but money speaks volumes. I hate saying that, but it does. And while we're talking about an asset management firm, I do wonder if some of other companies who have hourly employees, whether they are going to have to start dangling some of their incentives in order to make people feel comfortable to go. So a debate that we're going to continue, of course. But I don't know, Zach, which one would you choose? We're both vaccinated, by the way. We should let our viewers know.
Yeah, I took the benefits there of just, this was before all the incentives really were starting to get talked about. The benefit to me was just, as we've discussed with many doctors on our show, probably if you're going to get it, you can either have your defense in line that's been proven or you can't. I chose to have the defense in line and protect the people around me as well. And I still got it. Still felt good after it. So, there you go. Everyone's decision out there, incentives aside or not. That's going to do it for Akiko and myself on today's show. We got much more coming up after the break to continue our coverage throughout the session as we still keep our eyes on the broader market, the Dow in the red as we go to break.
6, 1, and stand by and go.
Hello, everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous here with my co-host Kristen Myers, and here's what's happening. Treasury Secretary Janet Yellen makes a big push for President Biden's economic agenda, telling a crowd in Atlanta that his trillion-dollar infrastructure bill is key to maintaining America's status as the world's superpower. The FDA could grant full approval to Pfizer's COVID-19 vaccine as soon as Labor Day. The two-shot vaccine is currently cleared for use on an emergency basis. Full approval by the FDA could push more Americans to get the shot, which health experts say is critical to eradicating the virus. And a reprieve for millions of Americans as the CDC issues a new ban on evictions across most of the country until early October. The former ban expired last month, even as some 11 million Americans continue to be behind on their rent and the Delta variant surges. On Wall Street, stocks coming under some pressure here after a disappointing report from the private payroll company ADP showing a labor market still struggling to recoup all of its pandemic-era losses. And Kristen, looks like that's offsetting another batch of strong earnings reports today.
Absolutely, Alexis. And I'm very glad that we have those numbers up there because as you can see, those ADP figures did come in at less than half of those consensus estimates. As you can see there, 330,000 private payrolls added in the month of July compared to the 690,000 that economists had been expecting. Now, this, of course, has put pressure on the S&P 500 and the Dow right now. We are seeing a bit of a mixed bag, however, as the Nasdaq is the only major index right now in the green. However, hovering right at that flat line, only up about 22 points right now. Since it is in the green, let's just check out some of the leaders and the laggards in that index. Let's start with some of the leaders right now. As you can see there, Moderna, AMD, and Zoom doing quite well. Moderna right now up over 7%. Activision Blizzard, I'll be talking about them in just a moment, doing quite well as well, up right now about 3%. Let's just quickly check the flip side for some of the laggards right now in that index. We are seeing Amgen, Match Group down almost 6%. Kraft Heinz also in the red right now, down over 5%. As you can see there, Marriott down over 3% right now. On a sector basis, we've got a lot of red across the board. Only a couple sectors right now in the green. Should be no surprise here. We are seeing tech in the green, up about 1/10 of a percentage point. Health and communication services also doing well right now. On the flip side, however, energy is the laggard, down over 2%. Of course, we'll be hearing from Jared Blickery in the next hour as to why that sector is getting hit. Consumer staples also in the red, down over 1% right now. Let's just check out some stocks. I want to start first with CVS. We did see some beats on both top and bottom lines. However, the stock is coming under some pressure. The company did also announce that their same-store sales did better than expected, and the company making an announcement as we see some of the labor shortages going on right now. They will be boosting the salaries of its minimum wage employees to $15 an hour. Now, we do have Yahoo Finance's Seville Marcellus joining us in this hour to give us a little bit more details on that. Let's talk Activision Blizzard right now. It is in the green. As you can see, they're up about 3%. Now, this is a stock, Alexis, if you remember, that has come under a lot of pressure lately, especially as we see some lawsuits filed against the company alleging racial and gender discrimination and harassment. But at least right now, it is all about that quarterly earnings report. We saw a beat on both top and bottom lines for the video game maker. Now, Activision Blizzard did strike a very optimistic tone in its forecast and says that it's going to continue to see strong demand in games like Candy Crush and Call of Duty. And I want to note, we actually will be hearing from the CEO of the video game components maker Corsair in the next hour. We'll be chatting about the video game outlook, especially as we come out of the pandemic. Let's just head over and check out Lyft. Did report quarterly earnings, and it reported smaller than expected losses and better than expected revenue, as we've been seeing strong demand. And I think anyone that's ever tried to book a Lyft or an Uber lately knows about some of the driver shortages and the strong demand that we have seen. So no surprise there that that was reflected in the quarter. That stock coming under pressure right now, really getting hammered, down over 8%. I want to head to the newsroom right now where we have Yahoo Finance's Jared Blickery standing by for a look what's moving the markets today. Hi, Jared.
Hi there. Well, you're talking about all the red. I want to start out with a stock on the Wi-Fi Interactive that is in the green in a really big way today. That would be Robinhood. Kind of the story of the day, besides those disappointing payrolls numbers that we saw this morning, up 41%, but it was up much more earlier. Let's just take a quick look at a 5-day chart going back to its IPO, and you can see we had a nice breakout yesterday, but it pales in comparison to what happened today. And this is the first day where we have options trading. That's very relevant because there's kind of a feedback cycle. When people buy options, that means they're buying potentially the underlying with leverage. And then the other people on the other side of that trade have to buy the underlying stock to hedge it. So this feedback mechanism shot it up, I would say, over $80 per share. We had a couple halts, and now it has come back and it's trying to find some support and making its second leg up. We've seen this before with meme stocks. Now, I want to move on to General Motors. This is a huge miss. They missed on their bottom line today, EPS coming in at $1.97 a share. The estimate was for $2.08. Couple of things contributing to this. Their margins were not the best. We know they have a supply shortage with chip stocks, but they also made investments in Stellantis and the EV startups, Lordstown Motors and Proterra. Those are not working out so well. Also, they have fires in their Chevy Bolt's EVs battery, and they have to do a related recall. That's going to cost them $800 million, and that's chipping away at $4.1 billion in earnings. Now, they did raise guidance, but it's kind of tenuous. It's going to depend on the COVID situation, and the bottom line is we haven't seen a drop in GM like this for about over a year, going back at least to the beginning of January of 2020. Now, there is another stock in the green. In fact, there's an entire sector in the green. That would be the chip stocks, and that's what I'm looking at right now. You can see all that green. Dark green is AMD. That stock has been on a tear. But the one moving today that I'm focusing on is Microchip. They just announced their earnings. Let's take a year-to-date look at this stock, and you see pretty choppy action here. They are tied, or they are affected by the same supply issue in semiconductors. They're trying to make them, but they have their own supply issues. And also, as the world kind of responds to the COVID surges, it could be challenging for them in the near future. Now, here's what Morgan Stanley is saying. They hold the stock with an overweight, or they recommend it with that, and they move their price target up to $190 from $177, saying the results demonstrate strong demand trends amid well understood supply challenges. Gross margins continue to surprise to the upside, while supply constraints are likely to remain into next year. So nice to see the chip stocks in the green, but not many other sectors and industry groups are responding similarly, guys.
All right. Thanks a lot, Jared. For more on the markets now, I want to bring in Cameron Dawson, Chief Market Strategist at Field Point Private. Cameron, good to see you. I want to actually start with what many believe to be the big catalyst for the market this week, and that's going to be Friday's monthly unemployment report from the government. That ADP report today from the private payroll company was not a great precursor to that report, coming in lower than expected. What are your expectations for that jobs report?
Not just even lower than expected, but half of where we were just in June. And when you peel back the layers of the ADP report, we can see that there were only 8,000 jobs added in manufacturing, despite manufacturing employers saying constantly that they can't find employees. And then in leisure and hospitality, we saw the lowest number of jobs added really since February. So you're right to say, what does this mean for Friday? And the question will be, if we continue to see ADP be lower than what we see in the non-farm payrolls, as well as as well as if we move to what will be bad news is bad news or bad news is good news. If bad news is bad news, what we'll see is the market react to underlying weakness in the economy, or bad news is good news, which means that this just means that the Fed won't be raising rates or tapering anytime soon.
So Cameron, I also want to talk about some risks here, which is the Delta variant. Some folks concerned that it could potentially weigh on the labor market going forward. We have seen investors selling off over concerns about the surges of the Delta variant around the country. How much of that do you see presenting a downside risks right now to the markets?
So we think that there are three things to watch with Delta, which is that the first one is we actually haven't seen Google mobility trends move lower in the places where the Delta variant has been the most resurgent. So that actually is good news. We also saw the report that 60% of American adults have had their first vaccine. That's also good news. The last one is that we saw the peak in the UK cases on the 7-day average for the Delta variant the day after their so-called Freedom Day. So this means that we might have another month of issues where people start to taper their behavior and wanting to go outside, but it does spell better news that this shouldn't be as much of a negative event as the earlier surges in cases that we saw last year.
You know, Cameron, a lot of the market strategists we've been talking to lately are looking outside the US and actually finding some opportunities in European markets right now.
Wow.
You say it's not time yet for international. What do you mean by that?
So this has been a very popular call this year to say it's time to move international based on things like cheaper relative valuations or the fact that performance has been just so weak in these international markets from both an economic basis and a catch up on economic performance, as well as just the fact that they've been underperforming for 15 years. But what we do is we plot these markets, both the international developed and emerging markets versus the US. And we find that we've actually been making new relative lows in recent weeks versus the US. So even though it's tempting to step in and be an early contrarian, until we see that relative performance start to turn, we think that we are still in a confirmed relative downtrend and that there really isn't much of a rationale to start and step in and be early and just try to catch the very beginning of the turn. We'd rather wait for confirmation and make sure that we're not getting caught in a value trap.
So where are you really seeing opportunity right now, Cameron, especially as you are anticipating some volatility going forward throughout the summer?
So it's interesting to see that some of the more defensive areas of the market are starting to outperform, such as healthcare stocks are doing better. And we're also seeing better performance out of lower volatility stocks. We think people are anticipating higher volatility as we move through the summer and into the fall, but we would look to those areas for opportunity. We've really liked dividend stocks all year as well, mostly if you have an expectation that forward returns will be lower. We know that forward returns typically are lower when you're coming in at high valuations. So to focus on your dividend and those companies that have the ability to grow their dividend and have it supported by strong free cash flow is something that we find very attractive. And this is all consistent with being in the second year of a recovery. If we think about how we were coming out of the bottom in 2020, growth stocks did well because growth was scarce. And then value stocks did well because we were repricing all of the depths of the issues with credit. Now we're in that middle phase where we think quality is really where you need to focus.
All right, Cameron Dawson, Chief Market Strategist at Field Point Private. Thanks so much for being with us. Coming up next, the FDA looks to give final approval to Pfizer's vaccine as early as Labor Day. We've got the details for you right after this.
Welcome back. The FDA is speeding up its full approval process for Pfizer's COVID-19 vaccine, while those that are vaccinated with the Johnson & Johnson vaccine can now get a booster dose of Pfizer or Moderna, at least in San Francisco. So let's chat more about the coronavirus pandemic. We're joined now by Dr. Ali Raja, professor at Harvard Medical School. Doctor, great to have you here with us. So I'm curious to know if you think that this full FDA approval, at least of Pfizer's vaccine, is really going to help perhaps allay some of the fears that we are still seeing amongst the unvaccinated.
Kristen, I really think that it will. I'm fully supportive of this. I've got to tell you, every day in the ER here, and I hear about this all over the country from my friends and family, there are still people who are really hesitant to get the vaccines because of the fact that they're under this emergency use authorization. So this is going to definitely help them be convinced to get vaccinated. The other side is there's also some workplaces like the hospital in which I work that are waiting until FDA approval to put vaccine mandates into place. So it'll help there as well. Quite honestly, our patients should feel that they're safe when they come to us for care. And this, along with the masking policies we already have in place, is really going to go a long way to making sure they're as safe as possible.
Doctor, we also learned today that the World Health Organization is now calling for a halt on COVID-19 boosters until at least September, because they say they want to make up for a shortfall of vaccines in poorer countries. What do you make of that recommendation by WHO?
Alexis, I completely agree with it. I've got to tell you, we are running into this Delta variant because of the fact that it developed and it mutated in countries that didn't have vaccination rates like ours, predominantly because of the vaccine not being available. Yes, we may need boosters here, but one of the reasons that we will is the development of future infectious variants. And those variants are going to keep developing unless we help low-income countries that don't have the vaccine get their populations vaccinated.
Another population that hasn't yet been vaccinated is children, at least those under the age of 12. We're about a month away now from the start of the school season. What are you anticipating to happen come September and even October? You know, once we see students back to school, some states like Florida saying that they are not going to require their students to wear a mask while in school. Some states, however, are implementing some of those mask mandates for those that are unvaccinated indoors. What are some of the fears here, and what could potentially happen, especially as we have this Delta variant surging?
Well, Kristen, it's a great question. I've got to tell you, this really hits home with me. I've got two young kids, one's 7, one's 9, and they're too young to be vaccinated. So for the third school year in a row, they're going to be really affected by this. And they're going to be wearing masks. I want them to wear masks just because of the fact that we're seeing, with Delta specifically, we're seeing younger patients get infected and get hospitalized just a little bit more than we did with the earlier variants. What I'm really hoping for is that when we start seeing good data from the Pfizer vaccine, from the Moderna vaccine, from the J&J vaccine, hopefully, that it's safe, that they're safe in younger patients. I'm hoping that those data show that they are safe and that we can get our children vaccinated, because honestly, they need to be in school in person, but they need to do so safely, which is going to be wearing a mask right now.
You know, Doctor, yesterday we had the CEO of Henry Schein on. That's a medical equipment manufacturer. And he was talking about the hesitancy on the part of some people to get vaccinated. And he said he believed that your own primary physician's recommendation as to whether or not to get the vaccine was the biggest part of people's decision-making process. Have you experienced something similar?
I really have. I have to tell you, it's interesting. As an ER doctor, I meet people for the first time most of the time when they come to see me. And I have to build that rapport very quickly over a matter of minutes. I have to get to know them well enough so that they're willing to trust me just as much as they do their primary care doctor and tell me everything about why they came in. And I find that even with that brief period to build rapport, I can often convince patients who haven't been convinced by anybody else to get vaccinated. Now, I can only imagine that as a primary care provider, I might even be able to do that even more so. But I do agree that primary care providers, any doctor with whom patients are connecting, they're really the key. We're really the key to getting patients convinced to be vaccinated.
Doctor, I don't know if you are a music buff or if you enjoy going to some of these music festivals, or if you've even just seen pictures of Lollapalooza. I wish we had some of the photos to show right now of the music festival in Chicago's Grant Park. But folks were literally crammed together by the thousands. I felt uncomfortable just looking at the photos, frankly, but everyone was supposed to be vaccinated to attend that event. So as we are reopening right now and folks are heading back to Broadway, going to restaurants and heading to some of these events, even if you are vaccinated, is it safe, even if outdoors, for thousands and thousands of folks to be crammed together, even if it's outdoors and even if they are vaccinated? Is that safe right now?
It's a great question. The fact is that it really depends a lot, Kristen. If you're going to an outdoor concert that's on the lawn and you're fully separated out, I think it's perfectly safe. I think that if you think about what New York City is doing right now, where they're implementing, honestly, a vaccine mandate to go indoor and see a Broadway show or eat at restaurants, I think that is safe. I think that something like Lollapalooza right now, quite honestly, from what I remember of Lollapalooza long ago, you are right in each other's faces. You're crowd surfing. Everybody is all over everybody. And even outdoors, that's just not safe right now.
All right, we're going to have to leave that there. Dr. Ali Raja, professor at Harvard Medical School, thank you so much for joining us today. And coming up next, we'll be talking about one of today's trending tickers. I talked about it at the top of the hour. That's CVS. We'll also be discussing how they plan on boosting employee salaries. That's next.
CVS Health posted second quarter results this morning that beat analyst estimates on both the top and bottom line. Company even raised its forecast for the year, but the stock is lower this morning anyway after the drugstore chain said it will focus on making investments for future growth instead of doing things like increasing dividend payments or share buybacks. CVS is also taking steps to attract new workers as retailers compete for talent. Yahoo Finance's Sabeel Marcellus here now with some more details. So what are they doing, Sabeel?
Alexis, they're raising wages and dropping educational requirements. That's how CVS is competing in this fierce battle we're seeing right now when it comes to restaurants and retailers, all trying to hire low-wage workers and trying to boost wages to bring them in. Now, one of the reasons that was cited oftentimes was that because of the enhanced federal unemployment benefits, that was a reason why people weren't coming off the sidelines and back into the labor force. But in some states, that has been stopped, and we're still not seeing a spike in those jobs being filled up. We're still hearing tons of complaints about these employers wanting to attract more workers. Now, President Biden has said that if they do want to attract more workers, they just need to raise wages. That's the key. That's the secret. That's what CVS is doing. So what CVS has is their starting wage is $11 an hour, but 2/3 of their employees are already making $15 an hour, and they plan to raise the minimum wage to $15 an hour for all employees by July of next year. So they're playing a little bit of catch up there. And also when it comes to the educational requirements, so this is what CVS is dropping. When they're recruiting for workers in colleges, on college campuses, they are dropping the GPA requirements. And then when it comes to the hourly workers, what they're dropping are the high school diploma requirements. So we're seeing CVS really pulling out all the stops. The ambition of CVS is to go beyond just being a pharmacy, but to actually be an urgent care center. So provide more medical services to customers. So for that, they need a much more robust labor force.
We'll see if that's going to do the trick, if they're going to be able to entice those workers. All right, Sybille Marcellus, thanks so much. Federal Reserve Vice Chair Richard Clarida is offering a timeline for an interest rate hike. We've got Yahoo Finance's Fed correspondent Brian Chung here now with more on what Clarida had to say. And I know he also made some comments about inflation today, Brian. What did he say exactly?
He did all that wrapped together in what is a pretty comprehensive summary of how the Federal Reserve is thinking after its meeting last Wednesday, where it held interest rates steady at near zero, but hinted that a taper could be coming soon. As you mentioned, the Federal Reserve Vice Chairman Richard Clarida saying that he could see the case for beginning the tapering process again of the Fed's asset purchases as soon as this year. And he also suggested that interest rate hikes could be coming as early as the beginning of 2023. All of that hinges on whether or not the unemployment rate gets to the 3.8% level that he feels would be close to maximum employment. Keep in mind, right now we're at 5.9%. But one major caveat to all of this is that Richard Clarida actually may not be a member of the Federal Reserve all that longer. His term is set to expire in January of 2022. But that may not stop what we've already seen from the Fed's dot plot projections, which we got 2 meetings ago from the FOMC, which shows a number of the 18 members on this committee seeing the case for interest rate hikes by the end of 2023. You can see that actually 13 of those 18 members see at least one rate hike by the end of that time frame, and the median member of that 18-member committee sees at least 2 rate hikes by the end of that time horizon. So it seems like even though Clarida is offering his remarks, it doesn't necessarily change the fact that the Fed, at least for right now, could see the case for interest rate hikes not long from now.
All right, Brian, I want to pivot from the Fed and go over to the Treasury. You were here just a couple days ago talking to us about some of the extraordinary measures that the Treasury was looking to implement because of Congress not passing any legislation about that debt ceiling. What's the update there?
Yeah, well, some remarks that we got from the Treasury Secretary and former Fed Chair Janet Yellen. She was speaking down in Atlanta. Most of her remarks were focusing really on the infrastructure bill that is still undergoing construction, no pun intended, on Capitol Hill. She was saying that really this is the bill that's going to get the economy and the productive capacity of the economy in place. And she was saying that things like childcare, training programs, fixing transit and roads, high-speed broadband internet are all major priorities that she feels like could get the economy to a higher level of GDP in the future. I want to read you a quote of what she said in those remarks earlier this morning. Quote, "There is a good faith discussion about how much spending is too much, but if we are going to make these investments, now is fiscally the most strategic time to make them." And those particular remarks are the connecting point between what Yellen is saying to what the Federal Reserve is doing right now, which is pinning short-term interest rates at near zero. Even on the longer end, 10-year borrowing costs around 119 at a benchmark, 184 basis points on the 30-year, which shows that really because of the Federal Reserve and other measures like that, now is the time to be issuing government debt and spending to make sure that they can get this infrastructure bill through.
All right, Brian Chung, thanks for the wrap up. Appreciate it. And coming up on Yahoo Finance Live, we speak with the co-founders of the space startup Varda. We're back after this.
Welcome back. Let's chat about space now, because the startup Varda is on a mission to build the first space factories. We're joined now by Delian Asperhoff and Will Brewy, Varda Space Industries founders. Let's start with you, Delian. I'm curious to know why the desire to produce products in space. How is it better perhaps than manufacturing right here on Earth?
There are certain really high value materials, everything from semiconductors, fiber optic cables, pharmaceuticals, that have shown lots of promise on the International Space Station over the past decade. Plenty of research has shown they can produce higher quality, lower defect versions than what you can down here on Earth. But you just can't scale those commercial supply chains on the International Space Station. That space station is set up as a research institution run by many multinationals, lots of bureaucracy. And so Varda is primarily focused on taking that research and work that's been done on the International Space Station and commercializing it in a near term and much more pragmatic format, where we're just building a sort of miniature, small, satellite space factory, sending it up into orbit, fabricating the materials the same way that they are on the ISS, and then bringing those materials back down. And so while it's exciting to see folks like Branson and Bezos and hell, even Musk now has, this fall, a documentary coming out with Netflix doing sort of space tourism, that's still only really bringing the value of space to a very small segment of the commercial population. What Varda is focused on is bringing the value of space, i.e. the microgravity, to a much wider population. And so we're really excited to be helping unlock the value of space to a much larger set of people, and are very grateful for all of the infrastructure that's been built over the past decade, like the SpaceX Falcon 9, like Rocket Lab and Astra, which are about to SPAC and go public. We're only possible because of this prior decade of work that has made all of these costs so much cheaper.
Speaking of which, Will, I know that you spent much of the past decade working on SpaceX's Cargo Dragon spacecraft. And I understand that some of your employees even came from SpaceX. What does your former boss, Elon Musk, have to say about that? And has he talked to you about your current venture?
No, thanks for having me. No, he hasn't spoken with me about it. I think he would be happy that in the fact that Varda is kind of the elasticity in the market that is responding to a order of magnitude drop in launch costs. When we were at SpaceX, we loved it. I still love my time at SpaceX, and we always worked on reusable rockets and the enabling capability that is. And just one of many things that reusable rockets enables are manufacturing in space and companies like Varda.
So, Will, let's just continue with you here. We just heard from Delian a moment ago mention costs. Curious to know what the cost of manufacturing in space would be, and then bring some of those goods back home here to Earth.
Sure. I don't want to dive into the exact unit economics because that does contain some of our secret sauce, but it's pretty lemonade stand business model. We build the factories, we buy the raw materials, we ship them to space, and then we recover them and sell them. So there's no miracles required, and there's no kind of anything enabling for our technology other than better unit economics thanks to a thriving space economy.
I like that, likening what you're doing there in space to a lemonade stand. If only it were so easy. Listen, Delian, I know that you guys founded this company a short 8 months ago. You've already raised some $53 million. No small feat, so congratulations there. I'm wondering if that's enough money to get you through your first mission, and if you can share with us who some of your investors are.
Yeah, so we went around the table and made sure to bring together some of the top tier venture investors. So on our cap table, we have Founders Fund, who are one of the primary backers of SpaceX, Coastal Ventures, who are one of the primary backers of Rocket Lab, Caffeinated Capital, who are one of the primary backers of Boom Aerospace, and Lux Capital, who are the primary backers of Relativity. And so we wanted to go out and get a very sort of deep capital pool from everyone involved in some of these really game-changing, innovative aerospace companies. And again, these infrastructure costs have just gotten so much lower. A company like Varda a decade ago, we would have had to build the rocket, build the satellite, we would have had to do entirely everything in-house. Would have probably taken $1 billion to even just do a single demonstration mission, versus our initial mission will probably actually only take us maybe $24 million. And so we've actually raised enough to not only be able to do our first mission, but to potentially skate even to our second, more ambitious second mission and larger space factory. And so it's truly incredible sort of what this dropped infrastructure costs from companies, everything from SpaceX to Blue Canyon Technologies to even public companies like Maxar and Iridium. Just the fact that they've scaled up their satellite constellations has made it so that even simple components like a flight computer on a satellite or a solar panel are just so much cheaper. And so when people think about why are space factories possible, it's not just the reusable rockets. It's that all of these parts of space have just become so much more high volume, so much more commoditized and consistent. A decade ago, satellites were sort of science projects done by governments. Now, so many satellites are sent up every day, you can actually basically just buy a satellite off the shelf. And that's what enables Varda to be possible. We just focus on what we're good at. We buy the satellite off the shelf. We buy the rocket launch off the shelf. We just focus on the zero gravity manufacturing and then bringing those materials back down from orbit, back down to Earth onto land. And that is only possible because of all the work that's been done over the past decade.
And of course, you guys have already done so much in less than a year already. How quickly do you think that you'll be able to have that first factory going? When is that first mission going to be? Do you have a target date in mind?
Yeah, our target date is the first half of 2023. And the reason for the rapid development is because we know we have to take the most pragmatic approach just in order to be a realistic business, but also to appease investors. And so that timeline allows us to really focus on pragmatism and no miracles required from a technology perspective.
You'll see a lot of space companies end up going out and raising hundreds of millions of dollars before they actually even get their sort of first product to market or get into orbit. We've been really focused on, and I think why we're seeing so much investor excitement customer excitement from the DoD, it's because we're taking a very near-term, commercially pragmatic approach. We're not talking about 7 years away or something like that for a space factory. We're talking about 18 months from today, being able to produce those first materials in orbit and bring them back down. And most of our customers down here on Earth, they could care less about us being a space factory company. They just like the materials that we're bringing down because they're better than any material that they've seen on Earth because, well, it's not possible down here on Earth. And so I think that's why you're just seeing so much enthusiasm and momentum across both the investors that are involved, the talent that Will is bringing on board, and so many of his ex-SpaceX colleagues being so excited to join, is seeing that this is something that's going to launch in 18 months, not in 5+ years.
Will, just break this down for the average person. What kinds of things are you bringing back down to Earth? And also, if you could just speak to how you're going to re-enter with that first mission. When you re-enter the capsule, it's going to happen over land, not water. That was a little surprising to me. So sort of a two-parter there for you, Will.
Sure. The first initial products are similar to we kind of think of it like the App Store, in the sense that we're providing a microgravity as a service to our customers. Like Delian said, they don't really care that we're going to space. What they care about is that we can fundamentally change one of the major laws of physics, gravity, which all engineering is built atop of. But since that capability doesn't exist, much like the App Store didn't exist at one point, we have to design our first few products in-house to kind of show the value in much the same way Apple wrote the first few apps for the App Store. As far as re-entry, that is also part of our secret sauce, but I will note that we are landing over land, and the purpose for that is unit economics. I tell the team, every week at our all hands, that we will know we are successful when we can go camping and see every once in a while a shooting star come across one of our capsules coming back in much the same way as a semi-truck would come back from an industrial park.
All right. I wish we could talk to you both even longer. It is absolutely fascinating. We want to hear more about that secret sauce, Will, so hopefully you'll have to come on back and give us some more insight. Delian Asper-Rahaf, Will Brewy, founders of Varda Space Industries, thanks so much for dropping on by. And coming up next after the break, it's our Funding Our Future segment. We'll be discussing how inflation will impact financial security for Americans going forward. That's next.
In this week's Funding Our Future, we look at rising inflation and what it means for people's financial security. Joining us today is Jim Kessler, Executive Vice President of Policy at Third Way. Jim, good to see you. You know, earlier we had our reporter on breaking down what Fed Vice Chair Clarida said today, that the U.S. economy is on track by the end of next year to meet employment and inflation hurdles that the Fed has set to raise interest rates. What impact do you think that's going to have on the average household?
Well, I think for a lot of households, you know, inflation is going to be fairly benign because wages are keeping up with it. And, you know, if you're a senior citizen, for example, and you're living on Social Security and fixed income, inflation, there's cost of living adjustments, so that theoretically keeps up with inflation there, but some of the other fixed income that you might have doesn't keep up with it. But, you know, I think right now we need to be watchful on inflation, maybe not so much worried about it. It seems like the Fed has got things pretty much well under control. The 10-year bond is in pretty good shape. And, you know, we're in this Rip Van Winkle economy where the transition of waking up from it is creating some anomalies that I'm not sure are really going to last. Rental car inflation, for example, and used car inflation, that's just not going to affect that many people. So, you know, I think it's going to be episodic for folks.
You know, Jim, I know what you're saying here, that inflation right now is something really to watch and to monitor without being too cautious or too worried about, at least right now. And we have heard the Fed say repeatedly that inflationary moves right now are transitory. So they're going to be temporary. However, we have had a couple of folks on this show that have talked about the durability of inflation and say that it might not be as transitory as some folks think, and have defined transitory to really be holding out a lot longer than we originally had indicated. So at what point does some of these inflationary moves really become a concern for most Americans?
Well, I think for some Americans, it's already a concern because they're seeing certain things that they are paying for, you know, go up in price. And, you know, if you were doing home remodeling, suddenly, like if you're buying something for your house, it seems like the prices went up, and there was a period where your gas prices went up. So there are places where consumers, they're very much in tune with it. But I also, you know, we're also facing a situation where the Delta variant is showing up, and that might put a damper on the economy moving forward, because the roaring economy that we've experienced in the last several months might slow back down, and that's going to change the calculation again. And, you know, we just have to realize that this is a very unique economy that we're in. The recession was essentially a medically induced economic coma. We're coming out of it rapidly, and now we've got another wave of COVID, mainly because people aren't getting vaccinated in lots of parts of the country. And that could have an impact too that will put a damper on inflation. So we're in a very unpredictable situation right now.
I know that Congress has got a big plate in front of it right now. Lawmakers working on passing the bipartisan infrastructure package, and it's going to be on to the budget and budget reconciliation. What are your expectations for that, and how might that impact everyday Americans?
So the bipartisan infrastructure bill is making its way through the Senate. My expectation is that it will pass the Senate on Sunday, and then it'll go over to the House. There's going to be a lot of consternation in the House because while the Senate moved on in a bipartisan way, the House really moved in a Democrats-only package. I expect it will pass the House, but there will be periods over the next week or so where it's going to look like it's all falling apart. That is part of the drama of Washington. That's going to move forward. Good for the economy, good for jobs, good long-term for economic growth and wages, and good long-term on climate. Then we're going to move to budget reconciliation. That is the next package. That is Democrats only. Their ceiling on that package is $3.5 trillion over the next 10 years of new spending and tax cuts and et cetera. That is a ceiling. That is, you know, and that is a target by some, but I expect that number will come down. And that package also, it's going to be paid for. what we spend in new programs and new tax cuts are going to be offset by some spending cuts, savings in other places, and tax increases in other places. So it's going to be close to a net zero in overall government spending, with some of the usual government congressional trickery on how you score revenue increases and spending that well. But it will roughly work itself out. It's going to be a package that has a lot of benefits for people who are middle class. There'll be a child tax credit, the $300 a month checks that will go to working parents, under, income of basically $150,000, and other elements as well. There'll be tax increases on those who are wealthy.
All right, Jim, we're going to have to leave it there. Jim Kessler, Executive Vice President of Policy at Third Way, thanks so much. And a reminder, Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Coming up, will you soon be able to wipe out student loan debt in bankruptcy? We've got the details for you coming up.
A bipartisan bankruptcy reform bill aims to let borrowers do something that they could never do before, and that's discharge their student loans in bankruptcy. We have Yahoo Finance's education reporter Aarti Swaminathan here with us now with details. This would be such a change and such a difference. Aarti, tell us a little bit more.
Yeah, so yesterday, Senate Majority Whip Dick Durbin, as well as Senator John Cornyn, noting these two because there was a bipartisan bill introduced in Congress to provide student loan borrowers with a fresh start. Because as far as we know, for the past, couple of decades, it has been such an impossible standard to meet just to get a bankruptcy court to allow you to discharge your student loans in bankruptcy. So you're basically stuck with it for how many years, right? We've heard of people in their 60s, 70s, 80s with student loan debt. But the reason why this specific bill is highly significant is because it allows student loan debt to be treated like any other debt, like credit card debt, like auto loan debt, but also it's a very palatable option for many people who are very averse to student loan forgiveness. We've heard of those proposals to cancel 50,000, 10,000. This is something that I heard yesterday during the hearing. A couple of Republicans actually said this is something that we would be willing to throw our weight behind.
All right, we're going to have to leave that there, but definitely some good news for some of those borrowers. Again, it was practically an impossibility before. Hopefully it'll be a lot easier now after those changes are made. Yahoo Finance's Aarti Swaminathan, thanks so much for coming on and giving us those details. That'll do it in this hour. Markets right now continue to be a bit of a mixed bag. The Nasdaq still in the green. We'll be keeping the market coverage going right after the break. And in the next hour, we'll be chatting with Andy Paul, CEO of the gaming hardware company Corsair, not just about their quarterly earnings, but also about the impact of the chip shortages on their business. That's after the break.
Hello and welcome to the 2 p.m. hour of Yahoo Finance Live. I'm Alexis Christophorous along with my co-host Kristen Myers. And here's what's happening. General Motors raises its profit outlook for the year, but the auto giant warns that the ongoing computer chip shortage and rising commodity prices will weigh on second half results. We have the latest for you. Plus, what does that computer chip shortage mean for the gaming industry? We'll speak with the CEO of Corsair Gaming, who's here to break down earnings. Corsair, by the way, has been a recent favorite among the meme crowd. And there's a new billionaire in town, and they don't hail from Silicon Valley. How music powerhouse Rihanna has gone on to become the world's wealthiest female musician. But first to the markets, where stocks are mixed right now. The Dow and S&P under pressure after a disappointing report from ADP, which shows private employers added just 330,000 jobs last month. Wall Street was expecting about double that. We've got the Dow off more than 260 points, the S&P down 12. The Nasdaq, though, bucking that downward trend, up now about 32 points. Want to hand it over to Jared Blickery, who's live for us in our newsroom. And Jared, I know you're going to start with GM. Tell us more about this stock's biggest drop in, what is it, 6 months?
Yeah, biggest drop, I think, of the year. And let's go to the Wi-Fi Interactive, where we can see on our automotive heat map, it is the #1 loser in the lower right here, down 8.6%. Now, this is a stock that had a nice pop at the beginning of the year. This goes back to January, and that was based on their EV plans. They had an investor day, and you can see it's up slightly since then, but kind of sideways trading action for the most part. Now, I just want to go over some of the key highlights. They did miss on their bottom line. Their earnings per share came in a little bit short of Wall Street estimates, and that's kind of a rare deal for them. One of the reasons they had made investments in Stellantis, Lordstown Motors, and Proterra, those have been not the best investments. EPS took a 12-cent hit from that. They also are spending $800 million on a recall for the Chevy Bolt's EV battery, and that's hitting their bottom line, $4.1 billion. So that's coming out of their $4.1 billion of earnings before interest and taxes. And they did manage to raise their guidance, but there's some doubt on the street that that's actually going to happen when realized because of the semiconductor shortage, which is still probably going to linger into 2022. That's what the CEO, Mary Barra, said on the call. Now, they could also face rising commodity costs. We got the Delta variant outbreaks, and this could result in more supply issues. They might have to shut down plants around the world. So the good news is they have pricing power, and their pickup trucks are minting money for them. So are their SUVs. They do have tight supplies, so that kind of eats into it. But they do have a rosier picture for 2022 and 2023. So that's what we're looking at right now. Again, the worst performing stock on our electric vehicles and components because, hey, they're an EV company, right, guys?
All right, Jared, let's head across the pond over to Europe because the EU has actually signed a contract for up to 200 million doses of a coronavirus vaccine. This one coming from Novavax. Tell us a little bit more of the details there.
That's right. And if you take a look at our pharmaceuticals heat map, lots of red, but there are some bright spots here, and that is the virus stock, the antivirus stock. So Novavax itself up 21%. I'm going to show that on the screen here. This is the jump that we're seeing today, kind of into this potential resistance area that it will have to clear, but a big 21% pop there. So this is going to be 100 million, 100 million doses of the vaccine up front with the option of an additional 100 million doses through 2023. And I have a quote from an EU commission. They said the decision was based on a sound scientific assessment, the technology used, the company's experience in vaccine development, and its production capacities to supply the whole of the EU. Now I'm going to go back to the heat map here and sort by performance. You can see the top line there, Novavax, BioNTech, Moderna. Those are the top three. All those vaccine stocks doing well. And I should say that Moderna is going to report earnings within the next 24 hours, guys.
Yeah, looking forward to that. Also, want to get to a Dow component, and that is Boeing. Jared, I know it's a big day for them. Their 737 MAX heading to China for a key test to finally end that flight ban. What do you know?
That's right. About 184 countries have approved Boeing for the return of the MAX 737 to the skies. And you're looking at our Dow heat map here. I'm going to pull up Boeing so you can see the price action, only down about 1%. Now, intraday, it did get a spike up on the news, but I guess we've given that back a little bit. So a couple of details here. It departed from 8 a.m. local time in Seattle's Boeing Field, and it's on its way to Honolulu as we speak. Now, usually it would take a shorter route around the Arctic, but it's banned from Russia. So that's one of the other countries where it's not currently allowed to fly. So they're going to fly around the equator. It's a longer route to China. Now, Boeing sent previously a delegation of around 35 pilots and engineers to China last month to meet with regulators, but China has not purchased or made any orders for any Boeing planes in years, and that has to do with the trade tensions there. So the 737 MAX is their big moneymaker. If they can sell some to China, that's going to be a huge win for them.
All right, Jared, let's talk now about Robinhood. I'm looking at it right now, up about 55% today, a nice pop over that IPO price, which is $38 a share. As you can see, they're sitting now at around $72. Jared, tell us more about what's happening with Robinhood.
Well, I got to say, this has been a fun stock to track today, and I've had my issues with Robinhood before, but look at this chart here. This is going back to their IPO. We had this big pop yesterday, and it's overshadowed by what's happening today. And a lot of this has to do with the fact that this is the first day that investors are able to buy options on the stock. And so that means that they're able to use leverage, and that's creating a virtuous cycle of volatility that we see here. So we got into the 80s. In fact, the stock was up over 80% at these highs, came back down. We've had several trading halts today, but we found some support around 60, just below that, and we are heading back up to 75. Now, I have some commentary from Bloomberg Intelligence, and they're saying that this intraday surge doesn't change the shaky fundamentals, and it compounds their concern about payment for order flow revenue through 2022, because their payment for order flow revenue dropped 34% in the second quarter. That's how they make most of their money. They sell your orders to Citadel and other market makers. They're also saying that the resurgent COVID-19 cases might keep workers at home and encourage day trading for a little bit longer, but we're not going to get back to those first quarter volume levels. And also, they got a bump from crypto. We know crypto's been mired in a bear market for some time, so they say it's a $30 stock. But I will say that they're talking about fundamentals here. And as this latest meme stock exemplifies, fundamentals don't always matter, do they?
No, they don't, sadly. All right. Thanks a lot, Jared Blickery. We'll talk to you a little later on for the commodities report. I want to continue our markets conversation now and bring in Christina Hooper, Invesco's Chief Global Market Strategist. Christina, it is good to see you. You know, when we've talked in the past, we've talked a lot about opportunities that you've seen outside the U.S. market. A lot of market strategists we've been talking to say they do see opportunity there. What are you looking at right now, especially given the sell-off we saw recently in Chinese stocks?
Well, certainly Chinese stocks look attractive. If we look at the PE ratios as of July 31st, they're more attractive relative to where they were a month ago, and they're also attractive relative to the global index, the MSCI World Index, as well as U.S. stocks. So it is time to start picking through and looking for specific bargains. Now, we want to do that in a discerning way. Given that China has enacted significant regulations, I would expect a more surgical approach that's communicated in advance. But we just need to recognize that there are going to be some winners and some losers, but it certainly looks like an attractive place to be picking up bargains.
Yeah, we've been hearing that a lot, how you have to go through this market to really pick out some of the bargains and some of the winners. At least here at home in the United States, where are you seeing some of those bargains? What sectors are you liking, and what's presenting itself as most attractive to you right now?
Well, I think cyclicals have legs in the shorter term. Although we know that can change on a day-to-day basis. Today, we got an ADP report that weighed down on markets because of concerns about growth. And that, of course, has been added to by continued concerns about the spread of the Delta variant. So there are going to be days where growth and more defensive names, larger cap names perform well. But I do think cyclicals in general should be the outperformers over the next several months. But at a certain point, we are going to see that handoff to growth, defensives, and larger caps as growth moderates.
I want to pivot for a minute over to the bond market, Christina, because I'm looking at the yield on the 10-year now at 1.18%. What do you think bond traders are telegraphing right now about where they see the economic recovery going?
Well, certainly there are concerns about economic growth, but I don't think it is centered on the US. Yes, we got a disappointing ADP report today, but I don't believe the labor market's going to normalize in the US until the fall when children are back in school and childcare is not such a big issue. So the 10-year yield, I think, is reflecting concerns about growth globally. And I do think there's a bit of fear out there because of what we're seeing with the Delta variant, especially for countries that have low vaccination levels. But that doesn't mean that we're not going to see solid growth. It just may not be as strong as one may have expected a month or two ago. So I think this is still a positive environment, especially when we're looking at U.S. growth.
But we are still seeing a bit of volatility. Just in the last hour, we were hearing about volatility could be expected through the summer and perhaps even a bit of a correction. So I do want to ask for some of the investors out there, how should they really start considering making some defensive plays, making some protective moves for some of those downside risks?
Well, we should definitely expect volatility. I think that is very likely this summer, given that we're heading into a period in which the Fed is likely to come out and announce tapering and then start tapering by the end of this year. So there are going to be at least small jitters attached to that kind of environment. And of course, we also have the Delta variant having an impact on a day-to-day basis when we get spookier headlines. So this is an environment in which we need to expect volatility, but I do think it's one in which we want to look for opportunities on the dips. So it's no different really than the opportunistic shopping we would do among China tech, but in the US. And I think defensives, growth, especially the tech sector, is likely to be more stable in the coming months.
All right, Christina Hooper, Invesco's Chief Global Market Strategist. Good to see you. Thanks so much. And a reminder that you can step up your investment strategy starting today with a free 14-day trial of Yahoo Finance Plus. You'll get expert research reports, some actionable investment ideas, also in there, advanced portfolio tools, and a whole lot more. It comes to you in a sleek ad-light experience. You can check it all out at yahoofinance.com/plus. Coming up, Uber out with earnings after today's closing bell. We'll get a preview on the other side of the break.
Welcome back. Lyft reported earnings and they beat estimates, though the stock right now is under a lot of pressure, down right now about 9.5%. And fellow rideshare company Uber is expected to report after the bell today. So let's chat about both of these companies. We're joined now by Angelo Zeno, Senior Industry Analyst at CFRA Research. Angelo, great to have you here with us. So I just first want your reaction to the Lyft earnings. I think it's always a question that so many folks have, why we see a stock under pressure after it does report a beat. It did report a loss. However, the loss was smaller than some analysts had been expecting. What do you think is causing Lyft right now to be in the red, down 9.5%?
Yeah, no, I mean, especially, following the reversal after hours where the stock was up sharply, right? So you look at the overall results, the Q2 results were absolutely fantastic, growing, 125%. The new active riders were a great figure out there in terms of 17.1 million. The fact that they saw adjusted EBITDA profitability, we think was a huge positive, a quarter earlier than anticipated. I think, and then when you kind of look at the Q3 guidance, also it was also above expectations, both on the top line of things as well as on an adjusted EBITDA basis. Now, why the stock is underperforming as much as it is, despite the better than expected results, I'd say, a big reason for it, I think, is probably because of the heightened investments that they kind of guided towards in the third quarter and likely even, potentially in the fourth quarter. I think a lot of people are questioning whether the number we saw in terms of adjusted EBITDA profitability is sustainable. We think it is. But there's clearly going to be some choppiness. Now, also, you've got the Delta virus kind of lingering out there, and the impact there kind of going into the winter months also could maybe be an uncertain factor out there for investors. But all in all, we do think the results were very good for Lyft, as well as a good indication for Uber ahead of the results tonight, at least in terms of their mobility business.
Yeah, let's talk a little bit more about what you're expecting from Uber. I know the street is still looking for another loss per share, but they are forecasting revenue to expand for the first time since the first quarter of 2020. So tell us what you're going to be looking for tonight from Uber.
Yeah, I mean, in terms of Uber, I think you kind of have to separate this into the two sides, right? In terms of the mobility side of things, again, we would, when you think about the ride-sharing market, at least in the US, it's about a 70-30 split in terms of Uber and Lyft. And I would anticipate that mobility would be a beat given what we saw out of Lyft's side of things. Now, clearly there's also a geographic difference between the two sides, but we do think the momentum remains very good geographically overseas. Now, on the delivery side of things, I think that it's more along the lines of the sustainability of orders. It's not necessarily whether or not they're going to see some significant growth. We do see some significant growth just because of the easy bar in a post-pandemic world. But I think it's all about, are they seeing some of that incremental growth in adjacent markets like groceries, as well as the momentum from acquisitions like Drizzly and Postmates that can offset maybe some of the lower order take rates that we're potentially going to see at a delivery side of things. But all in all, I would expect very strong results out of Uber. I think it's going to be more along the lines of kind of how they guide towards Q3 and kind of the commentary they provide in terms on the cost side of things as far as the supply constraints are concerned.
Angelo, I want to ask you about something that's been impacting both Lyft and Uber, and that essentially is a driver shortage. I have just noticed even recently, whenever I've tried to book an Uber or even a Lyft, that some of the prices are much, much, much higher than I would normally expect. I've had friends just anecdotally just say, listen, I'm not going to pay some of these higher prices on Uber. I'm actually going to go back to taxis, believe it or not. It's been years, I think, since any of us have ever used a taxi, frankly. How much do you think those driver shortages are going to continue to weigh on those two companies?
Yeah, no, I think that's a great question. And, clearly the supply constraints, the driver constraints are having an impact here. Our view, when you kind of look at what Lyft said last night, increasing driver supply by about 50% in the second quarter, and again, significant investments going into the third quarter here. I mean, clearly nobody out there wants to be paying these higher prices that you've seen. On top of that, having these longer wait times. Our view, though, is as you kind of go into this September month, especially kind of as you get that benefits cliff, here in the US that should kind of improve the actual supply situation for Uber. Most kind of drivers out there utilize Uber towards for the main reason of kind of getting that incremental kind of excess money on the side. So that being said, we do see significant improvement as we kind of go into the September and October months, and I think that should help improve the actual volume for this business. But at the same time, the headwind is going to be that you're going to see some pricing rollover.
All right, we're going to have to leave that there. Angelo Zeno, Senior Industry Analyst at CFRA Research. Thanks so much for joining us today. And coming up next after the break, we'll be talking with Corsair CEO Andy Paul about earnings, the outlook for the gaming industry, and more. That's next.
A mixed earnings report from Corsair Gaming this week. The company reporting strong sales growth, also reiterated its full year outlook, but adjusted earnings per share came in below estimates. Joining us now is Corsair's founder and CEO, Andy Paul. Andy, good to see you back on the show again. We all agree you have one of the coolest backgrounds we've seen in quite some time. So fitting for a video game equipment maker to have that background. I know that you're attributing the earnings per share shortfall to higher logistics costs, but I'm wondering if you could break down for us what those costs are and how long do you expect to see them remain elevated?
Yeah, well, look, this is a good point. Firstly, this is really a short-term issue, right? We've got a little a situation where there's the supply chain's a little clogged up, and there's a tough time getting containers. But this is a short-term issue. This will all be resolved by the end of this year, I think. So, we tend to look at this as a long-term investment, and I think that's the way investors should really look at it. I'm not, to be honest with you, focused on quarter by quarter, earnings, whether we're getting 99% or 101% of the analysts' consensus. That's really the last thing. What we're concentrating on here is being right in front of a massively growing market and bringing great products to market. So that's really what I'm focused on.
Andy, let's talk about something else that has been impacting the business and just the industry at large, not just yours, and that's chip shortages. We've seen this impact so many different fields. Automakers, for example, have been squeezed right now because of those shortages. How has that been impacting Corsair? I hear what you're saying about some of the logistical issues and supply chain issues being short term. Are you still seeing that as well with some of the chips?
Well, we certainly do. It's been a tough year to keep up with the demand. As you probably know, the demand for gaming equipment, gaming gear has exploded over the last few years, and even more so with people spending more time at home for the last year. So that's definitely stretched the supply line, and a lot of our flagship products that have high semiconductor content have been tough to keep on the shelves because the demand's been so high. Again, that should resolve itself with time. Right now, we've got a pretty good inventory position. And so we're looking forward to, the next couple of years, we can continue to bring some of these great products out.
And I'm wondering, it's sort of like a 1-2 punch for companies like yours across a lot of different industries. Andy, when you look at the delays we're now experiencing at the ports, which is one of the reasons why we're seeing higher prices and inflation pick up, how impacted are you by what's happening at our ports and with backed up freight?
Yeah, it just makes the supply chain longer. So, what used to take us 6 weeks to get a container from Asia into the US or Europe now takes 10 weeks. And so once you understand that and plan around it, it's okay. But certainly there's more ships on the ocean. That's more inventory. We've got a good balance sheet now, so we can afford to carry more inventory. So all of those things, again, are short-term problems that have to be adjusted to. But it doesn't really affect the overall business that much. It just gives us a couple of short-term hiccups.
I'm curious to know, because the pandemic, we saw obviously everyone staying at home in lockdown, obviously a big boon for the business as so many folks were instead playing video games. But now that trend is starting to reverse just a little bit as we see folks starting to travel again and leave their homes and go to restaurants and movies and other outdoor activities and events. How do you see that impacting the company and the business going forward? How do you see that impacting demand? Or are you anticipating perhaps that as the Delta variant continues to surge that, folks are going to continue to stay at home and keep playing some video games?
Well, yeah, so it's not a digital yes or no. I mean, people aren't playing more games now because of COVID. Certainly, this has been a long-term trend, right? I mean, I've been looking at video game number of gamers, over the last 10 years, and it's steadily going up. Obviously, a slight acceleration last year, but it's not as though people are going to come away, start going to restaurants and stop playing games. What's really happening here is that the amount of games that people were playing last year obviously stepped up, the amount of hours played, and that's increased everyone's skill level. So now you've got a lot of people that are much better at playing whatever game they were playing, whether it's Call of Duty or Valorant or whatever. Once you get better at a game, then you start looking for equipment. So what's really happened is we've sort of had a big surge in activity that's now starting to see a surge in people wanting to buy better keyboards, better mouse, better gaming PCs. And that's why the demand's so high. So I don't think this is going to be a situation where as soon as people go out to restaurants, they're going to stop gaming and the demand falls away. I think this is laying out a carpet for the next few years of really high demand of gaming gear.
Now, I know as a CEO, you can't be fixated on the company's stock price, but I'd love to get your thoughts on what's been happening with Corsair's stock. For a little while, it got caught up in that whole meme frenzy. And I know that according to the Reddit crowd, in June, your company's stock was mentioned something like 860 times. It's been on a bit of a roller coaster ride and is down more than 20% year to date. Given the fundamentals of the company, that seems a bit odd. What would your message be to investors right now, and especially those so-called meme investors?
Yeah, no, it's very straightforward. Look, and I should say, I've been a Corsair investor for 27 years, so one of the biggest private investors. So this is not a stock that you do short-term gains on. And, obviously we're not building the company for the benefit of day traders. But if you invest in a company like this, you invest in the long-term secular gaming growth, the long-term streaming growth, and the fact that we've got an ability to bring out lots and lots of great products. That should be the investment thesis, not what we think, you think the stock's going to be doing tomorrow. So, yeah, so this is a long-term play. And I think ultimately that's gonna play out. Obviously, we've got a lot of things going on between retail investors versus hedge fund shorting, and that's a battle we watch with sort of vague interest. But the fundamentals of the stock, really, in my opinion, should be based on long-term growth and our ability to win in the market.
Yep, sounds like a novel idea. Corsair's CEO Andy Paul, thanks so much for joining us. We appreciate your time. Next up, we're going to get you a check of the oil markets and our ETF report right after this.
Let's check out the energy markets now. We've got Jared Blickery standing by in the newsroom for a look. Jared, what's happening? I'm seeing that the energy markets right now is the laggard, down about 2 3/4 percentage point on a sector basis.
Yeah, that's right. And we're taking a look at crude oil. Let's take a look at the chart on the Wi-Fi Interactive because it is sinking. And we did get some fireworks around 10:30 a.m. and that would be right around here. But you can see that the price movement was already in place here. Now at 10:30 a.m. we got the weekly inventory report from the Department of Energy, and there was a surprise build of about 3.6 million barrels. Unexpected, and also one of the biggest jumps in a long time. So that's a little bit bearish there. And then we did get some more movement to the downside. Just want to check out a 3-month chart as well. And you can see after topping out over $75 a barrel here, we just kind of sunk. We got to about 65, tested these highs, and now we're back down at these lows. Could go as low as $60 per barrel. Now, I also want to check in on the energy sector. As you said, Christian, this is the worst performing sector. There we go. And you can see a lot of red and dark red. Exxon on the left, that's down 2%. So is Chevron. In the upper right here, we got Schlumberger, that energy supplier. They're down 3.7%. And then also Halliburton in the same category. They are down 5%. So energy definitely leading the way down today, guys.
All right, thanks so much, Jared, for breaking all of that down. It's time now for our ETF report brought to you by Invesco QQQ. We're joined now by Todd Rosenbluth, head of ETF and mutual fund research at CFRA. Todd, great to have you back here with us. I see in your notes that you say that these broad-based ETFs have really been leading the charge, so to speak. I'm wondering if you think that that trend is going to continue, at least in the second half of the year.
We do. We're at record flows already for 2021, beating 2020 with $540 billion of money that's flown in to ETFs. And these broad market ETFs like Vanguard's 500 ETF VOO, iShares 500 IVV, and VTI, which is Vanguard's total stock market. We're seeing these as broad asset allocation products. They continue to gain traction as we see investors become more comfortable in using ETFs for their broad exposure. But we're also seeing value-oriented plays that were popular in the good chunk of the first half of the year. You showed energy earlier, but energy ETF being out of favor, but energy ETFs like XLE or financial ETFs like XLF have been popular this year, as well as broader value-oriented ETFs.
You know, Todd, I want to ask you about Robinhood because we've seen a lot of activity in that stock. They just went public. Now they're above their IPO price. And despite being a very new stock, they're actually part of the ARK Innovation ETF. Have you seen more activity and more money flowing into that particular ETF since the Robinhood IPO?
Well, the ARK family of products, and in particular ARKK, has been a popular actively managed ETFs, given the success it had in 2020. The performance is down. I see you showing a chart here. It struggled versus the broader market, but it's benefiting today from a 1% stake within Robinhood. It's also in ARKF, which is a fintech version of that product. It again shows the potential benefits of active management. You can get in early into some of these companies, and that's going to help investors that have been looking for the longer term. And obviously Robinhood is a good long-term strategy for investors to consider. And it fits into these active ETFs much more easily than an index-based product like the Vanguard 500, among others.
Now, I know that value ETFs were also favored by investors, but we have had a lot of blockbuster earnings, at least from some of those big tech names. Now, we had seen a lot of rotation out of that sector. However, I'm wondering if investors right now should start looking again to some of those tech ETFs and really increase some of their exposure again.
We think we've seen really strong numbers from some of the growth-oriented and technology companies that you'd find within a growth ETF, like the triple Qs, like you'd see in VUG, which is Vanguard Growth ETF, or a more targeted ETF like XLK, which is a technology select sector spider. So heading towards the second half of the earnings season, technology tends to do well within the fourth quarter. We think growth-oriented ETFs certainly are warranted investor attention, and they can use ETFs to rotate between growth to value and back to growth, as we've seen throughout much of the year.
Are there any ETFs that were hot earlier in the year, say in January, and now as we're in the second part of the year, investors are having second thoughts?
Well, we've seen a rotation with fixed income, for example. So we've seen a rotation away from some of the more higher yielding products. Investors have rotated away from these products and gone into something that has less interest rate sensitivity, like a senior loan ETF. So we've seen a rotation within fixed income, investors shifting their risk appetite and using, again, the benefits that they can get in and out of ETFs relatively easily.
And before we let you go, Todd, I do want to ask you about the infrastructure bill. Right now, they have that bipartisan package. They're going to be taking up a vote on that. I think so many investors are expecting that a deal is going to be getting passed, hopefully somewhat soon. If you are looking for some exposure there, where should folks really start to look, especially as that infrastructure bill is going to get passed?
So Global X has a suite of thematic-oriented ETFs, and PAVE, PAVE. Well, the tickers are great with these. They tell you exactly what they're doing. PAVE is a U.S. infrastructure development ETF focused on industrials and materials companies that have 50% or more of their revenues tied to the United States, it's perfectly suited to benefit. We've seen the flows, we've seen the returns strong in 2021, and we at CFRA, this is our focus ETF for this current month. We think it's going to perform well over the next 9 months, and we think PAVE is a good way to play the infrastructure theme.
Yeah, as you can see, they're up almost 64% for the year. Todd Rosenbluth, head of ETF and mutual fund research at CFRA. Thanks so much for joining us. And coming up, ADP private payrolls seriously missed on some of those estimates. So what could this mean for Friday's jobs report? We'll be talking about that after the break.
The highlight of the week for investors is expected to be the government's monthly jobs report due out on Friday. And we certainly did not get an encouraging precursor to that today in the form of the ADP report, which showed private employers added just 330,000 jobs in the month of July, less than half the number of jobs we added in June. Here to talk about it now is Jesse Edgerton, economist at JP Morgan Chase. Jesse, good to see you again. So I'm curious, on the back of that ADP report, what are your expectations for Friday's monthly jobs report?
Well, we're still expecting a gain of 900,000 jobs in the official BLS report on Friday. I would say the ADP number this morning had a little bit of downside risk there, but the ADP number also tends to not be an especially reliable predictor of the official BLS number.
So I want to ask Jesse, I want to know if you think that there's going to be some weakness that might remain in the labor market after the summer really ends.
Sure. Well, I would say we are seeing some softening in a number of the high frequency indicators already as the Delta variant is spreading here. So even thinking about the July payroll report that we'll get on Friday, there has been a bit of deceleration already between June and July in some of the high frequency data we watch, like our card spending numbers from Chase and open table diners, TSA travelers, things like that. We were already seeing some deceleration from June into July. And then I think that's continuing further so far into August. So we are starting to see some pullback in things like card spending on airlines and lodging as people get more worried about the Delta variant here.
And I know that you expect education-related employment to provide a significant boost here. And is that just because we're going to be getting back to school and you see more of those folks re-entering the workforce again?
Well, so for the July report that will come out on Friday, it's a little bit different, where this is really kind of a distortion, I would say, to the seasonal adjustment process that might end up boosting the headline number that we're expecting to get on Friday. So the way that works is in a normal July, schools are laying off workers as they shut down for the summer. So in a normal July, we might expect to lose 1.3 million workers in the education sector just due to that normal seasonal process. And the seasonal adjustment factors try to kind of correct for that and measure what the underlying signal is from the labor market, looking through that normal decline that we always see. But under COVID, there's been such a decline in the number of people working in the education sector to begin with that we've been seeing smaller fluctuations, both in absolute and percentage terms, month to month in the education sector. So essentially this month for July, the seasonal factors are expecting a decline of 1.3 million jobs, but we think we're more likely to get something like a decline of 900,000 jobs or 1 million jobs. And so that will effectively boost the headline seasonally adjusted number by, say, 350,000 jobs. So that's kind of pushing us up from, say, a 500,000 print up to more like 900,000, which is our forecast.
I have to ask you here, Jesse, about the Delta variant, and it's a risk that we've heard so many folks talk about, from CEOs, to an investor, strategists and analysts. And I'm curious to know if you think at all that the Delta variant right now is presenting a risk to the labor market, perhaps even to some of those educational jobs, because we're hearing that schools right now, not all of them are going to mandate mask wearing. Who knows what's going to happen in a couple of months if schools will become hotbeds again of the infection and of the virus. What kind of risk do you see the Delta variant playing right now?
I do think it is a risk. Looking at the case numbers, they are rising fast everywhere, even in states that have a high fraction of people that are vaccinated. Honestly, the hospitalization numbers that we can see are also not looking that great. Rising fairly fast from low levels at this point, even in the highly vaccinated states. So it does seem like we're definitely going to get a very significant wave of cases here, right? Hopefully, the relatively high levels of vaccination in most parts of the country will prevent a large rise in hospitalizations and deaths compared to previous waves. And then it gets to be a bit of a debate about how people will react in terms of their behavior, right? Like I said, we are starting to see people pull back on their spending on airline tickets already, given what we've seen with the spread of the cases. And then, we'll see if governments around the country start to more formally restrict activities again. And I think by the end of August, we're likely to be seeing very, very high case numbers again if things continue on their current trend. I think that does open up the question of whether schools are going to reopen fully in person in September. And so that will be a big debate with very big implications, both for the labor market in the education sector, and then also, of course, for whether parents will be able to fully go back to work.
That is the question. And Jesse, I'm wondering when you think we might see the job market return to pre-pandemic levels. I read something recently that said it could be the end of this decade that we gain all of those jobs back. I believe we're still down about somewhere like 7 million jobs. What do you think in terms of a timeline?
That is right. We're still down 7 million jobs from the peak. And normally we would expect that number to trend up over time. So, we're even a little bit further below kind of the pre-COVID trend. I do think aside from this dip that we're likely to see due to the Delta variant here, we were on a fairly steady kind of 500,000-ish pace. If you stayed at that level, it would take 14 months, I guess, to make back those 7 million jobs that were down. So, I do think, assuming we can kind of get past a potential detour with the Delta variant, that we could see the labor market getting back to closer to what we think of as normal, say, 2 years from now.
All right, we're going to leave it there. Jesse Edgerton, JP Morgan Chase's economist. Thanks so much for being with us. And coming up next, pop star Rihanna is a newly minted billionaire, but it's not her music that's making her uber wealthy. We've got details for you coming up next.
Welcome back. Well, according to Forbes, singer, businesswoman, and just all around queen, Rihanna is now officially a billionaire. We have Yahoo Finance's Alexandra Canal here with all of the details for today's fame and fortune. Hi, Ali. Tell us what's going on with Rihanna's fortune.
You said it, Kristen. Queen Rihanna officially joining the Billionaires Club. According to Forbes, she's now worth a whopping $1.7 billion. That makes her the wealthiest female musician and second only to Oprah Winfrey as the richest female entertainer. But what's interesting here is, as you guys mentioned, the bulk of her income does not come from her music. It comes from her fashion and beauty brands. I want to start first with Fenty Beauty. That's a 50-50 joint venture between Rihanna and fashion powerhouse LVMH, the conglomerate behind luxury brands like Louis Vuitton and Dior. Now, that launched in 2017 and immediately brought in sales, generating more than $550 million in annual revenue in its first calendar year, according to Forbes. And a big thing about Fenty is that it was super inclusive. There were a variety of shades for their foundation, very inclusive on multiple skin tones, which at the time, there were not a lot of options. And we've seen an explosion of celebrity beauty brands with not only Rihanna, but also Kim Kardashian, Kylie Jenner, Lady Gaga. And consumers are continuing to gravitate towards those companies and as beauty trends and makeup trends continue to evolve. called. And then if you take a look at Savage X Fenty, which is her lingerie and fashion brand, she launched that 1 year later in 2018. She currently has a 30% ownership stake in the company. It raised $115 million in funding earlier this year, bringing the brand's valuation to over $1 billion. So Rihanna, she's making that dough. And I do think it speaks to the larger story here of more and more women entering entrepreneurship, opening up their own businesses, and therefore making room for that billionaires club, which has typically been dominated by males. So I think this is a great story. I'm all about Rihanna these days. I love her.
I'm with you. I say more power to Rihanna for sure. But men do still dominate that list, we know. And Jeff Bezos, of course, was the world's wealthiest person for quite some time, but he dropped to number 2. Tell us about it.
Yeah, so his net worth fell after Amazon's stock price sank 7% last week following the company's earnings, when the retail giant said that they've seen a slowdown in second quarter growth. Now, what you're seeing on your screen there is from close of markets Friday, July 23rd to Friday, July 30th. Bezos' net worth tumbled $16.8 billion to $192.4 billion. Now, as of today, Bezos' fortune is sitting at around $193.6 billion, so somewhat recovering from those losses. Now, he previously was the first person to reach that coveted $200 billion mark as Amazon soared amid pandemic stockpiling, people going to the site to purchase all their toilet paper, all their paper towels. I know I certainly did that. But since Bezos is out, that means someone else has to be number 1, and that is going to be Bernard Arnault, the CEO of LVMH, which is pretty ironic considering we were just talking about Rihanna, Fenty Beauty, and their partnership with LVMH and that fashion powerhouse. And Arnault, he was able to grow his wealth by $100 billion during the pandemic, which I think is pretty interesting considering that we saw consumers scaling back their consumer discretionary spending, and also the fact that we saw some job losses during the pandemic. But despite that, he was still able to tack on an additional $100 billion. And as of today, his net worth is $198.2 billion, according to Forbes. So he's almost at that $200 billion number that previously Bezos had the title of. So overall, though, I think it's pretty interesting to look at how many billionaires we have out there and how their wealth just continues to increase over time. There are 2,700 and I'm sorry, but basically, long story short here is that there's a lot of billionaires, and right now, we got to spread the wealth a little bit.
Yeah, and I'm not crying for Jeff Bezos at all for sliding to the number 2 slot. Sadly, that's all the time we have. Yahoo Finance's Alexandra Canal, thanks so much for bringing us all of those updates. Adam Shapiro and Shauna Smith will be carrying us through to the end of today's trading session. That's all after the break.
A mixed picture for markets, which fell at the open after a weaker than expected payroll number. But Robinhood, it raised higher. We're watching the markets and have the chief U.S. equity strategist from Credit Suisse ready to break it down for us with insight investors can use to make their next moves. The Delta variant continues to force COVID-19 case counts higher, and in San Francisco, people who got the J&J vaccine will soon be eligible for a booster from Pfizer and or Moderna, but the World Health Organization has something to say about that. And despite the increased caseloads, vaccinated Americans are hitting the road and getting out of town. We've got the CFO from Royal Caribbean joining us to talk about the surge in new bookings and how you can set sail and get away from it all. An hour to the closing bell. I'm Adam Shapiro.
And I'm Shauna Smith. Adam, let's take a look at where markets stand right now, because we have the Dow and S&P both in negative territory. The S&P pulling back from its record close yesterday. You can see the Dow off just around 284 points. Some of the selling accelerating here in the final couple hours of trading. The biggest laggards in the Dow, Amgen, Chevron, and Walgreens. But let's kick things off with Jared Blickery for a closer look at some of the declines that we are seeing. And Jared, I guess from your perspective, what's weighing on stocks?
Well, a number of things. Some of it's earnings, some of it's the Delta variant, and picture's worth 1,000 words. So let's go straight to the Wi-Fi Interactive. We see the two green sectors in the upper left. That's communication services and tech. Those have the mega caps in them. And not surprisingly, we're seeing some green in the Nasdaq, but Dow really lagging, as you just said, Shauna. Also want to point out to the downside, energy and staples are the worst performers. We just had crude oil settling 3% down. And I'll show you our heat map for the energy sector. Lots and lots of weakness there. Exxon and Chevron each down more than 2%. Also seeing some weakness in the staples, and that has to do with Kraft Heinz really missing on organic revenue, down 5% today, margins getting hit, and not the best outlook for the future based on increased inflation. Also looking at the travel sector, sorry for all the red guys, but we're seeing Southwest down 3%, Delta down 3.5%, Live Nation giving back gains. Now they reported earnings, but you can see they're well off of their highs. A nice beat for them, by the way. Let's take a look at some green here, because that would be focused in the tech sector. So semiconductors really jumping here. AMD up another 5%. That stock has been on a tear. Let's take a look at a 1-month chart. You can see just breaking to the upside, I believe it was last week, 2 record highs. Also some incremental news by Microchip. They reported earnings, decent outlook there, but they're only up about 1% or 87 basis points today. That's been kind of a rocky road for Microchip, one of those stocks that wasn't able to break to new highs given the recent strength in the semiconductor sector. But the Philly Semiconductor Index posting a record high today. Also taking a look at the banking sector, that's looking pretty weak here. We're seeing the 10-year T-note yield that dipped on that really missed ADP employment number this morning. It did recover and it did reverse, but still banking stocks taking some losses there. Also want to focus on the auto space, because there we're seeing kind of a mixed board, but GM really stands out after missing on its bottom line on EPS. Guys?
Jared, we're going to keep talking about these markets. Sometimes the simplest thing is the most important, but you can get boxed in when things don't go right. Let's raise that issue when it comes to Robinhood, because that stock is on a tear. And Esrey, what's going on?
That's right. Robinhood is up about 49% today. Remember, yesterday it was up 24%, just blowing past its IPO price of $38. So what's happening here? It seems to be that there's retail interest. Swaggy Stocks tracks stock sentiment and comments on Wall Street bets, and it is the top commented stock, Robinhood, on the forum over the last couple of days. You also have data from Fidelity showing real-time data from retail customers that Robinhood is a top traded stock. There are more buy orders than there are sell orders, and it's ahead of AMD and AMC. Those are also very popular among retail traders. And then you also had that recent news that Cathie Wood's ARK Innovation ETF scooped up more than 3 million shares of Robinhood, so a sign of encouragement over the last couple of days. Now, if you think that this is a short squeeze like we had seen with some around meme stocks initially back in January, let's say, well, no, this is not a short squeeze. I got in touch with S3 partners. They measure short interest, and they're saying, no, it's not any type of short squeeze. There's not enough time really to accumulate such a large short position on Robinhood. While there is some short side activity in Robinhood, this is definitely a long side that's the main driver here. Shauna, Adam?
All right, and as we appreciate that, let's bring in Jonathan Golub. He's Credit Suisse Securities Chief U.S. Equity Strategist, because as we get ready to wrap up another earnings season and another quarter of beating expectations, you talk about the rally that's been going on, and there are some perhaps disappointing economics out there, but investors seem to be brushing it all aside. Do you think they're perhaps missing a canary in the coal mine?
It's almost as if the market is reading two different scripts. Earnings this quarter, and these numbers are going to seem ridiculous, 86% above where they were a year ago, surprising by something in the ballpark of 16%. I mean, these are just enormous numbers for all of the concerns about profit margins. Of that 16%, 4% coming from revenues, 12% coming from better profit margins. And yet at the same time, GDP data missed expectations in a meaningful way. We had some jobs data coming out today, weaker. The Citi Economic Surprise Index dipped into negative territory, and interest rates, which are really important as a signal of economic health, are falling, which is a sign of weakness. So you have great earnings, and yet some of these signals are kind of contradicting it.
Jonathan, when you look at the outperformance of the market, I mean, it is rather remarkable going off of what you were saying, that S&P today just pulling back from yesterday's record close. I guess, why do you think, when you look at why the market, I guess, has been able to be so resilient, are you confident, though, that momentum will be able to continue here in the future?
Yes, with an asterisk. I mean, the first thing is, if you look at, let's say, in the month of July, or for that matter, even for the last 11 months, you have the market up, but the earnings are actually going up substantially faster than the stock prices are, which means the valuations, the PE of the market is falling. We were at a PE of 23 on the market last August, and we're at a PE of about 21 today. So the market's getting cheaper. But to your point about these signs of weakness, they are driving things underneath the hood within the market. So in the month of July, for example, you had non-cyclical stocks, things like consumer staples and healthcare, that led the market. That's not normally a sign of health. Tech is doing well, but some of these more cyclical areas like financials and industrials and materials and energy are lagging a little bit, not great signs of health. So there's a lot of, these countervailing winds. We have a call for 4,600 on the market. That's about 4% upside between now and the year. The earnings are going to take us there without a problem. But what stocks in particular lead, I think, is much more questionable.
Yeah, I mean, if we could all figure that out, we'd be billionaires and we wouldn't be doing these jobs. But for the investors who are watching right now, when you hear the market, the S&P 500 around 4,600 at year end, there's still upside. And because of the Fed's policies, you have no choice. You've got to be in equities somewhere.
Yeah, I mean, unless you think there's something broken here, and there's some signs of caution, again, against this backdrop of rip-roaring earnings. But we have, the news on the COVID vaccine. Not COVID vaccine, but COVID is an issue. We have these programs which allow for people to defer their payments on rent and student loans and mortgages. Some of those things are rolling off, which could create some pressure. So the near-term power behind the market is these insanely strong earnings. There's very little sign that they're not going to continue to be strong through the end of the year and into next year. But you are starting to see maybe cracks on the edge, if you will, that are making this a little more difficult. And where it's showing up is not in the market overall, but in the sectors and kind of groups of stocks and that leadership, and there's a bit more rotation going on there, which is causing, some people who trade their individual accounts or hedge fund managers or a little bit more heartache. But if you're looking at the overall market, it's just extremely solid on great earnings.
Jonathan, one thing that stuck out to me in your most recent note on earnings, you were talking about the companies that are beating on both the top and bottom lines, but the outperformance that we're seeing relative to what we've seen previously, and I guess underperformance is a better way to say it, because we're seeing those stocks jump about 0.8% versus 1.8% historically. I guess, what do you attribute this to, and is this something that makes sense in this current environment?
So let me give you the positive story. It's better than it was last quarter. But yeah, the market's doing something really funky, which is you're having these really, really large beats and the market's kind of shrugging their shoulders. I do think that it's helping the market overall and the tone of the market. What is happening, though, is the individual stocks that the news is coming out on. When they beat on an individual stock basis, the market is not treating them uniquely. So I do think that the earnings are helping the broad market. But if an individual security delivers a good earnings number, the market's kind of treating it as if it's kind of like a big pool of good news rather than something that's specific. And I will tell you, you're confused by it. I'm confused by it. The biggest portfolio managers and hedge fund guys are confused by it as well. But like I said, it was worse last quarter. This quarter is still a little bit below normal in terms of the market price response. I'd love to see it healthier.
Jonathan, good to see you. Jonathan Golub is Credit Suisse Securities Chief U.S. Equity Strategist. Thank you for joining us here on Yahoo Finance Live. When we come back here in the New York City area, they canceled the annual New York City Auto Show because of the rising COVID cases attributable to Delta-19, the variant that's Delta, which is causing so many problems. When we come back, the World Health Organization is asking wealthy nations to hold off on booster vaccines.
An update from the World Health Organization asking wealthy nations to hold off on booster shots through at least September. So we want to bring in Anjali Khemlani for a little bit more on this. And Anjali, I guess, what's behind the recommendation that they're making?
Well, the World Health Organization is focused on the rest of the world and making sure that other countries that are just starting to get vaccines can, in fact, continue to gain access and increase their vaccination rates. So what the World Health Organization is focused on is the fact that they are looking at a 10% vaccination of each country, achieving that by the end of September. And in order to do that, they have asked, and this is from the Director General earlier today, specifically for not just the vaccine producers themselves, but also for wealthier nations to hold a moratorium on boosters. We know that's happening in Israel right now. And the Director General did say also that this would help sort of alleviate the pressures on these countries right now and help the influx of vaccines through the COVAX facility, that program that's been set up by the World Health Organization in order to help vaccinate other countries. So as of right now, that moratorium holding on until the end of September, and in the meantime, making sure that they can get to that 10%. They're also targeting by the end of the year, by the way, that 40% of each country should reach vaccination, fully vaccinated status.
What's the status of the FDA and final approval for the Pfizer vaccine?
Right. The Pfizer vaccine is looking to be the first that would get full FDA approval. And the FDA is looking at what they called essentially a sprint. The New York Times reporting today that they might be able to get that approval done before the end of September, September being an important month, I guess. So looking at it as possibly before Memorial Day, but likely before that, possibly in the next couple of weeks is what they have said so far. So we'll have to wait and see how that all works out. But that is the latest on that. And it would help. The reason why that's important is because it would help then to have vaccine mandates and to push that through, according to some legal experts.
All right, Anj, thanks so much. We want to continue the conversation with Dr. Elizabeth Claiborne, emergency physician, also an adjunct assistant professor of emergency medicine at the University of Maryland School of Medicine. Dr. Claiborne, it's great to speak with you again. Let's just jump off of where Anj ended there, the fact that the FDA could potentially approve Pfizer's vaccine by the end of September. If in fact that were the case, I guess how significantly do you think this could potentially boost or increase the number of people willing to get the vaccine?
I think it could help tremendously. There has been some research that shows that almost maybe up to 3 or 4 people out of 10 who are currently vaccine hesitant would potentially move ahead with vaccinations if it had full FDA approval. It would give them that boost of confidence. But I think more important than that is the point that then we would be able to have vaccine mandates, which was earlier mentioned. And I think the vaccine mandates coming from employers and other organizations would really kind of bolster participation in inoculation rates that need to be more widespread, specifically in areas of the country where we haven't had great early adoption. So I think many healthcare workers like myself are looking forward to the full approval of the Pfizer vaccine and hopefully other vaccines behind that to encourage everyone to get a vaccine as soon as possible. And if that's the confidence that people need is to have that full approval, we hope it happens appropriately, but as soon as possible.
What's the advantage of getting a booster from a vaccine that may be different from the original vaccine you got? There's that discussion in San Francisco. If you got the J&J vaccine to get I don't know the right term, but a booster from either Moderna or Pfizer, what benefit is there to that?
Well, there had been some initial research that was looking at whether or not you would have superior protection by mix and matching the vaccines because they are slightly different in the way that they are treating or training your body to respond to the coronavirus. And by mixing and matching, you might have a more widespread or more thorough protection because you've learned slightly different sequences of that virus in which you can respond and protect yourself. But the data is still pending on that, so we're not 100% sure. However, I do know that there are plenty of research studies that are taking place that are examining that exact question. And I know that in the United States, they're looking at having a potential booster plan that would involve kind of the same methodology for everyone, regardless of what shot they had to begin with. And that's why there's so many variables that are being considered, and we don't know exactly how that is going to roll out in the future.
Doctor, taking a look at what's happening down in Florida, also what's happening down in Texas, Florida specifically, hospitalizations hitting a record for the 3rd day in a row. And then, of course, those 2 states, Florida and Texas, making up a 1/3 of all new cases here in the U.S. I guess the risk of this potentially happening to other areas of the country, what we're currently seeing play out in those two states. How do you read that? And I guess, how big of a threat do you see the Delta variant being to the rest of the country?
I cannot emphasize enough how serious this situation is. I honestly, as an emergency physician who continues to take care of patients on a daily basis who are testing positive for COVID, and the majority, in my personal experience, 100% of the people who I have had test positive in the last several months have been unvaccinated. This is a real threat. I think this is a wake-up call for everyone in the country, regardless of where they live, but especially in places like Texas and Florida, where we're seeing these case positivity rates go up and the number of hospitalizations go up. What I implore people to do is look in your own circle of people and ask who there is vaccine hesitant. What information do they need? Make sure you're verifying your sources. Even in my own family, when I have people approach me about whether or not they should get a vaccine if they're eligible and they haven't got it yet, I speak to them about where did you hear that it wasn't safe or that you weren't sure you're supposed to get it. Validate those sources. My sources are coming from peer-reviewed medical journals, and I look at that data very carefully so that I can tell both my patients and my family and friends with confidence that I think getting a vaccine is the best way to protect yourself against COVID-19. And I encourage everyone else to do that and just reach out to those members of their family or their friend circles who have not been vaccinated and encourage them to rethink that, because it is very risky.
I have a relative who's a doctor in a southern city that's seeing a massive spike and was pointing out to me that in the hospital, COVID ward is filled up, but then the other kinds of things people go to the hospital for, they now have the code where it's the room number and then H, and H means they're on the gurney outside in the hall. Are you seeing that kind of overcrowding in your area? Are you hearing the same kinds of stories?
The hospital that I work in has been very overcrowded for some time for a number of reasons, but anytime there is an influx of COVID patients, it definitely squeezes our ability to care for the remaining of patients that come in for regular issues. In addition, we're having a lot of people who have been more active, kids participating in camps and going back to school. So we're seeing some viral illnesses that are not COVID related that have cropped up. And in general, I think the trend across the country, including Maryland, where I work, is that everyone is very busy. And then there's a heightened sense of nervousness and anxiety because of this Delta variant and how easily it is transmissible and how potentially it is impacting populations that have been historically in the history of this pandemic not as impacted negatively, but now certainly becoming more of a group that we're concerned about, including our unvaccinated youth and especially those school-aged children.
Dr. Claiborne, always great to speak with you. Dr. Elizabeth Claiborne, emergency physician, also adjunct assistant professor of emergency medicine at the University of Maryland School of Medicine. Thanks so much for taking the time to join us today. Coming up, Fed Vice Chair Richard Clarida making some comments today about when we could potentially see the Fed raise rates. He also had some things to say about inflation. We've got those details for you right after the break.
Fed Speak is alive and well, and the person who translates Fed Speak for us is Brian Chung. He joins us now with the latest on comments regarding inflation and much more, the jobs report too, right?
Yeah, well, we heard from Federal Reserve's number 2 official, that's Richard Clarida. He's the vice chairman over there at the central bank, and he made remarks this morning to the Peterson Institute, giving a little bit more detail on the possible roadmap that the Federal Reserve could have into its next steps on possibly tightening its extremely accommodative monetary policy to stimulate the economy. The first step might be tapering its asset purchases. Now, we've heard a number of other Fed officials share their timelines for when they could see the slowing of their $120 billion a month pace of U.S. Treasury and agency mortgage-backed securities purchases. Clarida, for his part, saying he could see that tapering beginning at the end of the year. But he also said he could see a rate hike coming as early as the beginning of 2023. All that hinges on where the unemployment rate goes. He said that if his forecast for getting 3.8% headline unemployment by the end of 2022, that would possibly be a green light to raising interest rates as of the beginning of 2023. Now, all of this is caveated by the fact that Clarida himself may not even be a member of the Fed board over that time horizon. Keep in mind that his term as the vice chairman actually expires at the end of January next year, which means that he might not even be there to vote on some of those policies when it comes to raising interest rates, if it does indeed happen on that timeline at the beginning of 2023. But that might be a moot point when you consider that dot plot projection that we got in the June meeting. That was 2 Federal Reserve policy meetings ago, but you can see in the dot plots that among the 18 members of the committee, 15 of them saw at least one rate hike by the end of 2023. So it sounds like, at least for right now, Clarida is one of those 13 dots. But of course, that is a pretty large majority of the committee. So even if he's not there, it seems like a lot of the other current standing members could possibly see the case for the same type of timeline. So worth watching as we head into the Fed's Jackson Hole meeting, which is coming up, guys, only in a few weeks.
Brian, you briefly mentioned the labor market there. I guess what else did he have to say about jobs? Because we got that ADP data out this morning, coming up short just in terms of what the street was expecting. We get the big number out on Friday. And of course, that's a big question mark, I think, in this economic recovery, just the dynamics at play right now in the jobs market.
Absolutely. And yes, the ADP numbers did come in short. The Federal Reserve Vice Chairman didn't necessarily opine specifically on the ADP report, but he did say broadly that the labor market is something that he's watching very closely. When you consider the Fed has the dual mandate of stable prices and also stable prices and maximum employment. Well, on the stable prices side of things, we know that inflation is well above the Federal Reserve's target, which is moderately overshooting its 2% target. We know that core PCE is projected, especially among a number of Fed officials, to clock in at least at 3% for the year 2021. Now, Clarida said he expects that to come back down in 2022, although the likes of St. Louis Fed President James Bullard don't see that as the case. But really, inflation is coming up, and the Fed says that's kind of in line with their mandate. So really, the focus is on getting the labor market back to form. There are nearly 7 million people out of jobs compared to pre-pandemic levels, and I think that's the reason why you see Clarida hanging his hat on the unemployment rate, saying, look, if we can get that headline U3 rate to 3.8% by the end of 2022, that would be a green light that the economy is in good enough of a place to accommodate some higher rates.
Brian, we appreciate that. We're going to turn our attention to something a lot of people have been watching, not only the price of new cars, but actually can the car manufacturers deliver the vehicles that people want? We got Pras Subramanian here, our version of Click and Clack. What did GM tell us?
GM, Adam, not really following suit here with other automakers and other companies this quarter by not beating on earnings, right? Whereas Ford and Stellantis did. GM beat on the top line, though, with, nearly $31.7 billion in revenue, but missed on the bottom line at $1.97 in a share in adjusted EPS. The reason why they missed was this huge charge on the Chevy Bolt recall, around $800 million on that one, those warranty charges alone. So that really hurt numbers. But they also did boost their full year EPS forecast, but not enough to satisfy the street. Street wanted around $7.31 in earnings for the year. GM had about $5.40 to $6.40 a share. Now, GM had previously said that the chip shortage was going to really weigh on earnings to a tune of $1.5 to $2 billion. And then today, GM CEO Mary Barra said they will continue to see the impact, quote, of this chip shortage through the year and into 2022. Adam.
Ross, how does that line up with what we've heard from some of the other automakers? Because I think that's a big story when it comes to the automakers really over the last several months, is chip shortage, what it means for new cars. We've seen several plants go idle as a result of this. So how does this stack up just in terms of what we've heard from some of the others?
Well, in July we saw the automakers report, their annualized rate of sales for the month, which came in around 14.8 million versus the 15.4 that the street was expecting. Usually in a good month, that's around 17 million a month, right? So 14 and a half, a low kind of a miss there, not just from an expectation, but also from like a traditional sort of, usual run rate for sales in the month. Now these estimates are forecasts, they don't include hard numbers. For instance, like GM and Tesla, they don't report monthly sales. So these are just research reports that are sort of kind of trying to see where the auto industry is right now. And you mentioned those chip shortages. That's really what's weighing on sales. It's not so much a demand story as it is a supply issue. We heard Tesla and Elon Musk talking about how they have to buy chips from other people and then use software to actually make them work in their cars. Just this week, GM idled 3 truck plants in order to get the chips they're coming in from the factory. They're putting them into trucks that are just sitting on a lot waiting to get these chips installed. Ford also saying that they expect the chip shortage to last through 2022. What are they going to do? They're going to send unfinished trucks to the dealers and have the dealers put the chips in before sale to the owner. So my bottom line here is basically, yes, it is a demand issue, not a supply issue. And I'll tell you, Adam, if you want to sell that Sportster, that nice sports car you got, you probably should sell it right now because those used car sales prices are out of control.
I actually had a bizarre idea that someone could make some money, Pross, by getting a bunch of old East German Trabants, but fitting them out with electric motors, because gosh knows the internal combustion engine and those things will never work. But yeah, maybe I'll sell the Jag. You never know. Pross from Romanian, thank you very much. When we come back, we're going to talk about why no means no and is actually a victory for Ocasio-Cortez and Americans who are facing eviction.
It's time for our 2 and 2. 2 stocks that I have for you. 2 stocks that Adam's watching here in the final 24 minutes actually of trading. First up, let's take a look at Royal Caribbean. Now this stock under a bit of pressure, although off its lows of the day, off just around just over 2% at this point. They posted a wider than expected loss of revenue that came in below the street's expectations. But on a positive note, a 50% uptick in bookings compared with last quarter. They also project that 80% of their fleet is going to be back in service by the end of the year. Of course, the big headwind facing not only Royal Caribbean, but a number of, or really all cruise lines and really everything affected by the reopening play is a Delta variant, the spread there. We will be speaking with CFO Jason Liberty. He will join us next hour. We will get to ask him about all of this. Now, flipping over to Novavax, it's a top trending ticker on Yahoo Finance today. EU deal for up to 200 million doses of its COVID-19 vaccine is pushing stocks, is up just around 20% earlier. Now, EU's health commissioner are coming out and saying that this new agreement will expand the vaccine portfolio of the EU to include one more protein-based vaccine, which is a platform that is showing promise in clinical trials. Just in terms of some of the details of this agreement, the EU states will be able to buy up to 100 million doses of the vaccine with an option for 100 million additional doses until 2023. And of course, investors are liking this deal with the stock soaring today. Adam?
Shauna, take a look at United Airlines. Those shares have been trading down all session and actually accelerating a bit to the downside right now. They're off almost 3%. They announced plans this morning that they're going to increase 74 flights. That includes 52 new direct flights between college towns and professional football markets on game day weekends starting September through November. Yes, this is a big football play here. They're going to operate 3 times more direct flights to college towns this year than they did before the pandemic in 2019. And just so you know, TSA travel numbers through the airport, they're over 2 million a day, although yesterday it was 1.8 million. Then there's Ford. We heard Prost talking about what's going on with GM after they reported earnings and sales. We got Ford sales too. Shares are down almost 4% right now, accelerating to the downside as well. Total number of sales for Ford. You had in July 120,000. That's actually down from the 175,908 they had back in July of 2020. Part of this is the chip shortage, but the Mustang Mach-E, July sales grew 15%. They sold over 2,800 of those, and they're making a big deal out of the orders for the F-150 Lightning. Reservations now exceed 120,000. Shauna?
Adam, let's turn down to D.C. because a huge headline coming out, the CDC issuing an extension of the eviction moratorium for just around 60 days. Now, they're targeting areas that are hard hit by the Delta variant. We want to bring in Jessica Smith for the latest on this. And just what can you tell us about this order and what areas it applies to?
Yeah, Shauna, this new moratorium will go through October 3rd, and it applies to counties with high or substantial COVID-19 spread. Now, this comes after that previous eviction ban lapsed, but Congresswoman Cori Bush of Missouri led an effort to push the administration to extend it. She and other progressives were really pushing the administration, putting pressure on the administration. Bush camped outside the Capitol since Friday night, urging the president to act, and ultimately he did. If you'll remember, the White House last week warned Congress, urged them to act to pass legislation to extend the moratorium. Congress did not. The White House then said that it did not have legal authority to act on its own, that there was nothing the administration could do. They said they were looking at various options. And then after getting all this pressure from progressives, the White House decided that it would act, that the CDC could issue this new targeted moratorium. But even yesterday, as the president was talking about this, he did seem to cast doubt on the legality of it. And Republicans are really criticizing the administration for doing this unilaterally. We heard from Congressman Patrick McHenry. He said in a statement, now the administration is attempting to skirt the judicial branch with this half-baked idea that does nothing to actually help renters. Now, Press Secretary Jen Psaki was asked today about how the administration squares its first stance on this with this new decision. Here's what she had to say.
The president would not have moved forward with a step where he didn't feel comfortable and confident in the legal justification. It is also a reality that there are legal steps that have been taken by the Supreme Court in the last few months, and we have spoken to that publicly. We're not going to hide from that. But he asked the CDC and his legal experts to look at what is possible. This is a narrow, targeted moratorium that is different from the national moratorium. It's not an extension of that. It's a different moratorium from a policy and legal standpoint.
Now, the White House is also urging state and local governments to act. They're telling them to get out the nearly $50 billion in renters assistance that was in the American Rescue Plan. They're saying that that needs to get into the hands of renters and landlords, but that process is moving too slowly at this point. Adam and Shauna.
And Jessica Smith, thanks so much for the update on that. Coming up next, Crypto Corner, taking a look at Bitcoin, up just a bit today, up just around 3.5%, inching closer to that 40,000 level, the level of resistance that we've seen over the last several weeks. We will have more on this when we come back.
What goes down goes up again. Take a look at what's happening with Bitcoin. It's trading almost at 40,000. It's 39,000, roughly $600 and change. And a lot of people are wondering when they might be able to get a bit of action in crypto, whether it be Bitcoin or the other cryptocurrencies, especially after what Gary Gensler was saying yesterday. Let's bring in Ollie Leach. He's the Learn editor at CoinDesk. And what's the takeaway that you think is the most important thing we should pay attention to with his talking about the need for the SEC to have regulatory authority over this, but perhaps opening the door to ETFs on cryptocurrency?
Yeah, absolutely. The ETF stuff is really, really exciting. But, let's dial back a second. When he had the interview with Bloomberg on Tuesday, it's kind of dampened a bit of the optimism about Gary Gensler stepping into the role as the head of the SEC. He considers himself a pro-crypto person. He's, taught blockchain courses in the past. But he said, he's not going to be a soft touch. And I think that's what some crypto people were hoping for, He said that the SEC are looking into several areas, including DeFi lending, namely interest rate returns received from lending, which could fall in the SEC's oversight, stable coins. He also said that regulating exchanges would be an easy option for gaining more control over digital asset fraud and things like money laundering. And he also said that, he believes many crypto tokens in the market today could be unregistered securities, kind of repeating what Jay Clayton said before him about ICOs, which could be a real concern for altcoin holders. You know, when you consider the Howey test, and a lot of speculative traders right now are purchasing tokens with the expectation that they'll rise in value based on the efforts of the projects that are selling them. So that's something that's really something to be sort of wary of going forward. Also, you know, Gary Gensler really didn't make any comment about the potential approval of an exchange traded fund, even though there is a growing stack of them on his desk right now. I think there's over a dozen now. Global X Digital Assets is the latest firm to submit an application for an ETF. So all of this kind of seems to be kind of dampening the mood a little bit. There's not a great deal of certainty around what's going to happen in the United States in the regulatory space at the moment. So I think that's what's keeping the price of Bitcoin down at the moment.
Ollie, do you expect all of those concerns? Do you expect that to keep the Bitcoin buyers on the sidelines, at least in the short term?
I think so. There's a few other factors at play, right? But I think the regulatory side of it is a real cause of concern. And I mean, you know, if you look at the chart, there was a strong resistance around that sort of $42,000, $43,000 mark. It was a key level around May and February. We've come back underneath that 40K mark, which is a key psychological level to overcome. You know, and there's other things as well, you know, like Ethereum is doing really, really well right now. We've got the London hard fork coming up sometime tomorrow. And I think there could be investors pulling out of Bitcoin right now and putting that into Ethereum.
Can you help us understand what's about to happen to Ethereum?
Yeah, sure. So it's a really promising upgrade, unless you're an Ethereum miner. So basically, it's going to initiate a London hard fork. It's a non-backwards compatible upgrade that will bring into effect 5 Ethereum improvement proposals, EIPs. There's only 2 that you really need to be aware of, and that's the EIP 1559. And what it's going to do is, so right now, when Ethereum is heavily congested, which is a lot at the moment, NFTs and DeFi is booming, there's no telling what fees are going to be. And sometimes people can easily overpay fees, and it just makes the network very undesirable. And it's just one of those kind of things that are really holding Ethereum back. So what tomorrow hopefully is going to bring is a base fee, and that's just going to make fees more predictable. But the big thing, right, and that's what people need to understand, is Ethereum supply is unbounded. And so there is no cap on its supply, where you have something like Bitcoin and it has 21 million coins. Ethereum coins will just keep creating. And so what this EIP is also going to do is, when people send an Ethereum transaction, they have to send a small amount of Ether to power that transaction. Normally that goes to miners, right, to incentivize them to process your transaction. But what's actually going to happen with this new upgrade is they're actually going to take a piece of that Ethereum and burn it. They're going to completely destroy it. And what that's going to do is actually help to sort of keep the supply in check, which I think will kind of improve Ethereum's sort of longer term investment sort of benefits. The way it looks is a little bit more attractive. And it's basically, it's just going to sort of make the whole system, the transaction wait times a little bit better, and kind of remove that fee market sort of uncertainty. The problem is, though, is obviously there are a lot of people that make a living mining Ethereum, right? And this proposal is going to start really eating into their revenues. And so this is what's caused a lot of the upset, and this is sort of something that's going on in Ethereum right now, as it migrates from a mining system over to a staking mechanism. There's also another one called EIP 3554, and that's basically going to delay the difficulty bomb to December. And what that means is the difficulty bomb, when that goes off, that's just going to make mining even harder. And the idea of it is to basically force miners to sort of leave the network, and it's kind of promoting staking. It's kind of helping that migration across transition a bit faster. And that's been delayed because still Ethereum just hasn't quite got it together yet with its proof of staking mechanism at the moment.
Ollie Leach, Learn Editor at CoinDesk. Thank you very much. When we come back, counting down to the closing bell.
The final 7 minutes of trading, looking at a mixed picture. Dow and S&P still negative. The Nasdaq, though, holding on to gains up just around 0.2%. We want to get to Jared Blickery on the floor of the New York Stock Exchange. And Jared, you're keeping a close eye on the meme names today.
That's right, and we got a new addition to Robinhood. We'll get to that in a minute, but I'm looking at the Wi-Fi Interactive here. Kind of a mixed board. We do see some green. Lending Club looks like is up 5%, but check out AMC at the top. That's down 10%. GameStop down 3%. Just kind of indicative of the risk-off day that we're having in a lot of these sectors. I mentioned Robinhood. What a day for Robinhood. Up 80%, then it was down, I don't know, maybe 30, 40% off of those highs, and it climbed back up. But all driven by the options market, and also a little color on the short interest. We are building short interest, or there is a building short interest in the stock. It's been estimated by S3 Partners at about 10 million shares. Just a fraction. I believe there's 255 million shares outstanding. Too soon to call this a short squeeze, but I'll tell you what, those call options, those levered call options, really driving the price up. And we've been through this before, late January, early February. Then a few months later, the Reddit crowd knows what they're doing. If they really want to pump this stock, they're doing a pretty good job today. We've seen this before, so a lot of times it'll come back down, settle back down to reality, and then kind of consolidate and then go for a second burst. I'll be really interested to see what the crowd does with this one particular stock.
Jared, we're still watching 10-year yield below 1.2, and although people are selling the 10-year today, not fast enough. I mean, what's going on here?
It's fascinating. I'm glad you asked this question, because on that ADP miss this morning, we saw yields tank, and they were threatening to break to the lowest levels that we've had since February. Then we got some hawkish comments by the Fed's Clarida, and it sunk a little bit more. And then it just took off. So kind of a reversal in play here. Anytime we see interest at a lower level and then a subsequent buildup, a reversal as we do today, I think maybe we can have a continuation. It's not confirmed until we get the close tomorrow, but a lot of this is indicative of the Fed's thinking here. Even Yellen said that she expects policy liftoff after, I believe, 2022. She expects the conditions to be met for policy liftoff. Excuse me, those were Clarida's comments. I forgot, Yellen's no longer at the Fed, but she was speaking today as well. So Fed a little bit more hawkish, and we'll see if this gets some continuation.
All right, Jared Blickery, thanks so much. Again, taking a look at the broader markets here, the Dow off 293 points, S&P off around 0.4%. The Nasdaq, though, holding on to gains up just around 0.2%. A couple of big earnings reports for you after the bell. Of course, we will be watching Uber. We're also taking a look at Medifast. Their CEO, Dan Chard, he is going to join us right after those results are released. We'll get his big takeaway from the quarter for you. He is calling in as soon as those numbers cross the wires. We've got that for you right after the bell. About 90 seconds here until the closing bell. Looking at losses for the Dow and the S&P. We have Eric Sorensen. He's the CEO of Panagora. We also have Michael Vogelzang. He is CapTrust Chief Investment Officer. Michael, let me start with you. The losses that we're seeing today, the Dow off nearly 300 points. What do you make of the drop?
Well, other than another dose of Adderall for the market, not a whole lot today, right? There's a lot of mixed signals. We saw interest rates falling a lot. We're not terribly perturbed by the slowdown scare. So we're frankly kind of a quiet day, actually. Very, very mixed signals inside the market today.
All right, let's take a look at where we are here with the final 40 seconds to go in the trading day. Dow off just around 306 points, so a slightly larger leg lower here in the final couple of minutes of trading. S&P off 0.4%, pulling back from yesterday's record close. Nasdaq, though, holding on to gains, up just around 0.2%. In terms of the sector action that we're seeing, energy, the worst performer, followed by consumer staples and industrials. Those three trades not working in today's action. Dow's biggest laggards, Amgen by far, that stock off just around 6.5%. Chevron and Walgreens among the worst performers in the Dow today.
All right, we got a fresh hot serving of closing bell for you. Let's see where the markets are going to settle, and it's going to be the Dow off 320 some odd points, S&P 500 down about 20 points, but Nasdaq's going to be up to the up about 19. And just a quick point, as Shauna was just talking about with the Dow laggards, we did have some winners on the Dow, very few, just two. Salesforce, they were up about 1.5%. Nike was up about 0.5%. Let's go back to our panel and talk about what we're witnessing here. And Michael, you're not too concerned about the Delta variant. The COVID-induced moderation is not, as you say, the end of the world. But, the GM, for instance, the numbers we got out of GM is kind of a warning, isn't it, that there's still a lot of bottlenecks?
Yeah, the logistics will work themselves out, right? We've got some difficulty in logistical challenges. We have some inflation that's causing some indigestion at the moment. But specifically the Delta variant of COVID-19, we think is actually potentially positive for the stock and bond markets. Mostly because it might induce a bit of a slower economy. Frankly, the economy is booming. It wouldn't be the end of the world, as I said, to slow it down a bit. But it also might give the central banks around the world a little more cover to continue to provide some more liquidity than what I think the market's been expecting. So that could actually accelerate or extend some of the bull market action.
Eric, what's your view just in terms of the threat that the Delta variant poses to the market?
Say that again.
What's that?
Eric, can you hear us?
Yeah, I can hear you.
What's your view just in terms of the threat that the Delta variant poses to the market at this point?
I don't have a view on that. I don't know if you got the story right, but your handler was asking me to talk about some work we've done on small cap versus large cap over the last 40 years, including the last major run in small cap stocks starting about a year ago when I wrote a paper and predicted that.
So where do you think we go from here then in small caps? Because we do see the Russell 2000 off just around 1% today. You correctly called the bottom back in September. So where do we go from here?
Well, by way of backdrop, as a former academic, many of us studied small cap stocks, and there was something called the small cap effect. Basically, it was either return for risk or inefficiency, but they radically outperformed the bigger companies for 30 or 40 years. And the studies go back to 1926. And that changed in the 1980s, and the trend reversed itself to some degree. So there are long-term secular causes for small cap performance, and there are then shorter-term cyclical. And when we, a year ago, wrote this paper, the long-term secular one was interest rates. Bonds have duration, right? Yield curve. Stocks have duration. I've studied that and written about it. Some stocks are very sensitive to rates. A steady growth large company that's got pretty predictable earnings, rates rise, its multiple is going to get squeezed, and rates fall, it's going to expand. So what you saw from 1980, from the Volcker rigor with respect to controlling the money supply, really up to the last couple of years, is a general secular decline of rates. That hurt small companies versus the large companies. That's reversing itself in the next 5 to 10 years. So small companies are going to benefit from that. 3 other things, cyclical things. One of them is economic growth. That does help the Russell 2000. Secondly, market volatility being higher. Things are repriced more efficiently when people pay more attention, when there's volatility, which is no longer down single digit like it was the last 3 years, 4 years. And they were unbelievably cheap. A PE basis, price to sales, price to book. You didn't see small cap stocks as cheap a year ago as they were since they were cheaper actually than they were in 2000 in the last big run up. The flip side of that is what drives the large companies, and I think that's part of the catalyst as well.
Michael, I'm curious about this that you sent through to us, that your strategy is one that you're overweight U.S. equity positions, but with a more cautious tone. Describe your cautious tone. I know you're using it in a barbell strategy, but what does it look like?
Well, I think it's exactly that's exactly the point, is that, Eric's talking about interest rate sensitivity. And what we've seen are some of these really large mega cap stocks become very interest rate sensitive. The correlations to interest rates for the FANG stocks plus Microsoft plus a number of others are very, very high. And so as a market participant, I'm not particularly interested in trying to figure out which direction interest rates are going in the next, certainly not 6 or 10 months. What we know, though, is that those are very highly sensitive to interest rates. That is, if interest rates fall, those stocks are going to continue to do well. On the flip side, smaller value stocks will do exceptionally well when interest rates rise over the short term. We saw that in November when the small cap rally happened, when interest rates were rising. So, we're trying not to predict things like interest rates or oil prices or currencies. We're trying to understand and find interesting stocks to invest in for our clients. And so that's really what we mean by a barbell in our equity portfolios.
Michael, what do you make of the developments down in D.C., or really lack thereof, I guess, today? Because another day, we don't really have any significant development on the bipartisan infrastructure talks and the fact that we could potentially get a bill. But I guess, how big of an impact, or do you see this having an impact at all to the market?
Infrastructure is marginally constructive for the economic environment and for growth. I think longer term, it's really important for the country to make sure its infrastructure is in place. I don't think that has anything to do with today's stock market, but I think the competitiveness of the U.S. economy vis-a-vis our competitors or other foreign countries is really important, and it's been underinvested in for a long time. So from that perspective, I think it's critical. Short term, I don't think it's a particularly big deal. More worrisome for investors, I think, is taxes. And again, same point. We're not seeing a whole lot of progress on taxes over the last few weeks. I think the further we get along in the year, the more clarity we'll get. But it's hard to handicap that at the moment.
I realize it's hard to handicap it, but it seems incredibly unlikely that the administration would get the proposals it's put forward with capital gains tax increases. It just seems like it would be very hard, Michael. Even if we got something from the Fed at Jackson Hole, they can't even get past. The Democrats can't get past themselves regarding infrastructure and reconciliation.
Yeah, look, anything I say about the legislative process probably shouldn't be done on family television. So, it's pretty tough to know exactly where this is going to shake out. I do think the Democrats are playing a reasonably strong hand here. There's a lot of inter-party squabbling, and our best guess, and that's about what it is at the moment, is that we'll see some higher interest or higher tax rates on capital gains, which for wealthy individuals is going to matter. The devil's in those details, and like I said, it's really, really tough to handicap, except we think certainly the direction is higher.
All right, we want to pause real quick because we have a phoner joining us that we need to get to, and it's Medifast CEO. Medifast just out with earnings just a few minutes ago, and taking a look at the reaction, not seeing a heck of a lot of reaction after the stock closed at just around $287 a share. We want to bring in Dan Chard for his reaction to the quarter. And Dan, what can you tell us?
Well, it's good to be with you today. I think, we started a growth cycle that started really in 2018 when we were up 66%, 2019, 42%, and the pandemic year up 31%. We had a strong start to this year. First quarter 91%. And so now we just reported the second quarter up 79%. So it's really driven by the unique aspect of our model, which is our independent Optavia coaches who help individual clients get healthy by learning a set of healthy habits. So that number of coaches grew 62% to 59,000. And that's what's driving the growth. So we feel like we're in a unique position at a time when there's a lot of interest in becoming healthy, and so we're happy with the quarter and feel like we're well positioned to continue to address this large market.
Dan, I know you're going to get grilled on that earnings call in just a few minutes, but where do you go, forward? Where should we be watching? Is it going to be growth in the United States? Is it Asia Pacific? What do you see coming down the pike?
Well, this health and wellness, I'll call it a pandemic, that's kind of led by obesity rates across the world, is led by the United States, but other developed countries and also in developing countries. So there's this enormous addressable market, not just in the United States, but abroad. Our specific focus, we talk about our mission as being to offer the world lifelong transformation, one healthy habit at a time. So we started in the United States, as you pointed out, about a year and a half ago, expanded into Asia Pacific, into Hong Kong and Singapore, and we continue to grow in both of those markets. And our focus really is leveraging this model to attract new clients and achieving our long-term growth objectives of continuing to expand throughout the world and achieving growth in the mid-teens.
Dan Chard, CEO of Medifast, we will let you go because we know your earnings call is getting underway in just a few minutes. So you are a man in high demand right now, but we look forward to talking with you a little bit more about the quarter and what to expect going forward tomorrow afternoon. So make sure everyone tunes in for that. In the meantime, though, the earnings keep rolling in. Roku is out with its results. Shares off pretty significantly here after hours. Jared Blickery has that for us. Jared?
That's right. It's a mixed report, beats on a few key numbers, but a miss on another few key numbers here. Let me go through them. Net revenue was a beat, $645.1 million, up 81% year over year, and that beats the street estimate quite handily of $613.1 million. But a lot of that's coming from platform revenue. So platform revenue beat $532 million. Estimate was for $494 million, but player revenue missed. So that came in at $112.8 million, up only 1.3% year over year. Estimate was for higher at $121.3 million. Average revenue per user, now that's a beat as well, $36.46, up 46% year over year. Estimate was for slightly lower at $34.66. Now, active customer accounts came in at 55.1 million, and that is lower than the estimate of 55.8 million. Streaming hours, that's a miss too, 17.4 billion. Estimate was for 19.19 billion. So what this might be saying is, and this is going to be interesting to find out potentially on the call, are people simply streaming less now because they're going out more, or is the competition eating their market share? That's a key question there. Gross margin was a beat, 52.4%. Estimate was for 48.9%. And then finally, adjusted EBITDA coming in at 122.4 million, and the estimate was for 69.3 million. So big beat right there, but the stock's sinking in after hours trading because of the misses on some of those key numbers.
All right. Hey, Mike, hold one more second because we got to get in Uber earnings. I got Dan Howley standing by. And Dan, I don't want to steal the headline here, but I'm trying to figure out why the shares are selling off.
Yeah, right now, if we're looking at it, they obviously seem to have had a good quarter based on gross bookings, $21.9 billion, beating expectations by a hair of $20.93 billion. Mobility was higher than expected by about $300 million. Delivery was higher than expected by about $600 million. Earnings per share beat. What the issue here is the EBITDA loss. Analysts were expecting an EBITDA loss of $324.5 million for the quarter, but what they ended up with was $509 million for the quarter. So that means that they're not going to get to an EBITDA profit in anytime soon. They're now saying that the next quarter they will potentially get closer to what analysts were expecting. They're looking for an EBITDA estimated loss of $95.4 million. The Uber is saying below 100 million. So, 95.4 million is definitely below 100 million, but it's not exactly what analysts were expecting. And I think that's really where the shakes are coming in.
Dan Halley, thanks so much. We will have more on Uber's earnings in just a few minutes. But Mike, I want to bring you back in quickly. Just as we take a look at earnings season so far, this reaction that we've seen if a company disappoints on just one line, one item, we're seeing this severe reaction to the downside. What do you make of that? And I guess what does that tell us just about what investors are expecting at this point?
Look, I don't know anything about the companies that were just talked about. I mean, I know them a bit, but I think the takeaways that make some sense here are twofold. One is that these kind of companies, Roku, Uber, are exceptionally highly valued. They're priced for perfection, and if you have a blemish on your earnings quarterly call, you're going to have a difficult time, right? So I don't see it a whole lot more than that. There are people who are living on every number, and when you get a number that doesn't hit what analysts and portfolio people were hoping for, you're going to get a sell-off. The other thing is, of course, this can change in the morning. So we once real trading starts, the trading tonight is pretty thin on some of these names. The other thing I would say that I really actually like about what we've seen in the market over the last number of months is sort of these rolling corrections in various sectors. If you think about February, we had a really big, large pop in small cap, in very aggressive growth stocks. That's deflated in a lot of ways, but the market hung in there. We've seen the same thing with value stocks. They had a really huge rally. They've rolled over in a significant way. The FANG stocks, the super large cap tech companies, have done really well recently. There's this sort of rolling a release of pressure and tension in the markets that I think is really healthy. So instead of the market taking a nosedive, you get these swells underneath it, and I think that's really helpful. And so to me, actually, seeing some of these really good negative reactions can be a sign of a healthier market than not.
Mike Vogelzang, great to have you. CapTrust Chief Investment Officer. We need to take a quick break, but when we come back, more on Uber. The stock's still off pretty significantly, off just over 6%. We will have more on that when we come back.
Etsy earnings out, and they're falling big time in aftermarket. What's going on here? Let's bring in Inez Ferre. She's looking at those earnings for us.
That's right, Adam. Etsy right now down about 11% in after hours. Its revenue for the second quarter came in above what the street had been expecting. Earnings per share coming in at 68 cents. That's a penny shy of what the street was expecting, but it's also a slowdown year over year. Last year, the same quarter, 75 cents per share. Etsy is seeing its third quarter revenue coming in at anywhere between 500 million and 525 million. That's shy of what the street is expecting. And it also is not issuing guidance for the full year for 2021. So very important here, what's happening with e-commerce, this sort of slowdown that we've been seeing. Amazon last week announcing a slowdown. You saw last week Etsy shares were down because of Amazon, because of this fear that we're slowing down when it comes to online sales as economies reopen. Adam, Shauna?
Inez, thank you. Let's get back to those Uber earnings because those shares are still trading down after hours, off about 6%. Let's bring into the stream Wedbush Securities analyst Yigal Arounian, and it's good to have you back, Yigal. What's the headline to you? Because there's a lot in these numbers we want to break down with you. But what is the street perhaps missing, or is it sell on the news?
I think the headline is that the results are mixed. I mean, bookings overall were above expectations, but the EBITDA loss was bigger than expected, and kind of read through a continuation from Lyft and their results last night is that there's still a lot of investment into incentives to bring drivers back onto the platform. And while demand is still high, it's costing a lot for Uber and Lyft to bring drivers onto the network, and that's having an impact right now.
Yigal, I saw that you have a price target of $66 on Uber with a loss that we saw there on EBITDA. Does that make you rethink things at all or question, I guess, at least the short-term performance of the stock?
Maybe. There's still a lot to kind of work through here. The results just came out. We want to hear what management has to say on the call. All that will be very important. They did highlight in the press release that they still expect to reach EBITDA profitability by 4Q. Notably, that's become behind Lyft, which hit EBITDA profitability this quarter and expects to stay there. Originally it was Uber that set the target earlier. So there's a little bit to think through there, but the food Uber Eats delivery business is remaining strong. I think that's critical. Overall demand is staying strong for the mobility and rideshare business. I think that's really important. We expect the kind of driver issue to work itself out over time, or it certainly got better over the quarter. I think as some of the unemployment benefits start to fade, more drivers will come onto the network. That those issues will fix themselves out. So on the core of the business, the strength and demand is probably the most important out of everything. And some of these core things I think are a little bit more transitory and will work themselves out over the remainder of the year. So I think it's still a positive story in the rideshare and the food delivery business.
When you talk about food delivery, I mean, I'm looking at the top line of the release where they talk about delivery gross bookings, 12.9 billion, up 85% year over year. Might investors be worried that, okay, we are going to get out of this pandemic even with the Delta variant spike, and that perhaps the delivery slows down a bit, or am I missing?
Yeah. That's an area we've been a little bit cautious on. I think we remain a little bit cautious on. They definitely came in better than our expectations for the quarter. So the business is proving to be, at least for now, still resilient. The area where the delivery business has real opportunity and where you can see growth rates stay elevated is the newer parts of the business in grocery and essentials, delivering for pharmacies, for example. They just launched their grocery business nationwide. They just bought Drizzly, getting into alcohol delivery. So there's a lot more that they're doing there to diversify away from just restaurant delivery, and really become this kind of last mile logistics company for a lot more than just restaurant. And I think that's the opportunity to see the growth stay strong in that business.
I know it's not technically an apples to apples comparison, because what you're just talking about, that part of Uber's business, the delivery business, clearly separates it from its competitor Lyft. But when you do take a look at the ride sharing part of Uber's business, comparing that to what we heard from Lyft last night, I guess, how did the two stack up against each other?
So I think we'll have to wait and hear a little bit more from Uber about their intentions for how they, expect to continue to invest behind driver incentives. So that's why Lyft was down today. They had a pretty strong quarter. Their profitability was well ahead of expectations. And then on their earnings call, they talked about investing more in drivers and bringing prices down. Right. That's been one thing that hasn't returned to normal for Uber and Lyft and rideshare is that prices have stayed strong because the supply hasn't caught up with demand. Riders have been willing to kind of overlook that in the near term and pay more because I think most people kind of understand the dynamics now. But I think going forward, you'll probably start to meet a little bit more resistance from people when they have to pay so much more for rides. So Lyft is taking the approach to actively try to bring prices down. That means in the near term, costs are going to grow faster than revenue. That was the big issue for Lyft and their results. It's not clear what strategy Uber is going to take, but to me, they're going to have to kind of keep prices in line. Otherwise, they'll likely cede some share to Lyft. So there's a lot more to learn from Uber and how it intends to bridge from where we are today to what will ultimately be a more normal environment closer to the end of the year.
Yigal Arounian is a Wedbush Securities analyst. Thank you for taking time to speak with us about this earnings report from Uber. When we come back, Royal Caribbean out as well with their earnings. Shares fell as the cruise line posted a wider than expected loss, but the bookings are up and Americans want to travel and hit the road. We're going to talk about all this with the CFO, Jason Liberty, right after the break.
Royal Caribbean out with earnings this morning, posting a wider than expected loss. You can see that on your screen right now. Disappointing revenue. The stock off 2.5%, but some good news in the quarter, 50% increase in bookings compared with last quarter. So we want to talk all about this with Jason Liberty. He's the CFO of Royal Caribbean. And Jason, that 50% in bookings quarter over quarter, certainly a strong sign here for your company going forward. Just what's your assessment of where things stand today with your business?
Yeah, sure. Great. Well, first, it's really great to be here and we are really excited because it was only a few months ago that we only had a couple of ships operating, and today over half our fleet is operating, and by the end of the year we expect to have over 80% of our fleet operating. What we clearly see is this past quarter was really just about us beginning to ramp up our ships, and as we look forward, what we see is really strong demand trends, especially as we get into 2022. Rates are up. Our volumes are very competitive to what we saw pre-COVID. And it's very clear to us that our guests and our customers are looking to get back to enjoy these incredible vacations that our 5 brands deliver for them each and every day. So we're really excited, and we think that it's the waters are more predictable in front of us, and we also think that it's clear that the consumer is ready to travel.
Are you having any trouble recruiting the men and women you need to staff the ships? We keep hearing about the labor shortages, and I know that in some cases, some of the people who do staff those ships are not perhaps U.S. citizens. But what does that look like for the cruise line going forward?
Yeah, one issue we don't have is generating demand for our crew to come back to our ships. I've had the opportunity over the past several weeks and months to be on our ships as our ships are coming back up into service, and there is plenty of demand for our crew to come back. They are elated to be back on and getting ready, and in many cases delivering what they do best, which is delivering these incredible vacation experiences to our guests. So we really haven't been challenged by that. I mean, there's always been some on the overall logistics side of things, getting our crew here and vaccinated and so forth. But in terms of our ability to attract the crew, it's been no issue at all.
Give us a look at, or an inside look at, the consumers and the spending trends that you're seeing. I guess compared to 2019 levels, are the travelers on your cruise ships, are they spending more or less than they were 2 years ago?
Yeah. So we over the past, really since the beginning of the year, we've had about 135,000 guests travel with us this past quarter. We had about 35,000 guests travel back on our ships. And one thing that's really clear is that there is strong demand and willingness to spend. The second quarter, we saw our guests spend almost twice what they typically spend in historical or pre-COVID periods of time. Some of that is on our incredible islands like Coco Cay at Perfect Day, which you're showing here on the screen, and some of that is in the spa and in our retail shops and so forth. So what we clearly see is they've been saving, they have money to spend. There was really built up demand for them to be on our ships and experience our brands and assets, which is what they were used to pre-COVID.
Are they loyal customers returning, or are they new customers? Are you actually grabbing a whole new set of people who will cruise into the future?
It's a little bit of a mix. Certainly right out the gate, our loyalty guests who are just so incredible and have stayed with us through this journey are certainly a greater percentage of the mix here in the early days. But what we are seeing is a quick resurgence of the new to cruise coming on for that weekend getaway or just spending 4 or 5 days on one of our ships. So the mix is coming back into balance, where basically a third of our guests are new to cruise, a third of our guests are loyal, and a third of our guests are first to brand. And when that's kind of in concert, we're able to drive very strong pricing in our model.
Jason, what's your view just on, we've heard more and more companies beginning to mandate vaccinations for their workers. You're in a business where you're consumer facing. Many of your employees have face-to-face interaction with the travelers. What's your view, or what's your stance on potentially mandating vaccines here in the short term?
Yeah, well, the health and safety of our crew and our guests is really a number one priority for us, has been a number one priority for us. And so we, for some time, have really mandated that our crew are fully vaccinated on our ships, and so these ships that having half of our fleet back up and running are filled with crew members that have been fully vaccinated. We believe the combination of vaccination as well as the health, the protocols that we developed with our Healthy Sail Panel have really driven a situation where you're much safer on our ship than you are at land, and we've been proving that as we've been operating and having very, very few COVID cases.
I see the University of Miami helmet behind you, and I'm thinking it's easy to get to Coral Gables. But I got to ask you, some of the destinations outside the U.S. are the governments that are so dependent upon the tourism and the tourists you bring them. Are they being cooperative in the reopening, or are you facing some hurdles there?
No, exceptionally helpful in this process. We have ships turning in Greece, we have ships turning in the UK. That has all come to be through the leadership of these different governments and making sure that our crew is vaccinated. We have access to the ports, we have access to the destinations. So everybody in our ecosystem is very eager for us to return, and we're all working together to make sure one, that the guest experience is as we would expect it to be, and it's also being done in a healthy and safe way.
Jason, great to speak with you. Jason Liberty, CFO of Royal Caribbean, and we hope to have you back here on Yahoo Finance next quarter. Another big story that we're watching here, the New York State Assembly accelerating its impeachment investigation of Governor Andrew Cuomo. Now, all this happening after the report that was released yesterday detailing numerous instances of sexual harassment. But we want to talk about the business aspect of this and what this means for the very economically important state of New York. And for that, we want to bring in our editor-in-chief, Andy Serwer. And Andy, I guess from your perspective, what does this mean here for the future? And I guess what it could potentially, the impact it could have on a nationwide scale? Andy, I think you might be muted.
Yes, I am. I was trying not to make noise. I'm sorry about that, Shauna. But yes, just to respond to your question, the longer that Governor Cuomo stays in his position, the more of an effect it has on New York State and the economy in, as you said, this critical state. And of course, it has impact on the rest of the country as well. He's the leader of this state, which has a $200 billion budget, number 2 after California. The GDP of New York State is 1.7 trillion. That's number 3 after California and Texas. There are some 54 Fortune 500 companies based in New York State. That includes our parent company, Verizon, JP Morgan, Pfizer, Goldman Sachs, and dozens of other household names. And, sure, everyone's going about their business. It doesn't affect them. But when you look to the leadership to try to get things done or simply to get some direction in this very critical time, coming out of COVID and maybe going back into a little bit of COVID, this is not good. And it's just shocking, quite frankly, that the governor is not stepping down. The president of the United States has suggested he stepped down, and now he's facing just a litany of investigations, and yet he stays in that chair.
Andy, there have been Democratic governors who have survived the call to resign over different issues, but this is potentially criminal. And can you think of anything in the past where a governor successfully was able to stay in office facing these kinds of potential criminal charges?
Well, the short answer is no, Adam. And I'm not sure why he's taking this long. I mean, he's obviously deflected these charges for years. And in fact, a source reached out to me today who was the head of the executive director of the National Coalition for Homeless Veterans during the Clinton administration, and worked with Cuomo when he was head of HUD, and said that, quote, the pattern of behavior was well known. There, of course, were a flurry of news stories within the past several years and allegations as well. But this very damning report really should end it all, I would think. And you're right, the criminal investigations on top of that potentially really make, I think, it untenable for him to stay in that position. And it's surprising to me that maybe he's negotiating his exit. That's all I can surmise at this point.
Yeah, surprising me as well, as long as he's lasted. All right, Andy Serwer, of course, the story that we will continue to follow here at Yahoo Finance. Andy Serwer, thanks so much for joining us today. Coming up next, investing in healthcare, Bain Capital's latest investment in the healthcare services space. We have that for you right after the break.
We talk about opportunity for investors when it comes to healthcare, and one of the firms that knows how to find opportunity is Bain Capital. They've been investing in healthcare going back to about, 2003 or 4. Let's bring in their managing director at Bain Capital Private Equity, Devin O'Reilly, because Bain Capital announced this morning an investment in PartSource. And help us understand what PartSource does for those of us who haven't lived in Cleveland, Ohio before, and how if you ever should engage with a hospital or different kinds of medical devices, you might be dealing with a hospital that's sourcing via PartSource, right?
Yeah, thanks for having me. PartSource is a really innovative healthcare IT company that is solving a complex problem that, if you're a hospital trying to manage a very long list of med tech equipment that you have in your facilities, you'll have the need for replacement parts and also service technicians that you need to actually service that equipment and perform that maintenance. And so it's very complex because there's over 3,500 hospitals in the U.S. and thousands of medical med tech equipment companies and even more service providers. So what PartSource does is basically provides a B2B marketplace to bring all those parties together and allow hospitals to procure those parts and services in a very efficient and cost-effective manner. So if you're a patient and you go into the hospital, you need the medical equipment and the doctor be ready to serve you. PartSource is part of that whole ecosystem that's helping hospitals run efficiently.
Devin, Bain Capital is one of the most active investors when it comes to this space, when it comes to healthcare. I'm curious just in terms of when you look for potential investments out there, I guess, how has that strategy or how has what you're looking for changed as a result of COVID, or has it?
Yeah, well, look, every healthcare provider has gone through a difficult time over the course of the last 12 months. And so, I think what we see from an investment perspective is that a lot of trends that were actually happening in the marketplace prior to COVID have actually been accelerated by COVID. And so, for example, telehealth is one area where, prior to COVID, is starting to be more and more telehealth visits and clinicians visiting with patients via telehealth. But obviously, COVID dramatically accelerated that. So we had some providers that were, 2 or 3% of their patient visits were in the form of telehealth. But during the peak of the COVID crisis last summer, that went to 50% or more. But what we see now is now that we're hopefully largely through the crisis, that's still settling out at maybe 20-25% of some types of specialties in primary care are seeing patients at that type of level. And so I think that would have played out over a longer period of time, but that's been accelerated by COVID. And so we're seeing trends like that that have been underlying trends that have been actually accelerated by the COVID crisis.
Their clients, your clients now, are some of the biggest names in hospital care in the United States: Cleveland Clinic, Johns Hopkins, Mayo, New York Presbyterian. They have endowments and foundations that can pay, whether it's for software or these kinds of systems. What about smaller hospitals? Is there a product for them, that PartSource, or is that a growth area for PartSource?
Yeah, this PartSource actually serves all different types of hospitals and health systems. If you think about the problem that they're solving, it's basically trying to create more efficient healthcare by bringing together in this marketplace form all the suppliers of med tech parts and service and all the potential buyers. And so the problems are equally great for some of the smaller hospital systems, and even perhaps more so because they don't have as large of a staff to be able to manage some of these issues. And so we really see it as a significant opportunity for all types of healthcare providers, and even beyond the acute care hospitals. So a lot of patient care is migrating into outpatient facilities and doctors' offices, and that is a future opportunity for the company to serve those types of settings as well. And another opportunity we think about is hospitals all around the world outside the U.S. deal with these same types of challenges, and so that's another perhaps growth opportunity for the company.
We appreciate your sharing a little bit about this deal with us. Devin O'Reilly, Managing Director at Bain Capital Private Equity. All the best to you. When we come back, tale as old as time. Beauty and the Beast being those nasty chemicals you sometimes get in makeup. Doesn't have to be that way. In our short business spotlight, clean beauty. We got the founder joining us right after this.
Clean beauty products are a big driver in a growing market for skincare. Now, the skincare market is huge. It's actually expected to reach $181 billion by 2025. So we want to talk to one founder of a company that's looking to capitalize on some of this growth, specifically in clean beauty. And for that, we want to bring in Kendra Cole Butler, founder of Alpine Beauty. And Kendra, it's great to have you here. This is a segment clearly that has already experienced pretty tremendous growth, and looking forward, certainly lots of opportunities there. Just talk to us just about how Alpine Beauty fits into this space and why you're seeing such a huge opportunity for clean beauty products.
Well, I think there's a secular trend for clean beauty in general, because people are starting to realize that by taking toxins and chemicals out of our skincare, we might be in a healthier state of the skin, body, and mind. What we're doing at Alpine Beauty that's a little bit different is we are using wild plants that we sustainably harvest from my hometown of Jackson Hole, Wyoming. So taking that clean trend one step further and utilizing the powers of Mother Nature and the potential of these wild plants that grow basically untouched by man, and harnessing the benefits that they can bring directly to the skin.
Some of us are old enough to remember when people from South Florida would flock to Costa Rica for facelifts and then rub their faces with Crisco. We've come a long way.
We've come a long way.
Yeah, there's a bunch of my mother's generation, let me tell you, it wasn't a pretty sight with Crisco on their faces. Who's the market? Is it women who might be 50 and older, or is it younger women who are demanding these cleaner products for their skin?
There really is no specific age range. I think that all generations are starting to realize that in this 21st century, we have made tremendous progress in terms of technology and skincare ingredients, and we can utilize more natural alternatives to those things that once just came from a chemical lab. So I really think there's no specific age group. You of course have the Gen Z and millennials that are very into research and they're constantly online learning about new ingredients, but we have customers over 60 years old that love and appreciate the brand. And really, it's every woman just wants results. Every man, anybody who's using skincare wants to see their products perform. So if you can get that from a natural substitute, why not?
Kendra, what natural ingredient would you say is the next big thing in skincare that we should all be excited about?
So we're really loving the retinol alternatives right now. Retinol has been around for a very long time. It's kind of been the gold standard in skincare, but it's produced chemically. It's a chemical synthetic, and it can have some adverse reaction on the skin. It can have dryness, redness. It's not for everybody, even though it's an amazing ingredient. So the natural alternatives to retinol we're seeing right now are something called bakuchiol. It's from the bobchi plant, which is amazing. And this plant has actually been clinically tested against retinol, and it's neck and neck in terms of anti-aging performance, fine lines and wrinkles, uneven texture and tone on the skin, but not from a chemical lab. So we're able now to find those natural, clean alternatives that are just as effective as those that come from a chemical lab, but none of the downside. So that's really exciting for us.
This is a small business segment. I'm curious, as a founder, what advice do you have for other founders so that they don't burn out as they're growing their businesses?
Burnout is something that we've all experienced, I think, and not just founders. I think people across this, country in general, we've all felt like we've had a place in our life where enough is enough. And my advice, not only to founders, but to other people experiencing that, is make sure that you set your limitations and you set boundaries in your life. And when you feel that burnout is coming on, just take a TO and take a break, because once you burn out, it's really hard to get back in the other direction, versus just taking care of yourself along the way and slowing down and preventing it from actually happening.
I think that's advice we can all take to heart. Kendra Cole-Butler, founder of Alpine Beauty, thanks so much for taking the time to join us, and we wish you all the best. We are going to take a quick break. On the other side, a couple of things you need to watch for tomorrow. We'll be right back.
All right, as we go into the home stretch, a couple of things you're going to want to watch for tomorrow. Shauna, you're up first.
Adam, I'll be watching jobless claims are out at 8:30 a.m. Eastern time tomorrow, coming off that disappointing ADP report that we got before the bell today. We're expecting 383,000 jobs. That would be a 1-month low, down from last week's 400,000. So we'll see whether or not we pull through and actually beat expectations. And again, this is ahead of the big jobs report on Friday. How about you?
Got to keep an eye on several things, but some of the guests that are coming up on the Yahoo Finance platform. We've got Paul Jacobson, CFO from General Motors. You heard Prost breaking down the GM earnings earlier during our program. We're going to hear from the CFO himself. Also going to have on Glenn Fogel from Booking Holdings. He's the CEO. And then coming back into the program tomorrow with us will be Dan Chard from Medifast. He was talking about the earnings report they released right after the bell when he called us on his way to their earnings call with analysts. We're going to talk more about what's going on, and they make the healthcare, dietary supplements, and all of that. So we're going to be talking with him. It's a company that's got a market cap of about $3 billion. As we wrap it up, let's take one last look at where the markets finished today. We were down on the Dow 323 points. The S&P 500 was off 20 points, but the Nasdaq did manage to finish up about 20 points. We will see you bright and early tomorrow morning, 9 a.m. Yahoo Finance Live.